Motherfucker.
Welcome back, everybody. Stock futures, if you're just waking up, are falling this morning. It looks like the Dow futures are off by about 220 points. S&P futures and the NASDAQ down as well. This comes after a report said that Ukraine launched an attack inside Russian territory using those U.S.-supplied long-term missiles. For more on the markets right now, we want to bring in Sylvia Jablonski. She's CEO and Chief Investment Officer of Defiance ETFs. And Sylvia, I know this isn't what you were planning on talking about this morning, but welcome to live television. How concerned are you about this report out of Ukraine? We're looking at a reaction this morning of the markets down. It was a big drop down when this report came out, but you were still talking about a decline of less than 0.6% for the Dow and even less on a percentage basis for the other major averages. What are you thinking?
Good morning, Becky. Well, you know, it's never good to wake up to this news, but I think this has always been the caveat on what could potentially hamper our markets rally going into year end or even going forward. We have essentially two wars going on, two major wars that we're well aware of and monitoring, and escalations tend to lead to market pullbacks. And so what I would say is what I see so far is a muted reaction to this, as compared to what we've seen with some of the attacks in Israel, for example, where you see NASDAQ off 300, 400, 500 points or so. So perhaps the market at this point is muted and digesting the information, but how it escalates, we have a switch of presidents coming into office, and kind of where this all goes is up in the air right now.
Yeah. Having said that, we have a new administration coming in. You have the market that has been pretty enthusiastic about the potential for this new administration, but still a lot of questions on the details of how things are going to work. There were a lot of promises made during the election cycle, and there's been a lot of commentary, some written pieces recently just digging into the idea that these are not all promises that are going to be able to be delivered if you're looking at the math. You made promises to the wealthy class, you made promises to average Americans. How does this play out? And I guess, what do you think about where we've come so far just in terms of the market's enthusiasm and what can be delivered?
Yeah, sure. So I think that, where we've come in the markets is very much due to the macro backdrop, right? We have strong jobs, we have wages that have been steady and increasing, a consumer that's been spending, a lot of stability essentially in macroeconomics, GDP to 2 to 3%, rates coming down, supportive Fed put. And so I thought, regardless of the election, the market should do well. The market should rally into year end. Corporate earnings are holding up. Projections for next year are high single digits, low double digits. Everything is sort of rosy, soft landing, roaring 2020s. And so what the market doesn't like, though, is uncertainty. And as you said, we don't know which policies actually get passed. We don't know what happens with tariffs. We won't know what happens with immigration. Those two things can affect supply, which can affect inflation. But then again, deregulation and tax cuts can lead to potentially the opposite happening. So it could be a net zero. So it remains to be seen what actually passes here. But I think overall deregulation, cutting taxes tends to be good for markets. And the path of the Fed matters a lot, right? So as long as inflation doesn't creep back up and the Fed's kind of steadily reduces rates, I think we'll be okay. And I think the market rallies into year end. And I mean, we're almost there anyway. And it's, kind of rallied in minus this pullback, but potentially a strong year next year as well.
I think the biggest question maybe is, do earnings keep up with some of this enthusiasm? We have lots of, as you mentioned, enthusiasm that is tied to deregulation and lower tax rates, and that's clearly a plus for business forces being unleashed. But you also have markets that have risen pretty substantially. Everything looks great, but there's always a price, and what's the price? So where do you think, just about where stocks stand in valuation terms at this point?
Yeah, I mean, valuations are high, but earnings has thus far justified those valuations. And so I think what happens is if you actually get the tax cuts and you actually get the deregulation and rates keep coming down, that is undoubtedly a tailwind for corporate earnings going forward. And I think that keeps up with the rally. In terms of when it exhausts, I think that there will be an end in sight, but probably not in the near term here. So the other thing that I think investors can do, though, is broaden out their exposure, right? So the overvaluation comes from the top 33% of the S&P 500, which is really the Mag 7. And so if you broaden out to the other 493 names and, kind of look at the X-Mag, the names that are hidden in there, like the Constellation Energies, the Vistras, the GE Renovas, the Palantirs. I mean, there's a lot of places to put your money that kind of aren't overvalued at this point.
Sylvia, thanks a lot.
Thank you.
Coming up when we return, news out from smart ring maker Aura. Company CEO Tom Hale is going to join us next to talk about it. And then later this hour, former Google chairman and CEO Eric Schmidt will be right with us here on the Squawk Set. So much to discuss with him this morning as so much news pours through the system. We're coming right back. Welcome back to Squawk Box. Dexcom and Aura are announcing a strategic partnership combining Dexcom's glucose data with Oura Ring's biometrics to enhance metabolic, health insights, alongside Dexcom's $75 million investment in Aura's Series D funding. The company now valued at over $5 billion. It's a company that has a huge number of very prominent investor names that you all know, and we've talked about Aura for a long time because so many people wear it, including myself.
I thought you were going to say prominent users.
No, not prominent users.
I really thought you meant yours truly.
But no, everybody from Michael Dell back in the day. Tom Hale is going to be joining us, but everybody from Michael Dell to Lance Armstrong were some of the early investors in the Oura Ring, and now the company's worth $5 billion, and now we can.
That's why Lance Armstrong was so good. Amazing.
It was after his cycling career. Right. Tom Hale, it's nice to see you, sir.
Andrew, super excited to talk about the strategic partnership between Aura and Dexcom. Like any good partnership, it's a little bit of product integration, a little bit of collaboration, and a little bit of investment. The story is a personal story. It started, when we met in person, and Kevin Sayer, the CEO of Dexcom, was wearing an Oura Ring, and I was wearing a continuous glucose monitor, and we both immediately looked at each other and thought, oh my God, there's a huge opportunity here.
So, for those who don't know, I hopefully our audience knows what an Oura Ring is at this point. This is a ring, I'm wearing one of them, that tracks your sleep, but also tracks your activity throughout the day. For those folks who have an Apple Watch, it's a little bit different in that it's a smaller form factor, but similar in concept. Tom, I don't know if you would be offended by that. I'm just trying to figure out a way to explain it to folks. But the idea of a continuous glucose monitor is something else that's become a very big deal in the world of healthcare over the last couple of years now. And now the idea is that folks that would wear a ring and a Dexcom monitor at the same time, it sounds like. And the question that I was going to ask you is, would you wear the glucose monitor for folks just who have diabetes, or now increasingly I'm seeing people who are wearing these simply for health, just to understand their own glucose needs for diet and everything else?
Well, glucose is important. It's the energy source of the body, and it's affected by sleep activity and stress, and your daily biology changes as you eat food. So understanding glucose is key. And by the way, most people don't understand it. Now, what's happened with glucose monitors is that they're more available, affordable, and accessible than ever before because they're now available over the counter in the US. So anyone can go to a pharmacy or Amazon or Stelo, which is the brand name of glucose monitor from Dexcom, and get one of these things delivered. They can wear it for 15 days or 30 days as they see fit and start to see real insights about what they eat and how that affects their biology. And of course, we want to see how it affects all the elements of their holistic health, and that's where the Oura Ring comes in. I'll tell you, I learned a ton about myself. I've got one on now. It's really changed what I eat and how I think about foods, which I thought were healthy and actually turned out to be sugar bombs for me.
And so the big question is, how is it integrated with the ring?
So the software application from Aura, the Aura app, takes all the information from the ring. We'll also ingest the data from the glucose sensor, and we'll interleave that data to provide you new insights. So for example, one thing that people will learn is that about an hour before they wake up, their blood sugar spikes along with cortisol in their body. It's part of an evolutionary adaptation to sleeping in exposed areas. It wakes you up and brings you right into the consciousness. Other things people will learn is, listen, if I eat late, the sugar that I eat sometimes can maybe delay the onset of sleep or maybe make my sleep lower quality. These kinds of insights are going to be different for everybody because everybody's physiology, genetics, history, and diet is different. And I think you think about sleep, it's the one thing everybody does at least once a day, but everybody eats 3 times a day. So it's the kind of behavior that can really make a big impact on your life.
Tom, is your expectation, though, that people are going to buy a Dexcom, wear it for, as you said, 30 days, and then stop, and then just have those insights that they know from that period of time, or that they wear it continuously all the time, the same way people would wear a ring all the time so that they would know and be able to track everything that's going on all the time? And by the way, obviously there are people who think they don't want all this data. But that's a separate matter.
There are certainly advantages to gaining the insights and understanding what works for you. Like, for example, if I eat rice, it spikes my blood sugar. And that learning, now that I've learned it, I change my behavior. The reality is what you want to see is change over time. So what we see is people will be wearing the ring to kind of give them the sense of their biology over time and how it's changing. And then they'll apply glucose monitors when they see that they've made some changes. You know, if you've started working out, or if you've tried to be focused on sleep, or you've tried to really improve your health, you want to see that show up in the way that the glucose and the sleep and the stress and the activity all interact. I think providing that experience is going to be powerful for people.
Tom, there's been speculation for a long time. I mentioned the Apple Watch earlier, that Apple has been working on an effort, and others as well, I should say, to do the equivalent of glucose monitoring without pricking you and having to wear a separate device, right? This is sort of the holy grail of, I think, the business you're in, which is, you know, this ring basically has a whole series of light sensors on it, and that maybe there's some way to actually figure out glucose without actually having to stick a needle in you. By the way, I've done this before. The needle doesn't feel like anything. It's a nothing thing.
It hurts on your finger.
But if you could avoid that, and there was something non-invasive at all, that would be, you know, a miracle. How far do you think you are from that? And irrespective of how far you are from it, how far do you think the industry is from that?
You know, this is a topic of lots of people's interest. I think the reality is that it is kind of like the Holy Grail, which is it might be out there, but, you know, no one's yet to find it. I do think it's possible, but it's probably going to be measured, you know, in maybe a decade or so to be accurate enough and to be, you know, for people to be confident enough that they would trust their lives to it. In the meantime, CGMs are the best that we have. And they work, and they're here today. And I think the learning about glucose and learning about its impact on longevity, on sleep, on stress, on health, I think is something that is going to be really transformative. And we've already seen it. Like, I was in New York last week, and people were saying, hey, I'm going to a party. We're all going to put continuous glucose monitors on and talk about sugar. I mean, it's a really interesting social thing that's going to happen.
Wow. Matt Gates might, probably not. Tom, what besides rice got you go? Because I may not wear the ring, but I can benefit from your experience. What caused your sugar bombs besides rice? What are the
Some
things?
people have different sugar bombs than others.
I know, but I don't know. We kind of look alike. Tom, what caused it?
I used to drink a latte in the morning, yogurt with granola, and think I was being super healthy.
Yeah, yogurt.
Of course, completely spiked my blood sugar. Rice was the real surprise. Turns out I'm very kind of insensitive to rice. But there's lots of other foods that I think you might consider healthy that might surprise you.
Snickers bar, is that something I should?
Definitely off the menu.
That's not good. Okay.
Yeah. Sorry
if
about
you think
that.
of them, let me know.
I mean, it was yogurt that had fruit in it. Like, you're not talking plain yogurt, right?
You know, plain yogurt is better, and I think for me, flavored yogurt was really what was the kryptonite. The point is that everyone can have a different experience and a different learning because everyone's physiology is different.
What's the price point, real quick, of these continuous glucose monitors that pair with the ring?
The Dexcom Stelo glucose monitor, they sort of come in packs of 2, and it's roughly $99 for 2, or 30 days. It's much more affordable and accessible. It used to be you could only get them with a prescription, and now they're available over the counter.
But not cheap if you're doing it all the time.
Yeah.
All right. Tom, thank you so much. Appreciate it. And congratulations.
Thank you, guys.
$5 billion
Take care.
valuation. That's a big deal. Thanks.
All right, coming up, we're going to continue to monitor a report saying that Ukraine launched an attack inside Russia using U.S.-supplied long-range missiles. Stock futures did sell off a little bit after that report came out. We'll have the details next.
Got 5 things to know ahead of today's opening bell. Boomer reporting now saying that Ukrainian armed forces carried out their first strike within Russian territory using U.S.-supplied long-range missiles. Dow futures dropping more than 200 points after that report. Meantime, Russian President Putin signing a revised doctrine lowering the threshold for the use of nuclear weapons. Putin saying that any conventional attack on Russia by any nation supported by a nuclear power will be considered a joint attack on his country. Back here in the U.S., Walmart now set to report at the top of the hour. The stock up 14.5% since the last report, I should say, 3 months ago. And then on the economic data front, we're going to get the latest housing start data. That's at 8:30 Eastern Time. Polled forecasters looking for a slight decline from the prior month. And reports say that DOJ antitrust officials plan to ask a judge to force Alphabet's Google to sell off its Chrome browser. That's according to multiple reports. And the judge ruled in August that Google illegally monopolized the search market. Coming up when we return, former Google chairman and CEO Eric Schmidt's going to join us right here on the Squawk set. We're coming right back after this.
living through it.
Welcome back to Squawk Box. Our next guest is a known leader in the tech industry who's going to be weighing in on so many issues, regulation under Trump, administration, and so much more. But he's got a new book out. Eric Schmidt is here, former Google chairman and CEO. His book is out today. It is called Genesis: Artificial Intelligence, Hope, and the Human Spirit. And most interestingly, it is worth noting that you have two co-authors, but one of whom is Henry Kissinger. And this was one of the last things he worked on before he passed away?
It's Dr. Kissinger's last book, and of course we miss him every day, all of us who knew him. But he got very, very concerned about the impact of AI on society. He didn't really understand AI, but he figured it out. But the biggest issue is the impact on our human dignity. How do we perceive ourselves? Are we human? Are we the dogs to the computers, or the computers under our control?
I want to get into all of that. I do want to ask you, though, a whole bunch of questions just about the here and now, if you'd indulge me. We were just talking about this report that came out last night about the potential for your former employer to be forced to push Chrome outside of Google and effectively to spin that business off or break it up. What do you think of that? And what do you think do you think there is a regulatory need to do something at Google?
Well, a lot of this has to do with the antitrust activities,
right,
which were initiated by President Trump in his first term and continued by Biden. I've never agreed with the use of antitrust to deal with the large tech companies. I think that if you want to deal with them, then regulate them, but do it in a fair way, do it in an open way, and have it apply to everybody.
So when you look at but the impact of taking Chrome out of Google, you think would be what?
Well, Chrome itself doesn't make any money. What they're referring to is the fact that the use of Chrome means much higher gross margins than shared browsers.
Right.
But again, to me, those are business decisions. I just don't agree with the government's attitude in this area.
Do you think that the whole antitrust game is going to change under Trump as it relates to Google, as it relates to Apple? There was a report out recently that they may not go after Apple anymore. I mean, do you think that there's a whole new sort of sea change here?
Well, Lena Khan, who is the executive here in the government, will clearly be leaving, and she pushed a whole bunch of new theories about how antitrust would work, which we'll see if they're proven over time. The important thing from my perspective is these antitrust efforts don't work. If you want to regulate, do it in a precise way, do it in such a way that you understand your outcomes. Don't play other games. Now, these companies, by the way, as their defender, are under enormous pressure from their employees, from lawsuits and so forth. This is just another regulatory pressure on them.
But the Department of Justice began this under the first Trump administration.
That is correct.
This is not something that's out there, and there have been other companies from Microsoft to AT&T and others who have gotten broken up over the years. I mean,
well, Microsoft was not broken up.
it had to deal with. It wasn't broken up. It had to deal with the separation of and dealing with all the terms the government placed on it.
And what happened was that set Microsoft back about 10 years.
Yeah, Bill Gates has blamed it for why.
But from my perspective, breaking up these companies is not going to fundamentally address the annoyance that you have with them. They're vertically integrated, but the fact of the matter is, I worked a lot with European Union trying to slow down their regulation. In every move they suggested, Google ultimately found other ways of being successful in business. And so it's much more subtle. The companies are vertically integrated in a way where they're actually trying to deliver an integrated experience. Mm-hmm. By taking something, I'll give you an example with Apple. There was a proposal to take the App Store away from Apple. Well, the App Store is an integral experience for the user. So it's a degradation of the user experience. Now, for what, right? You really think that people want to then download their own app store and deal with the problems of security and so forth? There have to be other solutions.
Let me bring this back to AI and maybe then connect it back to the book. But here's a question about the search business. So for a very long time at Google, search was the business. It still is 90%, and it does have a 90% market share for that business if you define search as the sort of blue link economy. The question right now is all of a sudden we're talking about AI, and we had the CEO of Perplexity on just yesterday. I'm going to be seeing Sam Altman in a couple weeks at OpenAI. Amazon is trying to build its own system. Everybody is trying to do something. And so the question is, do you define the marketplace for search as the blue link economy and what you put into your search bar today as that is the size of the market, or is the size of the search market a very different market because people are either using these other AI services and that becomes search, or even when you go to search on an Amazon or you search on Instagram or whatever, that you should think about that as a search product?
Usually when people are talking about these search issues, what they're really talking is the ads business, not the searches themselves. On the searches will go from blue links and the queries and so forth to answering the question,
right,
which has always been the goal of Google and Google's competitors. I just don't see that regulating the link placement and the other things, which is what regulators try to do, will essentially solve the problem. These products will get turned over to give you much better coaching, much better ideas, to be much better integrated. There will be issues around who is dominant there.
Right.
But remember, for the last year, there was a great deal of criticism of Google that they were late into this. Now, Google has come back with Gemini 1.5, which is really, really good. Right? So that's evidence of competition, which is a key component in an antitrust.
Do you think it will change? Meaning, do you think 5 years from now there will be a 90% market share in search, or do you think that other people will emerge?
Well, my own view is that search will change, and that the term search, you won't be searching, you'll be existing. Right? We talk in the book a lot about how human evolution will now be determined not by humans, but by human and computer. And humans, we know, are very different. They have different preferences, the way they consume information. So my own view is that you'll have lots of interesting choices at this next layer, but that they are well above the blue link economy that you talked about.
Getting back to the book and this idea of dignity, our own dignity, and us all being human,
Yeah.
and having a purpose. How concerned are you that we won't have a purpose? And that if you have a machine that you think is smarter than you, that and by the way, I think the machine is smarter than I am today, to be
It's not sentient.
perfectly blunt about it.
I don't think so.
In many ways, it's smarter than I
No,
am. It obviously,
not
I don't think it can
sentient.
think as
It
well as
has
I can
more
about certain
knowledge.
things.
Oh,
It
yeah,
has a lot more knowledge than
So
I'll ever
does a
have.
library, but that doesn't,
But what do you think about that? 5, 10 years from now.
and speak for yourself.
Humans are not going away. There's a long pattern of business efficiencies, taking the drudgery, the bad jobs, the unpleasant jobs, the dangerous jobs, and eliminating them and allow humans to do what we prefer to do, which is be creative and use our human judgment. It will take a long time for those human functions to go away, if ever. The important thing about what's happening is that if business efficiency that you're seeing from AI is replacing low-level, tedious jobs, we have an issue that those people will need a new place to work,
Right.
because human dignity involves
Do
working.
you think we'll need to make strides in neurology to ever get to that point for machines, or do you think just raw size of the data that a machine assimilates will eventually result in sentience? Because we are nowhere near understanding how you see green or feel love or the spirit of humans. We have no idea how that happens neuronally.
Well, we can build computers that can appear to have consciousness, but they don't really have it. And the reason we know that
Do we need to understand the brain before we get to that point?
we will, and I
Because I don't
personally,
know if we ever will.
we certainly are not going to do it in our lifetime.
No.
Talking about it in our lifetime, there's now a question in the AI community that seems to have bubbled up in the last month or so about whether the industry is hitting a, quote, wall in terms of just how fast the scaling capabilities are of AI. Sam Altman put out a tweet saying there is no wall. Others have said there is a wall, or at least a slowdown of some sort. What do you think is really happening?
So there's been a slope like this, which is, they're called scaling laws, which means more hardware, more data, you get these emergent behaviors, you get these incredible abilities, which you can see today from the various competitors, Gemini, OpenAI, Claude, a few others. They're really impressive. There's some evidence in the last month or two that it's getting harder and harder to get to the next tranche. My own view is that those are just adjustments in the path. That, for example, it's harder to find new data, right? Because a lot of the data has been searched. On the other hand, you have huge groups that are developing new algorithms. The pace is not slowing, but the nature of the pace may change as a result.
And then the other question I was asking, this is an enterprise question, probably for a lot of our audience. A lot of folks have taken on and used Microsoft Copilot now. And there have been a whole bunch of stories recently, and Mark Benioff has actually sort of used it to his benefit to say, you know what, all this stuff not totally ready for prime time yet. That employees say they like it to some degree, but then they often complain that they don't feel like they're getting the value out of it yet, that it's more of a party trick than it is something that's actually helping them in their day-to-day. What do you think about that?
So there's evidence that a programmer, roughly half their code is written by the programmer and half of it is written by AI. Now, if you ask the programmer, we being human,
Right.
the programmer will say, well, I wrote all of it and the computer helped. If you ask the computer, would the computer say, well, he helped me, but I really wrote it? We don't really know. The important point is this is the collaboration between the two. I would argue that that's an improvement in efficiency and productivity, which is a good thing.
So will there be a quantum or a gradual advance?
It looks so far exponential, which from your perspective means sort of gradual, like a slope. There are people who believe, I call this the San Francisco school because they're all in San Francisco at the moment, where the slope will actually accelerate, that is the quantum change that you're describing, when we invent scientists that are themselves AIs and not human. And there's a belief that that will occur within this next 3 to 5 years. And
Because
think about
we can't do it, we can't look at ourselves, we need to create something that can look at
well,
us.
a lot of these things are math.
Right.
And frankly, computers are going to get really, really good at math with these new tools. So imagine instead of having 1,000 AI scientists, you have 100,000, human scientists, you have 100,000 AI scientists. Wouldn't that be interesting? That's a belief.
Eric, I got one final one for you, and I know we got to go. Data leakage. So that's the other big issue that I think a lot of the big enterprises are worried about right now. It's actually something that is a number of the stories about Copilot at the moment, which is that, you know, everybody thinks they've siloed all of their data. And yeah, sure, on Workday or one of these systems, most people couldn't get to salaries or other information because they didn't know how to get. But if you now have a OpenAI or a Copilot or Gemini where you can just type in what you want to see, sometimes it's now unearthing and finding things internally inside the enterprise that employees are not supposed to see, or that is sort of scheduled for a certain group of people, but other. How hard is it going to be long term for businesses to actually get their data siloed in the right way?
Those are just examples of bad engineering. When Google showed up, but when we had enterprise search, we had the same concerns. Just fix it, right? These are poorly designed systems, and one of the things about AI is that it can rearrange your system. It can tell you where the vulnerabilities are. If you want to know something to worry about these models being stolen. That's what I worry about, that somebody evil or malicious will take them and use them for bad things.
The large language models.
Exactly.
What about like the ones that are open source? I mean, anybody could steal that.
Well,
if you will. It's built for stealing.
they're designed to be delivered,
Right.
but they've also been checked by the deliverer before they're made open.
Eric Schmidt, the book is called Genesis, Artificial Intelligence, Hope, and Human Spirit.
Thank you.
It's great to see you this morning. Thank you. Squawk Box coming right back after this.
Fairfaxathletics.com.
All right, welcome back, everybody. We have some breaking news from Merck this morning. Angelica Peebles joins us right now with the latest. Hi, Angelica.
Hey, Becky. Merck's saying that its injectable version of its best-selling cancer drug Keytruda looks comparable to the IV form. That's from a phase 3 trial in lung cancer. Now, the shot takes about 2 to 3 minutes to administer versus 30 minutes for the infusion, so it could be easier for patients and doctors, and it's also a way for Merck to extend sales of Keytruda. The IV form will go off patent in 2028, and that will leave Merck with a massive hole to fill. Keytruda sales were $25 billion last year, so a new form of Keytruda would be protected for longer, and a more convenient version could be more attractive for patients and doctors. So again, Merck sees a really big opportunity here, and they're planning to discuss the results with regulators ASAP. That stock up about 2% this morning, Becky.
Yeah, we're watching that right now. It looks like it's moving around, up by about $1.65. In terms of what this could mean, with Keytruda going off patent, if this holds on to it, what portion of the market they think that might be?
It's a good question, and we'll have to see exactly how it shakes out, because you have to imagine that payers are not necessarily going to want to go for the more expensive version, even if it is more convenient. So it's hard to say right now at this point how that breakdown will be. But again, Merck sees a really big opportunity to hold on to at least a portion of those sales.
I guess the other question would be, if it's injectable versus IV, can you do it yourself versus going into a hospital setting to have it done? And is that cheaper in terms of overall delivery?
You would still probably have to go into a physician's office because it's a little bit more complex than some other injectables like the GLP-1s. But again, if you could go into a doctor's office and it takes 2 to 3 minutes to inject someone with it versus sending them to an infusion center, having them sit in a chair for 30 minutes, it is a much more convenient option for patients and, again, the health system.
Okay, Angelica, thank you.
It is now just before 7 a.m. on the East Coast. You're watching Squawk Box on CNBC. I'm Andrew Ross Sorkin along with Joe Kernan and Becky Quick on a Tuesday morning. It's hard to remember these days. I want to get to this morning's big breaking news and the war in Ukraine. This morning, Russian President Vladimir Putin signing a revised doctrine that lowers the threshold for the use of nuclear weapons. Putin saying that any conventional attack on Russia by any nation supported by nuclear power will be considered a joint attack on his country. At the same time, monitoring a Bloomberg report, that's what we're looking at right now, that cites Ukrainian military officials that Ukrainian armed forces have carried out their first strike in a border region within Russian territory with U.S.-made Army tactical missile systems. Russia's defense ministry has now confirmed that report, and we're trying to see what will happen next. Take a look at futures because they are reacting to this report this morning. Dow off about 256 points, the S&P 500 off about 22 points, and the NASDAQ off about 51 points. We'll also tell you where treasuries are. You can look there at the 10-year, 4.380, the 2-year at 4.2, and then let's talk oil, gold, and maybe we should take a look at Bitcoin as well. In terms of the energy world, $68.63 if you want to buy a barrel of WTI crude. That down just a little less than 1%. And then gold, take a look at where gold stands, up just a bit, $2,632. Can we flip it around and show Bitcoin as well? Because that's actually moved up as well. Sometimes it actually moves down. You never really know what it's trying to suggest here, but
it's on a 10-year flight to quality. I think it's 230 again, almost 250.
$91,720.
All right, let's get to Contessa Brewer. She's got a look at this morning's pre-market movers. Contessa, good morning.
Morning to you. Let's start things off with shares of Google down around. We have it down about a percent on reports that DOJ is pushing Google to spin off Chrome. There you go. Okay, it's recovered some, a little more than 0.5% at this point. Continued legal troubles here for the parent company, Alphabet. A U.S. district judge already ruled in August that Google has a monopoly on its search engine, and Alphabet shares for the year we've seen up nearly 25% year to date. We'll be following that court case, see what happens. Trump media shares have dropped more than 5% pre-market after reports that it's in advanced talks to acquire crypto firm Bakkt. Trump has, of course, demonstrated growing interest in the crypto space over the last few years. He says he wants a national crypto stockpile, and the Trump family recently launched crypto platform World Liberty Financial. But look at Bakkt here. It's up almost 14% on that news, even as Trump declines. And Supermicro, by far the largest S&P pre-market gainer, up more than 24%. after announcing BDO as its auditor and submitting its compliance plan to the NASDAQ. Previous auditor, EY, resigned in October after short seller Hindenburg Research released a report flagging accounting irregularities. The chip maker still needs to file its year-end 2024 report, but look at the shares, up 17.5% right now. This is a breath of fresh air for investors who've seen this stock tumble since its 2024 highs in March. Joe?
All right, Contessa, thanks. Walmart just reported quarterly results. Courtney Reagan's here with the numbers. Good morning.
Hi, good morning. So Walmart beating on the top and bottom lines here, reporting adjusted earnings of 58 cents on revenue of $169.6 billion. That's just for a quarter. The world's largest retailer upping its full year earnings, sales, and operating income guidance with this one important quarter left for the holiday. Total gross margin also up 21 basis points from last year. Operating income up 8.2%. Both of those metrics actually were stronger in just the U.S. segment. Walmart's U.S. comparable sales coming in at 5.3%. That's beating consensus by a decent margin. General merchandise sales grew for the second quarter in a row, and this is after falling for 11 straight quarters. Now, the retailer calls out broad-based strength across merchandise categories and channels with strong transaction counts and unit volumes as well. Share gains primarily from upper income households. Walmart's U.S. net e-commerce sales up 22%, global e-commerce up 27%, advertising up 27% globally, 26% in the U.S. I spoke briefly with the CFO, John David Rainey, who added that Walmart has had 30% of customer orders paying something more to get that delivery within an hour or within 3 hours, which means e-commerce is actually getting very close to profitability. He also added that e-commerce is now 18% of total sales. That's up 300 basis points from last year. And on the consumer, Rainey said, what we're seeing right now feels very consistent with prior quarters. Consumers are spending more on food. They're buying general merchandise items, but they're also being discerning, being joyful, waiting until there's a better price point on items. On potential tariffs under the incoming administration, Rainey said about 2/3 of the items that we sell are made, grown, or assembled in the U.S., noting we've been living under a tariff environment for 7 years. Tariffs, though, are inflationary for customers, so we want to work with suppliers on our own private assortment to try to bring down prices.
The 87 bid now, 87.22. The old all-time closing high was 85.79. So that's closing in on $700 billion market cap, so all-time high for.
Quite hefty, right, for this. We still call it the world's largest retailer because by revenue it is. Obviously, e-commerce is growing. Amazon beats it in just e-commerce.
This is different because they're actually saying that they're raising guidance, and it's because of the trends they expect, not what they've seen, like we heard from Home.
Yeah, exactly.
This is maybe a little more a sign of strength. I don't know if it's a sign of strength of the U.S. consumer or a sign of strength for Walmart.
Yeah, we sort of tried to tease that out in our conversation to see what they would say, and they said, look, like the trends that we're seeing, we're feeling good. The consumer feels consistent. They do think that the macro environment has not deteriorated. They're also sort of giving themselves some credit for some things that they've done. They had those early October sales. They are seeing some sales in stronger categories. He called out earbuds, but saying, apparel sales are still on the weaker side. Obviously, weather has been an issue. No one wants to buy coats when it's, 80 degrees on Halloween. But, I think there's some puts and takes there. But yes, I think upping these three metrics going into this very important final quarter is a good thing.
Guess if the stocks you own aren't at all-time highs, you should be actually questioning what's happening, since most of the averages are pretty close. So probably not.
Although a lot of that's from the Magnificent Seven.
It is. But then the Dow, when the Dow hits new highs, it's all those 30 Dow components. Right. Thanks, Courtney.
Thanks.
All right, coming up, Martha Stewart just out with her 100th book. She'll join us straight ahead. Squawk Box. Be right back.
make money.
Welcome back to Squawk. A news alert on Robinhood, the trading platform announcing it is buying Trade PMR. It's a portfolio management platform that is for registered investment advisors. Trade PMR has over $40 billion under management, serves roughly about 350 firms right now. The acquisition allowing Robinhood to offer investment advisory services to its customers. Just another example, as we've been watching Robinhood really expand from what was just an app into a much more fully featured company that has all sorts of different services. When we come back, a lot more on Squawk. Aperture investor, CEO Peter Krause, he's going to be with us. The market's reaction to Ukraine hitting Russia, U.S.-made missiles, we're watching it. We'll talk to him about that and so much more. Russia's state media now saying that anti-missile systems down 5 out of 6 missiles, and debris from one missile fell on the territory of a military facility. We'll bring you more details as we get them this morning, as this breaking news continues right here on Squawk Box.
All right, welcome back, everybody. Markets this morning reacting to Ukraine hitting inside Russian territory with U.S.-supplied missiles. And joining us right now to talk about the market's reaction, but also the bigger forces moving the markets right now, is Peter Krause. He's the chairman and CEO of Aperture Investors. And Peter, the immediate reaction this morning is a muted one. We're continuing to watch geopolitical events. We did see futures drop. It's not a massive move, maybe down a little over 0.5 percentage point for the Dow. It's just part of the continuing issue. Probably the bigger forces moving the markets right now are the Trump election and the new administration coming in, and then what the Fed does as a reaction to the economy. How do you add this all up? Because when we started the year, you had a pretty optimistic outlook. You changed it in July to say you were a little more concerned about some of the things that could be happening. How do you feel right now?
Well, it's a little uncertain, I think, and I think the market's reflecting that. Volatility since the election, inside the market, the volatility has actually increased reasonably significantly between different stocks and bonds. And the market itself has been kind of listless, not really directional.
That first week, there was a pretty big
up
move in the market.
5%, but then down 2%. So that's sort of the part of the volatility. I think there is uncertainty here. We don't really know what the administration is going to do with tariffs. We don't know what they're going to do on immigration. We don't know what they're going to do on taxes. We know what the broad headlines are. We don't know exactly what's going to impact the different parts of the economy, and people are going to allocate capital and make big investments. I think we will grow. I think there will be growth here. I think 18 months, 2 years, we'll see significant injection of capital into the economy. Manufacturing is relatively low. Destocking has been taking place over the last 2 years. We should see restocking. We should see growth. But I think people are going to wait, and investors are going to watch, but CEOs are going to wait to see how this clears up before they start committing capital.
I guess the other question then is, if we see growth, is that growth strong enough that how the Fed plays into some of this too? This has been a huge win where we've had a pretty strong economy. Companies have been able to continue to deliver on the bottom line, and it's all happening while the Fed's moving to move interest rates lower, and that's a pretty hard force to change.
Yeah, I think the Fed is going to continue to lower rates, but at a slower pace. I think the short rates are probably still too elevated for a normal environment. So you'll probably see 25 basis points in December, and next year probably 25 to 50 basis points. But I don't think, unless the economy gets really hot and inflation comes back in force, I don't think that the Fed's going to reverse that.
Okay.
And I don't think the Fed's going to drive rates down to some lower level unless there's recession.
So if you have that massive deregulation and lower taxes, which we don't know exactly what the taxes are going to look like, but I think it's a safe bet that taxes will be lower than they would have been under the Harris administration, and probably than where they are.
I think you'll have growth.
Yeah.
So I think you'll have growth, and I think you'll have the market will do reasonably well. I think companies' earnings will do well. I think the interest-sensitive assets will struggle a bit because the rates are not going to come down that much. So, private equity, real estate, things like that are sensitive to levels of interest rates will have to not struggle, but figure out how to restructure themselves in that environment.
What's that mean for housing, which has been a big issue?
I think people's incomes will grow. I think that they'll be able to afford at least to fix their houses and change things. So you'll see housing-related stocks or stocks that affect improvements in housing do reasonably well. How it's going to affect home builders, that's a little bit of a challenge because interest rates again are very sensitive to those kinds of activities, and I think that falls sort of in the real estate camp. It'll probably be more challenging for that to grow.
One of the real areas of uncertainty is probably in the medical arena, not just pharmaceutical companies, but any of the insurers, any of the hospitals, any of these companies could be facing some pretty significant changes. It's hard to argue that things aren't broken in some of the arenas there.
Well, it's been broken for many years.
Yeah.
The question is, on the margin, how will it get fixed and changed? And I think the whole question about the delivery process for medicines is going to be questioned. We don't know how the next administration is going to deal with vaccines. So, there are questions out there that have to get resolved, and that probably retards early on any commitment of capital and growth in those parts of the market, but it will get clarified. And then, I think, we're going to see general growth even in that space.
What's your biggest takeaway, or something you would tell investors, something you're watching out for right now?
I don't think the market's going to go down here. I mean, I forget 5-10%. I don't mean that. I think the market's going to grow. I think equities will actually do well for the next 18 months to 2 years. Bonds are not going to be, duration's not going to be cheap. And I don't think the long end of the curve is going to get a lot more attractive. I think the 5-year and the 10-year will be where it is or higher.
regardless of what the Fed does, because
Regardless of what the Fed does, yeah, exactly. And look, growth on top of where we are in inflation is probably going to keep inflation where it is to slightly higher. So if inflation gets 2.5 to 3, and you want a real rate of interest, that's 4.5, 10-year, maybe even 5, and that's what we should expect. And so if you're thinking that you're going to run your business with a 4% or 3.5% 10-year, not unless there's a recession.
Peter, thank you. Peter Krause.
All right, coming up next, Oklahoma Republican Senator and President-elect Trump supporter Mark Wayne Mullen will join us, and then author, entrepreneur, and entertainer Martha Stewart will join us to discuss the launch of her new book and much more. Sparkbox will be right back. The Trump team search for a prospective Treasury Secretary continues. Joining us now with his thoughts on who would make the ideal candidate, Oklahoma Senator and Trump supporter Mark Wayne Mullen. Senator, once again, it's good to have you on this morning.
Thanks for having me on, Joe.
Earlier, we were actually talking about this, and it's something interesting came to mind, and that is we know how much the president likes rising stock prices, and sometimes it appears that a measure of how well he thinks he's doing depends on the stock market. And we said, so, okay, that's an important component for Treasury Secretary, someone that can deliver that. Also, the president wants someone on board with his economic plans, which include tariffs. And our point was, wow, that is a difficult line to toe, if you will, to try to be fully behind him on tariffs and yet be able to do all that he can or he or she can to raise stock prices. Is that incongruous?
Well, Joe, one thing we know is the president knows business. He's been very successful in business. He's been very successful in running campaigns. He knows how to surround himself with the right people. And I wouldn't say that the president loves tariffs. What he loves is free trade. He loves access to markets. And what he has said multiple times about the tariffs is he's tired of selling out America. We need to be on an even playing field. People shouldn't just have access to us and us not access to them. And if they want to have free trade, meaning that we have complete access to their markets and they have the same access to us, then we're talking about having no tariffs. If you want to have just access to us and not give us access to you, your market, your population base, then we're going to even the playing field by the tariffs. And I don't think that's a hard market to sell. I think that is just putting America first. And that's what the president has talked about. Quit letting people take advantage of America. And people are sick of it. We saw that. That's why the American people overwhelmingly voted for President Trump in a way that I think none of us predicted.
Do you have a preference? And do you have any, something that we don't know? Do you know anything we don't know about who's in the pole position to finally?
Well, obviously there's a lot of names being floated around, but I would say there's been a lot of names floated for a lot of these positions, and then someone else comes out that the president wasn't really leaking, wasn't letting known that he was even paying attention to. The president's going to make his own decision, regardless of what the transition team says, regardless of who they vet. At the end of the day, the president will take the recommendation, but then he's going to make his own choice. And so we've all heard the names that have been floated, but none of us actually know who's going to be there at the end of the day.
Senator, we've heard in many different variations of, this transition team is going to do different things than what happened the last time that President-elect Trump was president. And that includes people have attributed, maybe loyalists rather than some of the things that happened last. Jeff Sessions, I've mentioned a lot. The president definitely wants to make sure he doesn't get into a position where he has someone that goes totally off the reservation with what he does. And you remember what happened with Jeff Sessions. He recused himself from the whole Russia thing. So that might explain a lot of things, and I know you have said you've been asked at least 24 times about the president's pick, president-elect's pick for Attorney General Matt Gaetz. But how do you really explain it? Because the amount of political capital that we're seeing expended here, and just an objective, even if you're on the president's side, and even if you are willing to give him the benefit of the doubt, that is a glaringly controversial pick for a lot of people.
Well, there's no doubt and no question, Matt Gaetz and I have had our differences. They've been very public. However, I respect the president and I respect his ability to put good people around him. One thing we have here is we have an incoming president that's been there and done the job for 4 years. He knows exactly what he's looking for. And so you have to trust that decision making as he moves forward. It's not like he's brand new. He's the 45th president. Now he's the 47th president. He did an excellent job as a 45th. He comes into this 47th with a tremendous amount of experience. He knows what his team has to get done. He knows where he's going, and he only has 4 years to do it. So regardless of the differences that Matt Gaetz and I have to set those to the side a little bit, and I have to do my job, my constitutional duty on Article 2, Section 2, where it says that I have to advise and consent. That means I have to have oversight, and we'll do that with every one of these picks, and we're going to do it in a very quick fashion because the president wants to get to work, and Congress wants to deliver the mandate that the American people gave us.
I think if we knew for sure that would happen, we'd probably feel better. Because I mean, you've seen. I think you've reported that you saw some of the behavior that people are raising an eyebrow. You're familiar with it, so he probably wouldn't be. You wouldn't be, and you're saying, well, we at least need to give him consideration. Will that include a full vetting from the Senate, or if it was a recess appointment, it will? Because if it was a recess appointment, or if it was some other thing that the president is floating, I saw about a way of subverting it that could get him in for 201 days or something. Would you be okay if that's the way that Matt Gaetz ended up as Attorney General?
Joe, keep in mind that's very tough. The recess appointments have been talked about a lot, and I'm not saying that's out of question, but I'm saying that's a very difficult road to go through. Remember, President Obama tried to do this in 2014. We took him to court. The Canada decision of 2014 actually overturned that. So Congress has to have it's a very narrow window. When we decide to recess, it's not debatable, but it is amendable, and that means that both chambers have to agree, and both chambers can really muck that up. So it's very difficult to actually get there. And then if you do get there, you got to recess for 10 days, and then the appointment is temporary to begin with. It's only for maximum 2 years or until the next Congress starts, as you just mentioned. And so the person still has to go through that confirmation period, even if they are appointed under recess. And that, I'm going to say that is tough. Now, the president, under Article 2, Section 3, which has never been invoked, could put us into recess if Congress can't agree, and he can set the amount of days that we're there. But once again, that is the last option. Our job right now, and what we're focused on, Congress and the Senate, is to deliver these appointments as fast as possible and do our due diligence to look at everybody with a mandate of oversight, and we will do that regardless of my personal opinion with Matt Gaetz. I will look at his appointment just like I will everyone else's.
Senator, can you do your job, your oversight, and really look into this if you don't have the investigation results from the House Ethics Committee on?
I believe we will probably get that. Yeah, and Becky, I believe we probably will get that. I think that's part of the oversight. Now, if we get that in a secure setting to where we have to go down the SCIF and read it, that's okay too. I'm not saying that the report has to be made public. I think that's part of the oversight, that the Senate should have access to that, though.
We've already heard from the lawyer, from some of the people who did testify to the House Ethics Committee, that he had a client who testified that she had not only seen him pay for sex with women, but also engage in sex with a 17-year-old woman at a drug-fueled party. Is that something that concerns you?
Well, if it is true, and I mean it, I got to say that, if that is true. Now, what I've said about Matt Gaetz is 100% true. Every word that I've said was accurate. But as I will say, we'll go through this process like we should. And if that is in the report, then that is going to be very problematic to move forward. There's no question Matt's going to have an uphill battle. And it's going to be a really difficult fight to get him confirmed, but I'm not saying it's impossible. And if it's what the president wants, then we're going to do our due diligence. As I said, we're going to advise and consent with our constitutional authority to do the oversight that we have to do.
Senator, let me ask you a different question. Taking your own opinions about this off the table, and even maybe taking some of the details of this report, which we don't fully know about, off the table. In corporate America, and so much of corporate America is watching this broadcast, us talking right now, if somebody, an employee, were to show another employee on a phone naked pictures of somebody that they're interacting with, in many companies, that unto itself would be grounds for firing. Meaning, if you were to call the HR department of most companies in the Fortune 500, that would be the end. There wouldn't be a conversation about it after that. How do you think about that versus the circumstance that you're being tasked with today? And do you think that corporate America is wrong to have those policies in place?
Well, Andrew, I have to look at this in a different manner, right? His constituents is who elected him, and his constituents knew exactly what it is, so they rehired him. Now, if we're going back and we're going to start talking about scrutiny of different people that have been put in positions or been appointed by presidents, we have to go back and scrutinize the appointments that President Biden put in place too. We can talk about Rachel, Assistant Secretary of HHS. There's pretty controversial questions to figuring out what pronoun's going to be used. We can talk about Sam, the guy who was in the Department of Energy, who couldn't figure out if that was his luggage or not and kept stealing people's luggage. You can talk about Pete Buttigieg and the controversial decision to put him in Department of Transportation. So if you're going to scrutinize, you can go through a lot of appointments, through a lot of presidency, and you can find a lot of reasons to scrutinize different appointments. Our job is to do oversight, and we will do that. If the president has picked Matt Gaetz to be over DOJ, then we're going to do our due diligence and understand what the president is wanting there. And so we're going to treat this appointment like the Senate has treated every other appointment from every other president.
Senator, I think the president, swept 7 states and, won the popular vote. And we saw that he probably, especially with everything he went through, he probably is in a position where he feels he can do what he wants, and he probably wants loyalists. But is there some 3D chess that we don't understand, that if there is a sacrificial lamb, let's say it was Matt Gaetz, that then maybe some of his other appointments that are somewhat controversial would be easier at that point? Is that in the back of his mind what's going on here, do you think?
I don't believe so. I think the president wants a hammer at the DOJ, and he sees Matt Gaetz as a hammer and all these other appointments. He's very confident in where they're at and can deliver the administration that he's wanting. His picks have been maybe unconventional, but we hired an unconventional president, and the American people wanted that. They don't want politics as usual. They want someone that's going to shake up Washington, D.C., and President Trump proved he could do that in 2016, and we had great results with the economy that followed. The American people saw what happened underneath the Biden administration, and it went to I'm going to use good words here. It went to heck in a handbasket, and then we see where the American people said, we're tired of that. We want something different. So the American people want it to be shook up, and the president is maybe using some picks for these positions that's not conventional, but it's what the American people wanted.
Okay, Senator, thank you and now it's 24, and so now it's 25 times at least that you've answered those questions. I appreciate you doing it for us this morning.
Joe, thank you. Thanks for having me on.
Okay, welcome. Thanks.
Auntie.
Coming up, author and entrepreneur Martha Stewart is going to be with us to celebrate the release of her 100th book. We'll be talking to Martha in just a moment. In the meantime, take a look at the futures. We got some red on the screen. 231 points off on the Dow. NASDAQ down about 37 points. S&P 500 off about 16 points as some new geopolitical issues have emerged overnight between Ukraine and Russia. We'll talk about that as well. Squawk Box coming right back. Back to Squawk Box. Martha Stewart is out with her 100th book. It is titled Martha, the Cookbook, a compilation of 100 of her favorite recipes. Joining us right now, live from Bedford, is Martha Stewart, founder of Martha Stewart Living on Media. Martha, it is great to see you, and congratulations, 100 books.
Yeah,
Can you remember all of them?
I have to catch up to Danielle Steele. She's done 200.
How different do you think it is when you think about when you wrote the first one and today, just given the age of social media, even the role of books in our world today, how different really is it?
It's a very different world. You can access recipes online so easily nowadays. It's just an incredibly different thing. But books still, I like books. I think so many people in the kitchen like cookbooks. They like to hold the book, they like to open it on the counter. And this book is a very usable, workable book. And people are responding very favorably. We were in Charleston over the weekend, and 1,200 people came to Gaillard Hall and held up their books. It was quite amazing and quite nice to see that kind of interest in the printed word.
But we're agreeing this is not the last book. I know we're celebrating 100, but it's not like the 100th and the final.
Oh gosh, no. The 101st is already done. It's almost at the printer, and that is a gardening handbook, which is beautiful. And then I'm already working on my autobiography, and I'm working on a book about my houses, and a book about gardening, vegetable gardening, organically, and many more, I hope. I like to write. It's a nice thing to do.
Well, talking about your autobiography, let's talk about the film version of that, because a lot of us have been watching you on Netflix, and I'm so curious what you actually think about this documentary. I've read some of the things you've said, but now that I have an opportunity to actually talk to you about it and have watched it myself, what's your true takeaway?
What did you think?
I liked it. I know that you don't like certain parts of it, and I get that. I totally get that. But I thought in the end that I felt like I walked away loving you even more, to be honest with you. So I didn't think even the parts that you probably, I could feel the speed bumps for you. I knew where you were probably like, I don't love that. But
it's turned out to be much better than I thought. It was a slightly painful process to open up as I did to R.J. Cutler. And it was, and it's the time of life to do that, though. I mean, it's about time I spoke out a little bit about my personal life. But the response of, especially of young people, young women, love it. They love it. I think it's giving them some strength. It's giving them some energy. It's giving them a way to think about their future. And that makes me very happy. There's still more to tell, and that's the documentary, and possibly a Martha 2 documentary. That would be fun to do. And I'm very excited that my life has taken this turn where people are actually responding to a woman's story.
Right. How much do you think your opinion has changed because of the reaction? So I think one of the things that's so interesting oftentimes is people read a book about themselves or watch a film about themselves by themselves before it's out to the public. And they feel every speed bump, they think it's terrible. Invariably, you think it's terrible. And then it gets out in the wild, and you get calls from all sorts of people saying, Martha, isn't that great? And then, right?
Well, my friend Joel Silver, the movie director and producer, he called me screaming, how did I let that happen? It was the most horrible thing he ever saw. And I love that about him. He is so outspoken. And then somebody else, Ryan Murphy, called. He said he loved it. So everybody has an opinion, and I love that they have opinions about it. And I listen very carefully, because next time, Martha 2, if there ever is one, will be even better and probably more interesting and more helpful to the viewer than this one.
Would it be a different team that did Martha 2?
Oh, I don't know yet.
Okay, just thinking about.
I think so. I like different music. I'm an editor, really and truly, and you never saw a repetition in my magazine, so I wouldn't want to repeat. We use a different photographer every year for 4th of July, for example. A repetition is not my thing.
Martha, did you see SNL this weekend?
I did. I thought it was hysterical.
You know where I'm going with this.
I'm glad you brought it up. Can I straighten out one piece of journalism?
This is the whole brat thing for those folks who don't really know. I can read it to everybody if they don't know what we're talking about. Or you want to explain it, Martha?
Well, no, there was a lovely performer who was trying to explain the word brat, B-R-A-T, which is it's sort of a social term now to somebody who's real cool. And she first says, I'm cool because I was happy that Andrea Pizer, who is a journalist for the New York Post, I say in the movie, and I don't mention her name, right? You didn't hear her name in the movie.
Right.
I mentioned that she's dead, and I was happy that she was dead. Well, I wasn't talking about Andrea Pizer, by the way. And for why Andrea Pizer thinks it was her, I have no idea. But it was a little bit of sloppy fact-checking on the part of my team on the documentary. It was Constance L. Hayes, who is an equally divisive and very dangerous journalist at the New York Times at the time of my trial.
Oh my goodness, Martha! Do you know, Martha? I used to sit across from Connie Hayes. Do you know that? You wouldn't know
she
that.
died, right?
I know she passed away from cancer.
And I'm sorry for her family. I'm sorry for her family, but I did not like Constance Hayes, and I did not like what she did to me every single day. I had to read that.
Right.
It was horrible. and not very accurate and not very true and not very nice. And Andrea Pfizer wrote the same crap that she always writes, but I wasn't talking about Andrea Pfizer, and she should get off her high horse and not think that I was thinking about her for the last 15 years.
Martha, we were looking at home. Good to see you. We were looking at home through the for the recipes, and I'm just wondering, do you have we want to do some of them, and then I was thinking, let's say Snoop has a certain predilection for wanting something really sweet, or I don't know, something he'd really like. Were there any really good recipes in there for someone that might like that? I would like something like
infused is what he's talking about. Infusions.
Infusion.
The apple crumb pie for Thanksgiving is a must. And use as many different kinds of apples as you can. It really changes the texture and the taste of the apple pie.
Wait, can you top it with gummies, Martha?
No,
That's where I think Joe is going.
No, this is after you've already, and then you get
after you've already partake, and then you can have the pie.
Yeah, the entire. You know what? The whole book looked good for that. Actually, I'm gonna work an apple.
Turkey. Don't forget the parchment turkey. That's a new recipe. It sort of takes the place of my cheesecloth turkey, but it is the turkey comes out so deliciously. So if you're looking for a new turkey recipe, try that one.
And you won't blow the house up or get covered in like grease. I'm scared of doing those other things with the turkey. This is a safe way to.
It's the cleanest way I've ever cooked a turkey. It's really
is it parchment wrapped instead of foil?
Yeah, you wrap it after you stuff the turkey and butter it nicely. Then you wrap it in big sheets of parchment paper. You can use a staple gun or the bulldog clips from your desk, and roast it in the parchment. And then about a half hour before it's finished, you unwrap it, and it gets this beautiful, beautiful mahogany brown color. It's fabulous.
And that's the alternative to using foil, because now we have all these questions about wrapping.
Oh, no
stuff
foil.
in
I never cook with foil. But
I'm a new convert.
Cheesecloth is very good. You don't have to wrap your food in foil.
Perfect.
Martha Stewart on her 100th book. It is great to see you again, and we hope to see you in person soon. Thanks, Martha. Happy Thanksgiving.
Thanks so much. And your program is so good this morning.
Thank you. Thank you.
All right, when we come back, we've got some new reports that the Justice Department will ask a judge to force Alphabet's Google to sell off its Chrome internet browser. But will it happen? Former U.S. Chief Technology Officer Anish Chopra will join us to discuss. All right, welcome back to Squawk Box, everybody. Private equity giant Blackstone is in talks to buy Jersey Mike's in a deal that would value the sandwich chain at about $8 billion. The Wall Street Journal reports that Blackstone had been in talks earlier this year. It's the nation's second largest sub-style sandwich company by sales, behind only Subway. It's got more than 3,000 locations. Joe?
All right, coming up, former U.S. Chief Technology Officer Anish Chopra will join us to discuss Google and the DOJ. And Roblox making a number of changes, giving parents more power to protect children on online and in-game. CEO David Baszucki will join us to discuss. We're coming right back. The DOJ is reportedly going to ask a federal judge to force Alphabet's sale of Chrome in an antitrust crackdown. Joining us now, Anish Chopra, the White House Chief Technology Officer under President Obama. He's currently the Chief Strategy Officer at Arcadia, and you've got some guidelines for what would perhaps be a good remedy. Does this fall into that? As far as your opinion goes, you say remedy should be surgical and tie back to the harms. Does this work? Is this a good solution?
Well, we got to see the details, but I would say in general, what we want to understand is if the harm is that Google is behaving in an anti-competitive manner because of its exceptional search product, then you have to ask what it is that we can do to mitigate the harms caused by a reduction in competition. The provision that maybe didn't get as much attention but might actually be the sort of sleeper opportunity is that Google would open up access to its search technology through licensing agreements to third parties. This could be the most important part of the agreement. The Chrome browser obviously does allow for Google to personalize the search results because it follows us wherever we go on the internet. So decoupling that will reduce some of that personalization. But if there is this opportunity for competitors, new entrants to access that historical technology that is obviously dominating the way we search the internet today, then it might mean that more value-added services could come out to make that more competitive market what the regulators are asking for. It also might create some unintended consequences, which we should probably cover. So I don't want to give you a straight yes, no. I want to suggest to you context that there's potentially some good on the opening of the data and the licensing, and there may be some harm if the folks who come in on the other side end up being worse on privacy and worse on behaving in a way that our currently unregulated commercial internet market operates.
You say that maybe the best thing would be enabling customer control over the ad network. Does this do anything for that?
Well, that's what part of the issue is today. In order to access the search experience that we like, we sort of have to go through the gauntlet of the engine that takes all of our personal data and monetizes us as we go through the internet. So now if you could separate out the current way we access search, and there's now a new competitive market, there could be options. Someone could argue that I'll be a one to give you access to the great search results at Google, but I will not take all of your data and harvest it for purposes of personalized ads. And that may be a better product for some of us that want more confidence that our privacy is preserved. And so that competition will create options. For others, hey, you know what? I love the personalized ads. I'd rather have that. It might actually introduce me to something I hadn't seen before. You and I might have different opinions about what privacy means for us, and this gives us choices. So that idea of consumer control is that there'll be many front doors to access the Google search experience, and that could be a net positive to the American people.
Is this, with AI and everything else, it almost feels like yesterday's battle or something. Is it even going to be necessary at this? I mean, we may be doing something totally different. We're going to make sure MySpace is, not a monopoly.
Well, actually, this could be an accelerant to an AI future. So today, you and I search by ourselves. We physically do the searching. Very soon, we'll be using AI agents that will search on our behalf, knowing us in a more personalized way. So it could be that the API access to Google search is actually going to be a rocket fuel for competitive AI products. That may be the biggest issue. If I were an investor in Google, my biggest concern would be today, Gemini probably has an advantage on being able to access this incredible search capability. So all else being equal, I might pursue the Gemini AI product. But look at all the new technologies that have come forward, OpenAI, Anthropic, Perplexity. And now if they could access the Google Search API, I might get the same experience, but actually a better result because they might incorporate features that are more beneficial to me. So in many ways, this could be the catapult for an AI future where we delegate to agents the responsibility of searching.
Let me ask you a different question. Then how do you deal, for example, with email? So I would tell you Google has my email. I actually think that the email is probably more valuable. I don't even personally allow them to save the search. Not everyone allows to save the search by default. And search results from even a year ago are probably less relevant to the actual system. It's probably just the last sort of 2 weeks of search that might actually have some great relevance to what you're doing here. So how do you think about all the other data that companies have? How do you think about Outlook that Microsoft may have, for example, then?
Yeah, we will be asked to opt in on a whole range of services where, back to this idea of agentic AI, if we want an agent we trust to compete in a trust market, then that agent will be authorized to have access to our sensitive information. So here's to your point. If you look at this, of course, this ruling didn't affect Gmail specifically, so let me lift up more broadly. If we believe that we want to give consumers control over how we log into different systems, whatever those systems are, Salesforce in the enterprise, or take your pick on the consumer side, travel, etc. Well, the question is, at the moment, it's unclear, can I delegate an agent to interact with my personal services on my behalf? And is that going to be an open and competitive market, or am I going to be forced to use the agents at each vertical silo? I don't think we've received any kind of regulatory or market feedback yet.
There's going to be a security issue, Anish. There's going to be a security issue. This idea that somehow the agent is going to be able to pull from 100 different places, that scares people. It's why people like the Apple phone. It's all in one place and it's all controlled by one company. And I know some people think that that's too much control, but on the flip side, if all of a sudden you have AI agents crossing from one data pool to another data pool to another data pool to another data pool, and somehow information comes out of that that's not supposed to come out of that, that's actually a much bigger problem, I would argue to you, than this competitive issue you're describing.
Yeah, and that's why, if you recall, we've talked in the past, having the industry self-regulate on key questions about what it is that those agents can or cannot do with our data and what control panels, knobs and dials we have to manage that is critical, because we could go without guardrails. It could be a scenario where we be attracted to the honey of a new product or service, but the unintended consequences, it's done all this harm to us in terms of our privacy and security go hand in hand. For lack of a better term, a Chinese app that is trying to embed low-cost prices, but in exchange harvests all this information to do harm. This is an issue that we have to grapple with. What's separate from today's ruling, or the argument that the Justice Department's making, but broadly, we need to have more stakeholders involved in setting the rules of the road. This is going to run much faster than a government agency can regulate, and left to its own devices, we may have people take a little bit of a shortcut approach. So what you said, Andrew, is the harm is my number one concern at the moment, and that's why we need a place for industry consensus.
Very good. Anish, thank you. Good to have you on this morning.
Thanks for having me.
Okay. Stock futures this morning have been weak, and they did pull back after some news. Russia's Ministry of Defense saying Ukraine struck a facility inside its borders with American-made longer range missiles. That came days after the U.S. gave Ukraine its approval to use the weapons. And in a separate development, Russian President Vladimir Putin formally lowered the threshold for his country's use of nuclear weapons. Joining us now on the markets, Mark Spitznagel, founder and chief investment officer of the hedge fund Universa Investments, has more than $17 billion in assets under management. And one of the things, and it's good to have you on, great to have you in. You do deal in the possibility of black swan events. I guess so we ratcheted it up a little bit this morning, or not to worry?
I mean, we don't really look to short-term, fluctuations too much, but I do think we're at a time that we need to start to worry a little bit. It's been a little uncharacteristic. May have been a little more, in fact, a lot more bullish for the last 2 years, because I think we're sort of in this Goldilocks zone right now. I kind of feel like we'll remain in it a little bit more. I think we're going to look for a little more euphoria. But I think that we're still part of this boom bust cycle, and I think that that's kind of an inevitable thing that we're in.
But next year, maybe not so much.
Yeah, exactly. I mean, I think we have to, lag effects are important in this business, and I think it's easy for us to forget that, and it's kind of the reason, lag effects are the reason Bernanke, for instance, got so blindsided at the GFC. And what Goldilocks zones are the sort of when you're in this immediate effect, positive environment, and it's sort of overlapping lag effects that are kind of coming. So I think that's where we are right now.
Go ahead.
The boom and bust effect, is that ever since the COVID pandemic when things went down, or are you talking about broader boom and bust?
Definitely broader. I mean, I think that ultimately boom and bust cycles are caused by monetary policy. And we can't put the genie back in the bottle from what really started at the GFC. I really think that's what's driving everything ultimately.
All the other things that we talked about won't be what gets us, though. It'll be another mistake in monetary policy, in your view?
Yeah, so I mean, I think that, I think that ultimately what happened in 22, I thought that was an enormous mistake. When people thought that, we were in the 70s, that was kind of their investment thesis, and I thought that was just profoundly wrong, simply because of the leverage. We have the largest credit bubble, I would argue, in human history, and you can't just tighten into that. I don't think we're ever going to see another truly run-of-the-mill sort of, a business cycle again. So yeah, that was a mistake. But of course, the real mistake was what happened, 15 years earlier today. So yeah, I mean, ultimately, I think these are the problems. These are the mistakes that have happened. I think truly the Fed is behind the curve right now. Even though I hate looking like a Fed apologist. You'll never find someone who's more anti-Fed. I mean, and the Fed would be something that I would be in favor of. You'll never find a more negative person on the Fed than myself.
Who should be controlling monetary policy if it's not the Fed, not the president, I guess, do you think? I mean, how should we do it? Because there are people that point out, we haven't always had the Fed, and there are those that it's almost a religion, Fed independence, but you're just giving, there's a lot of people who could screw up monetary policy. It could be the Fed, could be the president, could be Congress. Is this the best way to do it, or should it be rule-based?
To me, I'm more of a purist on this. I think it sort of begs the question, well, why should there be monetary policy?
Yeah.
We all agree in free markets, price discovery of things. Why shouldn't that be the case for interest rates as well? I think we kind of need to figure that out first. I think we're better off, when we set interest rates. Why should a bureaucracy, a bureaucrat in Washington, to tell us what interest rates should be? It creates distortions in the market ultimately.
Right. But then there's times where we thank the Fed for saving our bacon, right? No?
Well, of course, that's the thing. But then it creates these other problems. It creates moral hazard. We know all these problems. And the other thing is, this is typical of government policy. The effects tend to come later. So we create these sort of Pyrrhic victories, and it's easy to forget who caused the real problems. This is really what governments do.
You sell your products from the goat farm, like the goat cheese, right? But do you like the goats? Because I've been to places where there are dwarf goats, and I could stay my whole family could stay all day. There's something about the serenity of animals I think that's why there's rescue animals. Do you like your goats, or you just use
That was a heck of a segue, right?
Yeah.
Do you use your goats?
I totally.
These are in the notes, but you still have the goat farm, right?
Yeah, of course.
Is it just to sell goat cheese, or do you love the goats? Do you love your goats?
I mean, we could go on and on. It's more than that. We do regenerative pasture management. It's much more than that. But the goats are cool. Goats are awesome.
That's what I'm talking about. I have been there. We go every year out to this place in the desert, and we spend hours sitting next to. They pee all over the place, but they're so docile and so affectionate. I guess it's all animals. I got 4 dogs, so maybe that's what it is. But I thought I'd ask you that. Are these are full-size goats, so they're not?
Yeah, we have French Alpine goats mostly.
French Alpine goats.
Yeah.
You know anything about goats, Sorkin?
I know very little about goats. I'm not a goat expert. I'm glad to be on the set with
If I say
expert.
goat to you, you're thinking like Tom Brady or something like that, right? Right?
Jordan usually. Michael.
Okay.
Yeah. Maybe Serena Williams. I don't know.
I'll warn you next time.
No, that's good. Good. Yeah.
Thank you.
Okay, coming up, we will talk to some more goats. We're going to talk more about some real important news that's actually happening right now that's actually impacting the markets and potentially the world. A report that Ukraine is striking inside of Russia, with former Deputy Assistant Secretary of Defense Rich Colby is going to join us next to break down what is happening and where this all heads next. We're coming right back.
right, take a look at the futures right now. You're going to see Dow futures under pressure, down by about 210 points. We've been there through most of the show this morning. A lot of that because of what's been happening in Ukraine.
Yep, we told you a few minutes ago about Ukraine striking inside Russia with U.S.-supplied longer range missiles. Also, Russian President Vladimir Putin formally lowering the threshold for his country's use of nuclear weapons. Joining us now on this is Elbridge Colby, former Deputy Assistant Secretary of Defense. I guess, Bridge, good to see you. We'll start with these comments from Putin. To be expected, given that the Biden administration okayed the use of these, is this, the response that you would have? It's not necessarily a huge escalation, I would hope, from Putin, but just kind of a quid pro quo for that move.
Well, good to be with you, Joe. I think the lowering of the threshold by Putin has been in train for some time. It is quite significant. Suggests that the Russians may use nuclear weapons in a broader array of circumstances. It's not a dramatic lowering, but material. But, Joe, I would see Russia's response. What Putin himself has said in the past is there could be horizontal steps, for instance, aid to the Houthis, to North Korea, to China, to Iran itself. So, and we'll see if there's further responses by Russia. There's also reports that there may be further sabotage in the North Sea, for instance. So I think that's the kind of thing we would expect.
So even though they use, the threat of perhaps a nuclear escalation, that's not really what he meant. He'll accomplish it through more conventional means that it almost sounds like an Iran proxy or something.
Well, there's that, but also, Joe, I think this is something to underline is how badly the situation is going. The Deputy National Security Advisor to President Biden said yesterday that the situation for Ukraine is extremely difficult. This is after 3 years of the Biden administration policy, and that Russia is continually upping the ante. And so I see the Biden administration's decision here, which is bizarre and I think inappropriate given it's in the transition period. The American people elected President Trump on a very different policy platform. It's kind of like a reductio ad absurdum of the Biden administration policy, because the New York Times is reporting that the Biden administration doesn't even think it's going to make a big difference, that neither the Ukrainians nor we ourselves have sufficient ATACMS in the inventory to really make a difference. And, the FT's reporting and other sources this morning that the Ukrainians have used it. The Russians have already moved a lot of their forces. They've adapted to this possibility. They're claiming they've shot down several of the ATACMS. We don't know. I'm not saying it's nothing, but it's a significant escalation on our part where we don't really think it's going to make a difference. And so it's, I think, a real, as I said, expression of the Biden administration's kind of symbolism over effectiveness policy that I think President Trump, we need to come in as soon as possible to deliver good results for the American people and, frankly, our allies.
What was the rationale then, do you think, that we're still, it's almost like a last gasp for sort of an all-in for Ukraine from this administration, just to contrast it?
It's not even all-in. It's not even, it honestly doesn't make a lot of sense.
Symbolically, that's what they're saying. We're still helping Ukraine. Wait till Trump gets in here and pulls the rug out from Ukraine.
Yeah, they tied it to the North Korean troops, but I don't see how that makes a big difference. It's not really tied to that. It doesn't make a ton of sense. Frankly, I think the best explanation is peer pressure from the Europeans. I mean, you've seen the Secretary General, other European leaders talk about this. My own view is put your money where your mouth is. I mean, the Secretary General of NATO, he was Prime Minister of the Netherlands while was spending next to nothing on defense for 10 years. And if the Europeans think the situation is so severe, let's put their money where their mouth is. The American people, as President Trump has pointed out, have spent a tremendous amount of money in weapons, and despite a lot of rhetoric, the Europeans aren't doing it. In fact, the Germans and the French are cutting military aid to Ukraine. So what's happening here? So I think trying to make peace and getting the Europeans to step up is the right policy proposal, and I think that's what speak for what President Trump has expressed.
Bridge, was there a true shift in Europe from we need to see this through to, I don't know what the end ever looked like, but to now? Did they actually shift and say, okay, some type of negotiated peace settlement is in the interest of all of us at this point, whether it's ceding land that Russia already had? Did they really change?
I think you see that happening. In fact, Chancellor Scholz spoke with President Putin for the first time in a while, I believe yesterday or the day before. So clearly people see the writing on the wall, and the war's not going well, unfortunately, under the Biden administration and its European allies. So I think people see that, and frankly, I think you're seeing movement from Kiev itself, from the Ukrainians. hopefully some receptivity on the part of the Russians, but if that's going to work, the Europeans are still going to have to step up to be able to support the Ukrainians.
You know Pete Hegseth, Bridge?
I know him by reputation, and I certainly admire his service to our country, his commitment to President Trump's kind of America First foreign policy, his connection with service members and so forth. So, but we don't have a close personal relationship or anything like that.
All right, do you expect you will?
No presumptions. I'm just excited. Look, I mean, I think that, Don Jr. actually put something out earlier today. President Trump is putting people like Pete Hegseth, who's very qualified, great American patriot, served his country, very articulate spokesman, but who are going to implement President Trump's own vision that he got elected on. There's no mystery here, and that's, I think, what people should key in on. I don't make any presumptions. I'd be honored to help contribute to that cause wherever I am.
Okay. Oh, Rich Colby, former, that was in the Trump administration, first time, right? Yeah.
Right.
Right. Okay. Excellent. Thanks, Bridge.
Thanks, Joe.
When we come back, the fate of one of the most recognizable sports themes in television history, composer John Tesh will join us on Round Ball Rock, and whether we'll be hearing it when pro basketball comes back to NBC next year. Squawk Box will be right back.
I.
For basketball fans going back to the 1990s, a few notes of John Tesh's Round Ball Rock can transport them back to the NBA on NBC. Now, as NBC Sports gears up for its multi-billion-dollar NBA broadcast deal starting next season, the network has teased the return of Tesh's iconic theme, but so far hasn't secured a licensing deal. NBC and CNBC, by the way, are both owned by NBC Universal parent company Comcast. Joining us right now is John Tesh. We should mention, by the way, NBC has no official comment on the negotiations over Round Ball Rock. And John, I just want to welcome you. First of all, for anybody who wasn't watching last week, we did a segment with Alex Sherman, a reporter from CNBC, talking about how these negotiations had been taking place, talked a little bit about it. And I made an unkind comment that I feel pretty bad about. I think I said it sounded dated. I heard you talk about it on a podcast, and I felt really bad because I love Round Ball Rock. I love you, John, and we're really happy to have you here to talk a little bit about this today. So thank you.
This is so funny. You didn't have to reach out, but on the podcast, I just thought, hey, listen, this song is not. I went crazy. I said, this song is not dated. You know, it's all those sounds are coming back. It was, I mean, I tell you what, nobody else on Squawk Box reached out. It was just you, you know. And so
We didn't insult you. I said you were like Top Gun. I said you were like Kenny Loggins.
You did.
Yeah,
Top Gun. I said.
I get the Top Gun credit, dude.
Yeah, but I get the Caddyshack. I get that Kenny Loggins Caddyshack credit.
I can remember Caddyshack.
Yes, exactly. Oh, you guys all get credit. Yeah, the Top Gun thing was really nice. Yeah. Well, anyway, I mean, real quickly before we get into it, I have to tell you that I'm sending you something, Becky. This is this is an old school, dated sound synthesizer. Okay. And you can see I wrote on there, dated sounds for Becky, and I signed it. So
John,
you'll be able to make
this.
all those dated, you'll be able to do the Top Gun sound, you can do the Round Ball Rock sound. Of course, you're going to have to report this to the IRS and to NASDAQ and all the rest of that stuff that you guys are dealing with, but maybe you can just auction it off or something. But
That's
the old sound is,
publish it. That's fantastic.
the old sound is back.
You know, John, we talked about this, and we got into a little bit about how, and you can tell us the timeline on some of these things. Maybe we should just start with that. I mean, Round Ball Rock is a song everybody knows. It's a song everybody gets excited about. And when NBC put out the release saying that you were going to be back with that, there was some fan excitement online about that. I guess we haven't completely negotiated a deal. There is no rights deal just yet. What happened?
Well, I mean, yeah, they released a press release saying that they got the rights to the NBA, which was amazing. And then in that, they included the fact that they were bringing Round Ball Rock back, and we hadn't talked yet. The good news is because you guys were squawking about it, and Watergate reporter Alex Sherman reported on it, and so now we are talking. So whenever I need anything, I'm just going to call you guys. No, I'm just. But it was. No, so we are talking, and it's great. But you know, it was funny because I didn't see it live, and I watched the video of you guys, and it sounded like Edward R. Murrow live from London. It was like, John Tisch is playing hardball. John Tisch is not happy. John Tisch is holding out, and then so of course the internet picks it up and says John Tisch is holding out. I'm not holding out. I mean, NBC is my friend. You know, Rick Cordella, who's now the new president of NBC Sports, is incredible. I mean, this guy is he's launching NBC Sports into a new era, and the guy has 6 Emmys, and so all I'm doing right now is, I mean, we're going to put together something, and I'm just looking forward to working with these guys.
Fantastic.
You guys are on the other side right now.
Well, we are thrilled to have you back in the fold.
And not only did I not say it was dated, I said I thought I heard it last week watching a basketball.
You did. You did.
That's how fast 20 years goes now, John. As you probably.
Yeah, you thought you'd heard it at the supermarket.
Are you sure it's not still? I was watching it.
John, talking about dated or updating it, one of the things you said on the podcast, which I enjoyed watching, was the idea that you might actually tinker with it a little bit. Was that what you were intimating?
Update
we
hopefully.
actually
An orchestra, right?
Update it, hopefully.
Yeah. Guys,
That's a
we
joke.
went to the legendary Ocean Way recording in Nashville, and we recorded several versions of it. It was funny because when I said on some podcast that I was going to re-record, people were like, no, don't touch it. We like the OG version of it, and I had to ask my 30-year-old daughter what the heck that meant. So there are actually 3 versions of it now, and so Next year is going to be a big year for us because we're going to release a new sports record. They'll have all 3 versions of it. And then we're actually going to do a thing called Round Ball Rock Battle of the Bands, where it's going to be a contest between high school bands, and we'll give away hundreds of instruments, and it's going to be great. Just leading up to the new season.
You thought about giving it away to or selling it to private equity and having them kind of do any negotiations with it. What changed your mind?
It was my 12-year-old granddaughter. She said, "No, Pop," and we were very close. And she said, "Pop, no, you can't sell this song." And so all 3 of my grandkids, 12, 10, and 8, they can play the song on a piano. But my 12-year-old the other day, she goes, Pop, I've been playing this Round Ball Rock for a while, and it's pretty easy. There's a lot of white keys." And I said, "Shut up, kid," But they're all into it. The funny thing about all this is I don't think anybody would have predicted that Charles Barkley would be on ESPN, that Al Michaels would be on Amazon Sports, and that Round Ball Rock would be back on NBC. It's like, it's dogs will be friends with cats. It's like one of the biblical signs of the end of the world. But I'll take it.
Well, we've got plenty of other indications of that too.
We get to talk about Entertainment Tonight and Mary Hart. I mean, John, I grew up watching you. This whole thing is incredible to me that we're even having this conversation.
Listen, for the first time you guys said something about it, I got so many texts from all of my friends saying that, hey, did you know you were on Squawk Box? And not one of my friends could spell squawk, but now they're all huge fans.
Hey, John, we just want to thank you. We've got data that we are late to get to, but I want to say thank you for being gracious when I reached out. And
we'll see.
He immediately got back with me, and I teased. I will tell you, I was texting back and forth with him while we were on the show, and he said he might come on this week, and I teased it. I said, "Oh, he's coming on next week," and then I realized that I had done the same thing. That I got excited, and I spouted off before I should have. So thanks for being gracious all the way around,
That's
John.
great. I appreciate you guys. And in the world of geopolitics, it's this big, but I appreciate talking to you guys about it.
We appreciate talking to you too, John Tess.
Speaking of, Rick Santelli standing by at the CME in Chicago with some breaking housing data. Hey, Rick.
All right, Joe, indeed, these are October readings for housing starts and permits. And remember, we had Storm Milton, in October. We had Helene in September. And some of the Southeast may have been affected, as you'll see. Number 1,311,000 on starts at seasonally adjusted annualized units. And that follows a slightly revised 1,353,000. So we're down, 3%-ish? That is the lightest rate since July, and that July rate on starts, of course, was the weakest going back all the way to 2021. So we want to be very careful here and point out that, it's also between single and multi-family 16 home sales due to interest rate levels and landlocked owners really have been underperforming. So, single family new construction has been kind of the star. The percentage of those homes has grown over historic standards. And if we look at permits, they were also down 1,416,000. That follows at 1,425,000. So less than a 1% drop, but still also the lightest rate since July. We want to continue to monitor this. And if you recall, close your eyes and envision a chart of 10-year yields and how they moved in October. They basically moved in October from below 380 to well over 440, to 420-ish. So we know that interest rates moved higher, and they continue to be the kind of linchpin of the housing market. We do see that rates haven't moved much, but they were already down coming into this number, Joe. 422 and a 10, that's down a half a dozen basis points, a very parallel shift on the yield curve. 10s are down about a half a dozen basis points as well at a 435 yield. And this consolidation we've seen in closing yields on long-dated treasuries is starting to slip a bit. We had 4 sessions in a row where we were closing between 442 and 445. Yesterday we're a bit lower, and it looks like we're losing a bit of that momentum. It doesn't surprise me that 4.5 has been a bit of a breaker for 10-year yields, but I wouldn't look for a huge amount of retrenchment. Back to you.
Does it matter what goes on? Well, hopefully nothing. I thought it was a flight to safety from what's happening in, far away. That's not what's happening, right?
Well, I do think that there is some of that in there, and actually, with the counterfactual not known, what you bring up is a really great point. If we're hovering right now, still very close to the mid 430s in a 10-year, with that effect in, what happens when it turns around a little bit? I just think that the scale of interest rates, especially from 7s out to 30s, has really stacked up a little bit, and I continue to point to the fact that 2-year note yields are going to reflect more of the sentiment of the Fed, even though they may not be easing as much as we anticipated, let's say, a half a year ago. I think that feel-good presentation that the Fed will give about the easing cycle will continue to keep short rates a little more well-behaved than long end.
Who'd make the best Treasury Secretary, Rick?
Oh, I don't know. I haven't gotten that phone call yet. I'm a little surprised.
I was wondering. I know. No, but who? Out of the ones you know, is there one you want the most hawkish Treasury Secretary, but strongest dollar guy or gal?
Well, I just hope it's not a labor economist right off the get-go, I would think. I don't know. I kind of like our buddy, our old buddy from CNBC. I think Kudlow would make a great Treasury Secretary.
That's interesting. All right. Free markets, best path to prosperity. I say that a lot too. That I got a little bit of it. I think he tried to trademark that. All right. Thanks, Rick. Diana Olick joins us now with more on those. Not on the Treasury Secretary pick necessarily, Diana, but if you want to opine on that as well.
No, I do not. I'll talk housing, though, Joe. How's that? Look, I want to continue on what Rick was saying about the mortgage rates during October. We started with the average on the 30-year fix at around 6.2% at the start of October. It shot up over 7% by the end of the month. So that's what home builders were looking at during October as they were starting homes. And you do see that the bulk of this drop, this unexpectedly lower drop that we saw in housing starts, was mostly single family. You saw single family month to month down about 7%. Multifamily was actually up month to month about 10%, still down year over year. That's because multifamily has an oversupply. They're still drawing down. We've seen that all year. Single family, though, still needs much more construction, and we're down 0.5% year over year in October. So not a good sign for that. But the builders, again, we're seeing these higher mortgage rates. Also, I want to talk about that weather effect, which was that we did see a big drop in the South on housing start, single and multifamily. That, of course, due to the hurricanes. We also, though, saw a big drop in the Northeast, so you can't blame it all on the weather. But builder sentiment has been going up. We saw it tick up in the report yesterday, which was for November. Builders seem to be expecting mortgage rates to ease down a little bit. Perhaps more of that is the share of big builders who are able to buy down rates. But they're also pleased with the potential for President-elect Trump opening up more federal lands and the opportunity to get more homes built on more land. Land, of course, is a big problem for them. But again, these housing starts number in October, obviously looking backward. We did see rates kind of normalize in November, but we're still up over 7%. So the builders have a long road ahead. I also want to throw in that they've seen lumber prices spike due to several reasons in the last couple of weeks. In fact, we're at the highest level of the year right now. And for framing lumber, prices are up 20% year over year. That has to do with very low supply right now for lumber and very high demand. As we look at going into the spring season, they start to, buy their lumber now. So a lot of headwinds for the builders right now, and that's probably why you saw the numbers come in light. Back to you guys.
Okay, Diana, thank you. We come back a lot more on Squawk this morning. Roblox CEO David Baszucki is going to be joining us to talk about some of those new privacy protections for children, and we come right back.
come back, Roblox CEO David Baszucki will join us live. Stay tuned. You're watching Squawk Box, and this is CNBC.
CNBC. Welcome back to Squawk Box. Roblox rolling out safety updates to the popular gaming platform, including remote parental controls and content labeling. Roblox has been under fire on safety issues since a report last month from activist short seller Hindenburg Research said that the game exposed children to grooming, pornography, violent content, and abusive speech. Roblox has rejected all of Hindenburg's claims and called its report misleading. Join us right now, first on CNBC, is Roblox CEO Dave Baszucki. Good morning to you. We've been talking for many years now about your site and the company and trying to keep kids safe. You're rolling out a whole number of new products and features for parents. By the way, I'm happy that you're doing this because it sounds like maybe I'll be able to control what my kids are doing more than I was able to. But explain what exactly you're doing and how you're addressing this.
Hey, Andrew, thank you so much for having me and us on the show. We want to highlight what a priority safety is on our platform. And we release so many safety updates throughout the year, but the one we did on Monday was a real big one. And it's all about allowing parents to transparently connect with the digital lives of their kids on Roblox. The first thing is we announced parent accounts. Parent accounts allow we think all parents should have a Roblox account as well. And when a parent links their parent account to their kid's account, they can work with the friends list, they can work with screen time if they want, and they can also work with experience guidelines and the content that their kids will see. The second thing we released is a new way of looking at experience guidelines that are a lot closer to what parents are familiar with, which is how the movie industry thinks about content. So these are just really a continuation of our focus on safety and civility on Roblox.
Dave, hindsight's 2020, but obviously this Hindenburg report has put a lot of spotlight on these issues on the site. I was not aware of some of the sort of Epstein Island creations that kids had access to before. What was your reaction when you first read that report? Putting aside the short sale on the company and clearly the incentives on their side economically at least, but when you read it, what did you think?
Yeah, I do want to, thanks for pointing out this is a short seller report, and thanks for pointing out that we rejected all of the allegations of the report that Roblox wasn't safe and civil. The big release that we did on Monday was well in the works and well in the planning prior to this really report. And as I highlighted, we're shipping safety and civility updates constantly. On the content side, we have strong controls in place. We're constantly scanning all of the content on the site, immediately taking down things that are not appropriate, and taking a step back when we think about the company. We're really approach safety in a fundamentally different way. All of the text on our platform is filtered. All of the voice is filtered. We have teams of moderators. We really hold ourselves to a higher standard and put safety and civility as our top priority.
But Dave, one of the real shifts that I'm seeing, at least in terms of this new, some of these new releases is, so, and you know this, I have two 14-year-old boys and a 7-year-old. And, I remember back with the boys, but I know it now with my daughter. She's talking to people that she does not know online, right? I mean, I've actually walked over to her iPad when she's doing, and I'll say, who are you talking to? And she'll say, I don't know. It's somebody. And I always flinch when that happens a little bit. And I'm thinking to myself, well, is this, a good person, a bad person? What do you do about it? I had, sons, I think when they were 9 or 10, they wanted to make Robux, which is the currency on Roblox, and the only way to really make it is to become a developer. And I remember them trying to figure out how they could pretend that they were 13 years old on the site, because that's the only way to become a quote-unquote developer. How do you balance all of these things?
Yeah, so you're highlighting some really wonderful things. We think about the platform, and also some things we take very, very seriously. You're right. We want Roblox to be a place where people get interested in STEM, in creation, where they ultimately can create things that make a business on our platform. And part of the success we had in this last quarter is millions of creators making awesome properties on our platform and making money from it. Once again, back to safety, I want to highlight just our focus on this. All text on our platform runs through filters. All voice on our platform runs through filters. And we're more and more starting to lead the industry in the development of the AI to support safety and civility. For example, our voice filter, which we built internally, is now open sourced on Hugging Face and is one of the top downloaded models for voice safety and civility. And other companies are starting to adopt it. So we do want young people to get interested in STEM and creating on Roblox, and we put enormous focus on safety and civility.
Hey, Dave, can I just ask though, you said you're rejecting all of the claims that came from that Hindenburg report. Part of the claims were that this was a pedophile hellscape, that they found 38 groups where users traded child porn and solicited sexual favors, that some of those areas were patterned after either Epstein Island or Sean Combs, P. Diddy, and that they were able to access those areas of the site even when they registered an account that said that they were under the age of 13. Do you reject all of those claims?
Yeah, so this report claimed a bunch of things, that anyone can go look up and see are patently false. For example, they claimed we had twice the hours we state in our financial statements.
No, I'm not talking about the other
on the
just
safety,
on these claims themselves. Is there
on this claim, claiming child porn is being traded on Roblox is ridiculous, because we cannot share images on our platform. We have never allowed the sharing of the images on Roblox. It's part of being safe by default for all ages, not just younger, not just older players. And in fact, we really, because of this higher standard, we really work hard to prevent people on Roblox from going anywhere else, because other platforms do allow voice or image
but
sharing.
Dave, it sounds like there was, and I guess I think the question that we're trying to get at is whether there are demonstrable photographs, as you and I know photographs to be, versus maybe a digital animated version of pornography or people doing things that might be sexual in nature. Are you rejecting the idea that the analysts or investors in Hindenburg that put that report together did not see what they said they saw?
We reject that there's any image sharing on Roblox of pornography, and we want to highlight that we have very strong systems in place to very quickly take down content that's not consistent with our guidelines. I also want to highlight, in addition to that, what we're releasing on Monday, in addition to content safety, is giving parents more control of what content is appropriate for kids of their age as well.
Right. Well, I'll be signing up for that. Dave, we always appreciate talking to you about this, and I imagine and I hope we get an opportunity to continue this conversation, so thank you. Appreciate it.
Thank you, Andrew. Great to be on the show. Thank you.
Okay. Squawk Box, coming right back after this.
Thanks. Contessa Brewer joins us now to look at some of the morning's top pre-market movers. Hey, Contessa.
Hey there, Joe. Let's start off with shares of Lowe's now. We're falling in the pre-market despite beating across the board in quarter three, down 1 1/3%. The Lowe's also raised full-year revenue guidance, but the home improvement giant is expecting comp sales to decline next year, so that's why you're seeing shares declining. Walmart surging on earnings today, posting better than expected revenues and profit. up 2.5% pre-market. Gross profits also grew by 21 basis points. Walmart raised its full-year EPS guidance. It says it's seeing strong start to the holiday season as well. And rounding things out with Supermicro, which is skyrocketing now, we're seeing it up 24.5% after announcing BDO as its auditor and submitting its compliance plan to NASDAQ. Its previous auditor, EY, resigned in October, remember, after short seller Hindenburg Research released a report that flagged accounting irregularities. The chip maker still needs to file its year-end 2024 report, Becky.
Okay, Contessa, thank you very much. Let's take a broader look at the futures right now. They've taken another leg down this morning. You can see right now the Dow futures are down by close to 500 points. It's a drop of about 483 points below fair value right now. S&P futures are now down by 50, and the NASDAQ is down by 190. This is coming on some stepped up reports, more reports detailing what we've been talking about all morning since the futures first turned lower. At this point, Russia's foreign minister, Sergei Lavrov, is just saying that Ukraine's attacks against Russia's border region with the U.S.-made missiles is a signal that they seek escalation. I guess the United States, they say, is seeking escalation. Now, he said that Putin has issued his warnings already and that he hopes the new nuclear doctrine will be, in his words, well read, just amping up some of the concerns and stresses around this situation. Again, we've been in the red all morning long if you're just waking up. This was a situation where we were down by over 200 points earlier this morning. On news, a Bloomberg report that was out saying that this had happened. We've heard more confirmations throughout the morning, and now you're actually hearing from Russia officially on some of these issues, and that's why we've seen the turn lower. Why don't we take a look at the Treasury market, because Treasury yields, which have been climbing pretty significantly for months at this point, have taken a turn lower this morning as well. You can look at the U.S. 10-year now sitting at 433. We were up in the 447, 448 range yesterday. This all came as we've been watching these moves higher. That can be seen as a flight to safety with some of the issues that have come in, the 10-year moving lower. You're flipping through some of these other boards pretty quickly at this point, but if you saw Bitcoin, it's relatively flat. It's still above 91,000 this morning, 91,300. Close to it the last tick, but obviously these are all moves that will be watched very closely today. Not only what Russia is saying about this right now, but what the U.S. response will be, and that will be something that we will be tracking throughout the morning. You can see this playing out in some of the futures markets and beyond with some of these issues. We are looking again at the Dow futures now down by over 500 points. NASDAQ futures are over 200 points lower. The S&P 500 down by 55. If you want to point that out, that's probably a decline of just over 1% for the Dow, which is at 43,000. So when you're talking 500 points, it's a move of just over 1% to the downside. Earlier this morning, it was just over 0.5%. We'll continue to monitor this throughout the day.
500, that's a Lavrov comment.
And we will hope you see you right back here tomorrow. Right now, it's time for Squawk on the Street.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl Kingston here with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. There is some flight to safety this morning on these renewed Russia-Ukraine tensions. Gold is higher, yields are lower. You can see futures drowning out some of Walmart's beaten raise, the third straight quarter of rising comps. Our roadmap's going to begin, though, with these geopolitical risks. Futures lower as Russia-U.S. tensions hit some global markets. Putin lowering the threshold for a nuclear strike.
Plus, Walmart shares look to be up a bit this morning. The retail giant hiked its outlook yet again, and it is seeing what it expects will be a strong holiday season. We're also watching tech antitrust headwinds. The DOJ is reportedly set to ask a judge to force Alphabet's Google unit to sell off its Chrome internet browser, amongst other things.
Let's begin with these geopolitical tensions weighing on stocks worldwide. The Kremlin announcing Russian President Vladimir Putin has updated his country's nuclear doctrine. It says Russia could use nuclear arms if it's attacked by a country backed by a nuclear power. Moscow's defense ministry claims Ukraine has carried out its first strike on Russian territory using these U.S. long-range missiles, and that comes just days after a report stating that the Biden administration lifted restrictions on Ukraine's use of such missiles against targets inside Russia. Jim, this morning you wrote something like this does tend to get yields lower.
Yeah, I mean, look, we're in one of those situations where
you were trying to figure out why Biden didn't do this before. Why did they not have long-range missiles? And well, the reason why was that obviously there would be a statement about a nuclear response. This has been what everybody feared. I think at the same time, David, there's a belief. This is really it. I mean, if you're going to have a negotiation, this is how the negotiation starts. You say, okay, look, this is no longer, this is out of control, and maybe we got to sit down and figure out what to do. Whether it's solved by this administration or the next administration, this is the escalation that everyone had feared, and here it is.
Yeah, I think the expectation is it's the incoming administration that conceivably will try to settle things, as President-elect Trump has said he would do in 24 hours. That remains to be seen whether, in fact, that's possible. It's been many years of this war.
Right.
Well, 1,000 days today.
And, I mean, sometimes we forget the human toll. The Russians, by the way, losing, I think, the British estimates, which typically are referred to by many publications. I read the Journal's coverage, by the way, Wall Street Journal's coverage has been amazing of this war in so many different ways. 1,500 people a day getting lost by the Russians, just to put that in some perspective again in terms of what's been hot here. We know North Korea has provided as many as 13,000 soldiers that are now, some of them in combat position. You know, we haven't focused on this war that often, obviously, since the early days when we saw commodity prices rise and a lot of different things roiling global markets, but every so often it rears its head.
Right. I mean, look, I think it's ripe for some sort of negotiation, just because it's obvious that so many people are being killed, 1,000 days. I think that the Ukrainians would have to give away something in terms of setting it so that the Russians have land. If that would be, I think, the Trump doctrine. But the idea of selling the market here, you finally have interest rates down. You finally have a situation where the market, other than a few stocks, might not be under attack. We really had a lot of stocks fall off last week. We realized, wow, you know what, Trump is not, it may not be that friendly to the stock market. And so maybe you get, I don't know, look, if you say that you should buy something here and anything bad happens, it will never be forgotten. That tape will be run forever. It'll be on YouTube, a TikTok thing. Kramer says buy, and meanwhile, a city was obliterated. But if you think that it won't be, and you think that this is just the escalation you've been waiting for, we're finally going to have a chance to buy some stocks.
Certainly defense names you might expect would be an easy knee-jerk response.
I think that RTX is a terrific stock because it's got aerospace and defense. I don't know if I can buy Boeing. I mean, Boeing still has not demonstrated anything that makes me feel at all confident. You can buy, you want to buy Lockheed Martin? I mean, you've got this new, what I regard as a Palantir thrust, which just says you do not want to own any of the big hardware companies. I know that Palantir, we've been speaking more to Palantir, and Palantir stock went up very big off the NASDAQ 100, but that stock is slated to be the #1 stock in the S&P this year for the people who are moved, David, from GameStop kind of buyers to this one. And this one actually has what I call gravitas.
Palantir has gravitas. So has about a market cap that's 30 billion more than Boeing's. Which is
well, yeah,
sort of hard to imagine.
Boeing's having one of the worst years I've ever seen.
It's having a bad year. Yeah. It's having a bad year. When you talk about stocks, Jim, and you say finally time to buy them, though, I find myself that's a bit quizzical. I mean, it was only a week ago.
Well, no, some stocks are down so huge.
And interest rates you talked about, I mean, they've been higher. What you're just talking about today?
I'm saying today you get a chance. Look, I think it's a very positive market. It's just that there are sections of the market that are like the drug stocks and the food stocks. Like we've all decided that Bobby Jr. is just going to roll over this like I don't know, like Stalin rolling over to Moscow.
Is that what we're going with now, Bobby Jr.? Is that what we're calling him?
Yeah, Bobby Jr.
Bobby Jr.
Yeah, well, I kind of like the Sopranos thing.
Yeah,
because he's so powerful.
We do have a downgrade of KHC today out of Piper. They go to neutral, but they don't say it's about RFK Jr. They say it's more about, we saw these reports yesterday on perhaps reworking SNAP eligibility. Kraft is over-indexed to SNAP exposure.
Well, I mean, Kraft's really an awful company. They're terrible. I mean, honestly,
tell us what you really
terrible.
think.
No, like I'm looking. It's okay. You know what? It's okay.
It's okay for them to be
yeah, it's okay. You see, like one of the things that people are owed at home is what you would say at home at the office. Like I got to Kraft and said, "Man, those guys suck," you know. And then like maybe they do something. It's okay. It's okay. McCormick does it. McCormick actually fits with Bobby Jr.
Give us a long-term. Can we get a long-term Kraft Heinz? By the way, I mean, this is Buffett holding. It's been a big deal.
Oh, well, there you go.
Yeah.
Okay.
Pointing
well,
it
so
out.
was Ulta. Remember Ulta? That was a Buffett holding for
longer term.
He doesn't
Kraft
trade.
Heinz.
Buffett doesn't trade.
Yeah.
But Ulta was, I think, the definition of a trade. Is that all right to say that? Look at that.
That's suboptimal.
Oh, now it's time.
As you like to say, there's 10 years.
Kraft, now
That's
it's time.
60%. Hasn't worked out the way they planned, perhaps.
OSCAR.
Some of their hopes have been dashed.
MAYER spells really awful stuff. Look, this is the one that he wants. If Bobby Jr. is serious, he goes after this one. People say,
Baby Bear Bobby?
But no, he's a real force. I mean, people don't know what he's going to do, right? But he's
They don't even know if he's going to be confirmed,
Well,
by the
I mean,
way.
but you know, you have to presume. Do you want to presume nuclear war, Rocket Man?
No, I'm just saying you don't.
We also have Nestle on the tape. The
Okay, there's
the
good
U.S. CEO says he is, quote, less concerned about RFK Jr. after having spoken to members of the president-elect's transition team.
Yeah, we ought to be concerned about profits.
He may not be confirmed still. That is certainly possible.
Well, I mean,
and speaking of Larry Robbins yesterday at Glenview, who's a big healthcare investor, has been for many years. He certainly took the position that at least he seemed to think that there was a decent chance he will not be confirmed. Now, that's all a big guess. Who knows?
Right.
But it may quickly change the complexion of some in terms of the marketplace, in terms of some of these stocks, Jim, if in fact RFK Jr. is not confirmed.
Well, no, I mean, yeah, there is going to be an FDA head that person. There was a really good piece in the paper about how the things that Bobby Jr. could do. He could make it so that if you were Dr. Borla at Pfizer, I think you would probably spend a little more money away from vaccines. GlaxoSmithKline way away. But let's just go over. I'm going to go back to Nestle's. Okay, so Nestle's is missing. They have a $2.8 billion cost cutting. Do they really have that much fat? N-E-S-T-L-E-S. I mean, it's like Oscar Mayer. All we do is spell these names. But they're spinning off Pellegrino, Perrier, Aquapana. I don't know. That seems like good business.
Well, how about this, the Morgan Stanley table yesterday looking at big pharma ad spend? Do you want to take a guess at which media company has the highest percentage of total pharma ad spend?
Well, who's got the oldest demographics?
No, it's where we work. Comcast, 17%.
No, yeah.
Followed by Paramount.
Who has the oldest demographic?
Yeah, followed by Paramount.
Well, you know, at least we're not doing fire and cop shows. If I have to watch there's a network, all they do is fire and cop shows. I'm not kidding. Romo. It's like, oh, fireman, fire this, fire. Wait, I'm tired with fire.
It's network television. It's network television.
Cops, fire, hospitals. It hasn't worked for 30 years. Let's just keep doing it.
That said, broadcast is down so much less than linear cable. Broadcast is hanging in there.
Oh, good. Well, people want to watch fire.
I'm sorry to tell you, but that's,
Well, it's hanging in there.
You'd rather have NBC.
Okay, can I just say that if you ask me what the worst group is in this entire market, it's that group.
Which group?
Entertainment, cable.
I thought it was the drugs now.
No, that's going to bounce back.
Oh.
Those are just, look, Rob Davis has a terrific, he's got the vaccine thing. I don't know. You guys saw what they're doing?
I don't even know. Oh, you're talking about Merck now. Yeah.
Well, Merck's under 100. Merck's pretty good. That's a good company.
Yeah, we
used to call it St. Merck.
Got this phase 3 endpoint met today. Yeah.
You know, I think the drug companies are doing things. The cybersecurity look good. I like the banks. If they come in, I like them. But I'm not going to go after Lunchables. Lunchables is not the future.
Is that Kraft Heinz?
Yeah.
It is Kraft Heinz.
Yeah. I mean, cryogenics, in order to cool off the data center.
Don't be like me.
How about the long knives out for a video?
Don't be raised on Hawaiian Punch and Pop-Tarts, because this is what happens.
Well, look, Kellanova got that giant bid from Mars.
Not just a giant bid, a deal.
Mars was on Venus with
Yes,
that deal.
Mars is buying Kellanova.
You don't double. I mean, look, I happen to like the guys at Smucker.
And all their
they're very good.
Pop-Tarts.
But you know, they own Hostess.
Yes, they do.
And they've proven to me, by the way, that Hostess is. In the event of nuclear war, you eat the hell out of Hostess.
Well, we argued GLP-1s are bad for many of these businesses, but now we're arguing that RFK Jr. could be bad for them. But he's actually not necessarily in favor of GLP-1, so I don't know how it's going to work out.
Do you remember when the GOP desk ones, when that piece came out that said that people are going to, there was that planes
are going to be lighter because so many people would be at GOP-1. That was the bottom, okay? And we're approaching that market.
That was my favorite.
Okay? That was the worst
The
piece of
B of A
research I've
note,
ever
looking
read.
at how apparel sizes would change.
That was my favorite.
Yes.
Power was down the CPI this month.
Buy the airlines on GLP-1s.
That was it.
Yeah.
Buy the airlines.
People are going to weigh
So
less,
that's the kind of thing,
less fuel.
if I had that
was
piece
genius.
of research, that would show exactly how worthless. Look, I don't want to offend that person, which
You've
is why I
offended
forgot
so
their
many
name.
people in the last 11 minutes. It's unbelievable.
Oh, go pound sand.
There's one more. When we come back, we'll look at Walmart.
Corp.
A bright spot on the earnings front today, as we mentioned, this beat and raise and some pretty solid comps. Take a look at the pre-market. We'll get to some travel as well. We got a top pick on UAL. Many calls actually on NVIDIA with futures sharply in the red. Don't go anywhere. Walmart's up in the pre-market. The retail giant raising full-year guidance going into the holiday season. The company also with a quarterly beat cites strength across merchandise categories. U.S. comps up 5.3. E-commerce up 27. Jim, ads up 28.
They are about to inflect like you wouldn't believe. Now, here's a stock that you buy. This gets hit because there were no flies on this. And I think one of the things that we have to remember, I mean, the stock was down up 3 at one point. It's already down 1.9 and 1.8. But Carl, this company, everything they offered was of great value. And the people who make more than $100,000 a year are shopping there. So this is the win-win. David, their e-commerce is so strong that you have to wonder whether they're such a clear number 2 to Amazon.
Yes.
But you have to wonder whether that business itself is going to start making them billions because of the advertising. It's really extraordinary.
The advertising is a real opportunity for these companies. Essentially, you know, you're obviously your the vendors are paying you to advertise on the websites to draw eyeballs to their particular
That's
products.
unbelievable.
Amazon, as we know, the margins are incredible,
Amazing.
and Walmart has grown that business
How about the fact
significantly.
that they have all these groceries that are $5 and less, and grocery is doing very well for them. I don't know. I come back and I look at this quarter and I say, geez, wow, what a lucky thing. You're going to have a down market. This stock be up 5-6 is really good. It's up 60% for the year, though.
No, you look at 20 years, but also even the last 5 have been very strong.
Well, this guy
we've
McMillan
talked
runs
about
it.
McMillan's leadership.
He's got
has been-
horse sense in it.
Yes, it's been very, very successful. You've been a big fan
I've
for
been a
some
huge
time in
fan.
stock.
Yes, I am a huge fan, and I think that they have done remarkable things in terms of making it so that the prices were rolled back after what happened in this country. And I think we're starting to really get a feel now that President-elect Trump was elected. There just weren't enough Walmarts out there for everything else. There wasn't a Walmart for cars. There wasn't maybe Carvana. Wasn't a Walmart for houses. Walmart made it so that it became the anti-gouger. But obviously, Vice President Harris did not figure out who to embrace or hated business so much that would never call Doug McMillan in or never call Costco in and say, how do we get prices lower? Because the antipathy they had toward business, we do not talk enough about. Yes, they did have some Wall Streeters who were on their side, who were regarded as being the wrong team anyway. But they never embraced any of these companies. By the way, and who else has kept prices down? Well, the Titans. And the Titans are being attacked once again. Like the last minute, they're walking out of the building. And they're saying, listen, grenade to the major Titans that we know of. Amazon's kept prices down.
Oh, that's what you're talking about.
No,
Okay.
what do you think I'm talking about?
I thought maybe you were.
But remember the Titans?
Titans.
Coach Boone. He's thinking about Coach Boone.
I mean, a big part of Costin's 6,500 is about margins, and that's the kind of thing I think the Harris campaign was targeting.
Yeah.
Well, by the way,
one of the margins are out.
There is an item on the tape that a Walmart spokesman says, under Trump, we are concerned that significantly increased tariffs could lead to increased costs for our customers.
Well, it would. I mean, I think that everybody recognizes that. That's who you voted for. You get what you pay for.
Again, we should just emphasize, U.S. comps up 5.3%.
That's so hard to get.
That is a very.
I mean, Lowe's had.
It's a large number. By the way, EBIT also. I'm just trying to get through this.
Don't go right ahead.
EBIT also up 9.8%. So
Wasn't that incredible?
Those are big numbers.
I was just going to agree with you. That's all I was going to do.
Okay, thank you.
Those are unbelievable numbers.
Every so often, just a brief moment of silence.
That's what the 10's for, Chief.
Meanwhile, inventory down 0.6, pretty well managed.
Oh my God! No, there wasn't. It's a check. This was a clinic quarter. And by the way, they think about it every minute. One of the things that's amazing about Walmart, you say, look, I just had such a good experience in my one on Route 22. The manager knew exactly what he goes. Yeah, that guy's so great. I mean, did you like the boots that we did? I mean, they are what we used to think Sam Walton was. They know the stores. It's really incredible. They know my one in Neptune County, David, like it's the back of their hand. You don't know Neptune County from the Disney Neptune.
No, you got to be a good merchant. It all starts there. It all starts there.
Probably your family's in Gabardine.
That's what Sam taught me.
He did spend a lot of time over there.
I did. I didn't know Sam Walton.
But no, this is a remarkable quarter. It makes me feel good. I have total faith in America.
When we come back, we'll get Kramer's Mad Dash countdown to the opening bell. Plenty of other names to get to, including Lowe's and SMCI. Some news on the chips today, and we'll talk about NVIDIA's print tomorrow when we return.
Okay, 7 minutes to go, and what already has been a fairly wacky show. Let's get to a mad dash this morning. Want to talk a little Robin?
I want to upend an industry right now. If there are people from a brokerage house or banks listening, what they're going to have to understand is they're going to have to accept what I'm about to say. This is the king, okay? These guys have the next generation. The other guys have the people who watch fire shows and hospital shows and detective shows. These guys have the young. They watch TikTok, they watch YouTube, and they watch their handheld and trade crypto. And this morning, Robinhood did something that's unbelievable. They spent $300 million to buy a company that does RIA transfers. You'll see them, PMR Trade. They are not. I don't usually supposed to advertise, but mention the advertising, but it's an RIA custodian. Okay. So I mean, if you're one of these guys, this is one of those Butch Cassidy and the Sundance Kid situation.
Who are those guys?
Yes, you're sitting there at one of these major firms and you say, who are those guys? And I would say, they are the guys who in the great wealth transfer we're about to have from the baby boomers to younger, they're the guys who are crushing it. And you missed it. You just missed it. And what's amazing is, I think that all these guys could have been shut down very early on. They were doing all the balloons if you buy a certain stock. And the whole thing was like daily fantasy.
Yes.
And they ended up winning. They won. Dave Tepper probably could have bought them in a weekend, instead of the Panthers.
But they didn't. Now they've got the younger cohort, and they've got them trading.
And Davis got the Panthers.
But also crypto, obviously, very important.
Crypto's crushing it. I mean, look, this is also the anti-Gensler, when Coinbase is anti-Gensler.
Yes.
Gensler, it was the fireplace the whole time, dude.
Yes, it was always the fireplace.
It was always the fireplace.
It was the fireplace. It was always the fireplace. He finally did get out from in front of the fireplace.
Yeah, well, he's going to be in front of the lot.
Too late. Now he's going to have a lot of time in front of the fireplace.
This thing won. Everybody else lost. They didn't realize. The other firms thought, what can they ever amount to? It was like when I proposed.
But I mean, you're not buying it at the top here, Jim?
No, I am saying that they won. I'm not saying buy the stock, but it can go down, David, because of Moscow, because of Failsafe, because of Dr. Strangelove. I don't know. Dr. Strangelove. Fluoride. Fluoride. Remember, there's a general who's against fluoride.
Purity of essence, my friend. All right, we got an opening bell about 4.5 minutes from now. Don't forget, you can catch us anytime and anywhere. Listen to and follow the Squawk on the Street Opening Bell podcast.
Yeah, I'm Jim with the IRS building.
Hey, how's it going, sir?
Yeah, just give me a message, I guess, when you're going to go ahead and head on up there. Yeah.
My guys are headed over there right now. If not, should be pulling in any moment now.
Okay, well, I'll run on down there then.
Okay, sorry about that.
That's all right.
And,
I'm Jim.
nice to meet you, Jim. I'm Nate.
Yep, I'll head on down there.
All right, sounds good.
Bye. I'm thinking it might be a roof leak, but we'll know.
Oh, okay. Instead of the sprinkler heads leaking?
That's what I'm kind of thinking now, but we'll have them look at them.
Yeah, we were leaning towards the heads because the black that comes down on them, typically that is red stain.
Yeah, that red stain? Yeah, that's what it is. Yeah, that's probably.
That's typically what that looks like, appears to be at least.
Okay, well, I'll head on down there.
All right, thank you, sir.
Bye. Well, I'll be gone for a little bit. I got a lot going on today. Got to meet my accountant. I got to meet these guys at the building, and so.
Opposed to the technology side, which always play a major role in this case, even the administration focus.
Good stuff. Really like it, Ben Emmons. Good analysis. Great start to our morning. Appreciate your thoughts.
Thank you.
Absolutely. Good way to wrap in geopolitics into the future policy. What's happening in the short term for bonds, too. Ben Emmons, nice work there. All right, we got about 90 seconds, about a minute till the opening bell. We'll be right back.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network. It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next gen.
It's gonna be one of them kind of days,
Available
I can tell you.
anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
All right, a little bit of a rough and tumble morning for U.S. equity futures, but we are seeing a little bounce just in the last 20 minutes here as stocks try and stabilize and some of the risk-off tone retreats. Bonds caught a pretty good bid. Gold, too, as stocks came off. One could attribute it to headlines from overnight and this morning that Ukraine struck within Russia with a U.S. missile. What implication that has is up for your own geopolitical chops to figure out. I would offer that we have a 5-day chart now that is pretty straightforward, trending lower. S&Ps, Russell, NASDAQ have been making generally lower highs, and the Russell making lower lows. It's been most obvious in small caps that risk has come off since the peak of the post-election pop, which was on the 11th. So it's a little week-long drift downward that perhaps got another catalyst this morning, but generally in trend, moves that are in trend, I just like to say that they're in trend. You don't really have to find some great explanation, especially with the crude oil muted and the bond move only 20 basis points. People throwing out the nuke phrasing, and that just doesn't really seem like a nuclear war reaction. 40 basis points, 40 points rather, and the S&P's at the worst. So, all right, we're trying to figure it out. Certainly doesn't help to have negative headlines. And to Ben Emmons' point, I think he did a really good job that geopolitical expectations are also part of the Trump policy expectations game that is certainly going to be a bumpy one as it meets with reality. So claims that Russia-Ukraine war would end day one, a reminder that that's probably going to be complicated. So we'll see if stocks catch a bid. Wouldn't be surprised if they do. Bitcoin was up to 93.5 this morning, came back down to 92. So I'll watch that as it's been the most strong and reliable indicator of risk. We have some stocks to talk about on this list, but they're mostly kind of secondary trades. Lowe's is notable. We get into that alongside XPeng as well. HPE hanging in there pretty close to highs. I think that's kind of a win going into earnings. We'll talk more about cloud and the earnings season that's approaching. Let's look at the levels firstly and get our bearings with Kevin Green joining me here. If we just take a strictly technical look at the action here this morning, KG, how does it fit into the last 5 days?
Well, I mean, it does. I mean, it's on trend. What we've seen actually over the last 2 trading sessions here, we're continuing to test that 20-day moving average. We're pretty much testing it right now here, Oliver, and we want to see some buyers actually stepping in. But if you're actually looking at the E-mini S&P futures market, we did make a relatively new low since the highs, but we did see some buyers kind of stepping in, and on that 15-minute chart, we actually did see a nice little, bullish candle that actually did set up there, basically a hammer candle. So we were able to kind of buy up the lows from the futures market, and then this morning we want to continue to kind of, see some follow through. But right now, that 20-day moving average is going to be the key area that I'm looking at. Still looking at 58.50 as an area where maybe some buyers try to step in, and hopefully we do not fail there. And if we do fail, then we probably will actually, test that gap and fill that gap to the downside, especially if you're looking at the daily chart that I have those levels on here. So right now, I think we're actually setting up for the most part. It's bearish. We are seeing some negative flows for the most part, but structurally, for right now, to start off this session, we're still actually looking pretty good. Still want to see some buyers kind of stepping in at these levels. And if not, if we break through, once again, kind of like that chart shows, 58.50 is kind of like that range where it also equates to the gap that we saw for the election. And if we actually break through and break below that, the 50-day moving average is really where you want to see some buyers stepping in. We can look over the last 3 months. That has been an area where we have seen some buying activity taking place here, or reversal of bearish trends. So we're holding up for now. Let's see how we're going to maintain for the remainder of the day, and if tech is going to be able to lead us out of this, or are we going to see a rotation into defensive stocks, looking at utilities, maybe even real estate, looking at staples. We had some pretty decent numbers coming from Walmart, so those are going to be on the radar here for today's session at least.
Staples, the only sector higher right now. So obviously got a little bit of Walmart help there, but defensive in nature too. If you just kind of go through, the logic. So I like that. Tech still in the mix, only down 30 bips. It does seem like an important test here of the market's ability to hold this level, because oftentimes if it is a geopolitical driven thing, it's a short-term scare, and they're often, always basically buying opportunities. It's just the question is when. So if we're not able to turn this around, then I guess real kind of breakage, and then threatening that post-election gap, that's when things, it seems, would get really murky then, if we start to really fully unwind that pop.
Yeah, and if you are bearish, or you do want to see a little bit more of a retracement to the downside, obviously you want to see that break probably happening over the next couple of trading sessions, Oliver, because then that could kind of reset the markets, reset valuations for the most part, and then we still have that holiday trade, which really does kind of kick off on Black Friday, the day after Thanksgiving. Low liquidity, low volume type of environment could really drive us higher here. So that's kind of the setup. If we're going to hold here, you'd like to see us hold. If not, I don't think all is lost. I think there's still the seasonality portion of this market that buyers are going to try to step in, or at least dip their toes in for now. Going back to that E-mini S&P futures chart that I mentioned, if you kind of look at the bounce that we saw, it was right off the 61.8% retracement level on the Fibonacci. So once again, that's another key technical area that you wanted to see buyers kind of step in. That's your last bullish area of support here, from the lows that we had pre-election to the highs that we saw, 61.8% retracement. It literally hit that number on the dot, and that's where we started to kind of push higher here. So you want to see that follow through. On an intraday basis, here are the levels that I'm kind of focusing on. 5,900 is going to be your area where we might see some resistance, that positive gamma area that we kind of focus on. A lot of calls being sold at that level. 58.40 is going to be your negative gamma. So if we do kind of break through 58.50, 58.40 on an intraday basis, is going to be an area that I'm keeping my eye out on. The 58.15 puts have been catching a little bit of steam early on in the market here today. So if we do see a breakdown, 58.15 could be on the radar. In your immediate area of resistance, or where we might see some pressure in the market, 58.70. So those are going to be the levels that we're looking at on an intraday basis, kind of getting more into the minutia of the market, or the technicals of the market on a 5-minute or even a 10-minute, 15-minute structure.
Got it. Okay. Like that. So we need to hold the moving average. This being threatened. We need to find some dip buyers here. We hopefully, if you're bullish, you want to see them emerge in tech for the most part, which is kind of where they're trying to. But the staples trade fade a little bit. The anti-beta trade is bid this morning, but hopefully it's not just selling across the board. We'll see, but it's definitely a little bit of a dicey start here. a little rough, more like a test than so far a successful bounce back. So appreciate it, KG. Thanks for the perspective on the charts. Good look at the technicals there for the index and the futures. We got some stock stories to talk about. Caroline Woods is in New York, ready to talk about those stock stories. Let's knock out the earnings real quick. Carolina Lowe's down about 5% this morning, and a good run over the past year. The housing data was also neutral, and Home Depot's little change. So I do feel like that's the market telling us there might be some Lowe's specificity to this story.
It's an interesting one because actually it looked like it was going to open higher, and then we've been seeing kind of these losses pick up steam. The earnings call is still going on, so potentially some more cautious commentary on there, putting pressure on shares. But this was a beat on both the top and bottom line, and they actually boosted their guidance. Still expecting sales declines for the rest of the year, same-store sales declines, but not as bad as previously thought. So similar to what we heard from Home Depot. I do think it's also important to note, though, that shares had seen a pretty significant run-up heading into this report, even with today's 5% drawdown, still up about 16% year-to-date, up about 27% over the past 1 year. But just running through the numbers, adjusted EPS of $2.89 was 7 cents higher than analysts were expecting. Revenue did fall 1.5% to $20.17 billion, but still topped analysts' expectations. Comp store sales fell about 1.1%. Expectations were for almost 3% decline, so that came in better than expected as well. The company pointed to continued softness in do-it-yourself and bigger ticket discretionary demand, but it was partially offset by storm-related sales and then some positive comp sales in pro and online. As I said, the company boosted its full-year outlook, now expecting total sales between $83 to $83.5 billion. Previously, that was a range of $82.7 to $83.2, so boosting a bit on both the low and high end of that range. Comp store sales are now expected to be down between 3 and 3.5%. Previously, they were forecasting down between 3.5% to 4% from the prior year. Adjusted operating income, or basically adjusted operating margin, is expected to come in at 12.3 to 12.4%. Previously, that was 12.4 to 12.5%. From what I've seen on the earnings call so far, the company did say they continue to see pressure in bigger ticket items in kitchen and bath decor projects. So obviously, those are the more expensive areas. Lowe's CEO Marvin Ellison said as interest rates ease, they expect homeowners to tap into home equity to finance larger home improvement projects, something we've been waiting for quite some time, and Home Depot has kind of echoed similar sentiment. So shares are under pressure today, down about 4%. I did see a note from a Bernstein analyst saying that they think it's too early to call an inflection point in underlying home improvement demand. In fact, they rate Lowe's as an outperform, have a $306 price target. Lowe's is currently trading at $260, but said our proprietary home improvement macro forecast suggests home improvement demand will likely remain subdued over the next 12 months. So we'll see what else comes out of that earnings call. As you said, seeing a bit of weakness in Home Depot today as well, down about 2%.
Yeah. Home builders also down about 1%, so just a little bit of kind of peeling back some of the housing strength, which has really been going on since rates started making their move last month. So you can trace back the highs of these stocks, I think, pretty closely to the bond market situation. They're all pretty similar. Lowe's coming off now, though, a decent amount, down 4%, perhaps more of an uphill battle if homeowners are going to generally just stay as is for the moment. Doesn't sound like a particularly inspiring guidance message from Lowe's. So, all right, let's talk XPeng. Going over to China for a sec, down 5.5%. Stock had gotten back to even on the year. It actually turned into a positive on the year before the election, and then actually right after too. So the China stocks have really had a tough go of it, but XPeng was actually an outperformer for a little bit. So it seemed the market was getting real hopeful. What's wrong with these numbers? Big double-digit delivery increases.
Yeah, and this is another one that actually looked like it was poised to open higher. It was up about 4% in the pre-market, and now we're seeing a sharp decline. So it just seems like, participating in today's weakness here. I do think it's important to note, month to date, shares, even with this loss today of 5%, shares are still up about 10% this month. They were, still down year to date, but having a pretty impressive run up this month. So potentially already priced in at these levels. The loss per share of 23 cents topped or was narrower than analysts were expecting there. As you can see, revenue rose 18%, a little bit more than that, to $1.44 billion, also better than forecasts. Deliveries were up 16% from the third quarter of last year, coming in just above 46,500. Service revenue was up 91% year over year, and margins were actually better than expected as well. Gross profit margins came in at 15.3 for the quarter. The expectation was for more like 13.5 there. Now for the fourth quarter, the EV maker expects deliveries to be between 87,000 and 91,000. So that would represent a year-over-year increase of between 44.6% and 51.3%. Total revenues are expected to rise between 17 and 24% year over year, coming in at around $2.2 billion. Wall Street was looking for more like $2.1 billion at the midpoint. EV demand improving. Seems like XPeng, delivering better numbers, just not seeing that reflected in the share price today. I should also note, one thing I noticed when it was poised to open higher, it is trading above its median price target on Wall Street, even despite today's losses. So the median price target is $12 per share in terms of the consensus, and it's currently trading down about 6.5% right now, just above $12 per share, right around $12.16. So not sure if that's playing a part either, but another one we'll continue to watch.
Okay. I mean, it looks pretty good. I gotta say, especially when there were a lot of doubts about some of these companies over the last couple of years, how they're going to fare with all the competition and the China overlords, regulators. I mean, it seems pretty good. It seems like the businesses are pretty reliable and solid here. I mean, I know that there's some shrinkage in some of the margin elements, but also kind of depends which one you look at. So they're ramping up, and they've continued to. And I don't think people have like super high expectations for profitability at this point. So kind of surprised that it's coming off as hard as it is. But, it also had a rough first half of the year. So maybe some folks took profits on a little bounce the last month. We got two stories here about regulators. Let's talk maybe Alphabet first. Department of Justice wants them to sell Chrome. Interesting. I mean, did they really pull that much business out of that? It's a free app.
Well, it's a free app, but that's where they get all of their data that they use to then target advertisements, which of course is the huge portion of their revenue, something like 90% of their revenue. So we are seeing shares of Google.
It's like asking me to
actually hire.
Sell my anchor chair, and all this. Whatever I'm supposed to go, I don't know.
Just can't. You'd have to stand, I guess. But but yeah, actually, shares of Alphabet are actually higher, despite these reports that we're seeing that the Justice Department is pushing Google to sell its web browser Chrome. Back in August, a judge had already ruled that Google illegally monopolizes the search market. And now the DOJ is reportedly pushing for a judge to rule that the company needs to make some structural changes to Google's business, which could include measures related to AI and its Android smartphone operating system, also imposing data licensing requirements or potentially selling off that browser. It could also be forced to stop paying partners such as Apple billions of dollars a year to make Google's search engine the default web browser. Google's VP of Regulatory Affairs has responded that the government is putting its thumb on the scale in these ways, saying they would harm consumers, developers, and American technological leadership. So it seems like antitrust officials could be taking some additional steps to really regulate the tech industry before leaving office. I do think that's important to note, though, this case against Google actually came under was initiated under the Trump administration. So, there is some talk about an easier regulatory environment under a new administration, but it did come about under President Trump. So we'll have to see how this actually plays out. Doesn't seem to be weighing on Alphabet shares, though, today. We're seeing a sea of red here, but Alphabet actually higher today. So, we know Chrome is key to the business because of the data that it ends up, in terms of ad revenue, but they also have been using the browser to point people to their AI product, Gemini, as well. So, we'll have to see how this plays out. Something tells me we won't have any answers overnight here, though.
Yeah. All right. Well, Alphabet seems fairly innocuous. The chart right now, the response to it seems kind of ambivalent. So, I mean, it's just a really kind of bold thing to ask. I feel, again, it's such a core part of the business. So it's kind of Not sure how they're going to deal with it. I guess the market just saying that they won't have to, or maybe it'll limit what else they can do if they don't. I mean, the Department of Justice is not shy at all. Maybe they're trying to wait it out till the next admin. I don't know. But I don't know if it's going to be much better. Last one, HPE and Juniper trying to get together and trying to hope the government doesn't stop them.
Yeah, and we're seeing shares of both HPE and Juniper under pressure today. HPE off about 2.3%, Juniper off a little more than 1% today. There are reports that the DOJ's antitrust division is preparing a possible legal challenge to Hewlett-Packard Enterprise's $14 billion takeover of Juniper Networks. The Wall Street Journal is reporting that the division held a meeting with top company officials last week to kind of lay out the government's concerns. Such meetings are typically a company's kind of final chance to avoid a lawsuit. That they're often referred to as these last rites meetings. So no final decision has been made just yet, but Bloomberg is reporting that a decision on whether the U.S. will seek to block the deal could be made as soon as this week. Says the DOJ may still allow HPE's buyout of Juniper to continue, but some changes to address competition concerns might have to be made. They also say, though, that the companies may delay the deal until President Trump is in office, as his, Justice Department might be more lenient in terms of these deals. So we are seeing shares under pressure today. Also seeing a little bit more analyst activity for HPE. Citi raised its price target to $23 from $20. Kept a neutral rating on shares, but that's almost $2 higher, little $2 and change higher than where it is right now.
Yeah, all right. I can see why the market's a little bit nervous about that one, as it seems maybe a little bit more kind of, conclusive, and two companies that have a lot of competition in some giants. So Cisco, Aristanet, I mean, there's a lot of overlap in a lot of different business models. So it seems like for them it's going to be pretty important. All right, appreciate it. Thanks, Caroline. Good stuff. We're going to talk some more Walmart when we come back. Trade a little retail. Looking at the options for Target 2 ahead of the report in a moment.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
All right, let's talk some options. Let's talk some retail. Joining us, Jason Ware, partner and CIO at Albion Financial Group. We got Walmart out. We got Target on the way. Jason, you have a preference? What's the message on the consumer here?
Yeah, we do have a preference. Good morning. So we own Target. We've owned Target for a few years for our equity dividend strategy. We think Target has a good total return profile. You get a decent dividend. It's almost 3%. Juxtapose that to Walmart, which is now less than 1%. I think for investors, for folks who need some dividend and cash flow and growth of that better than inflation, Target's a good place to look. Look, Target also trading at half the valuation of Walmart. It's been a tough 2 years for Target as their margins, their operating margins got hammered down to the low single digits. That's inflecting back up. We think they can get back to 8-9%. If so, earnings go up over the next few years. And again, the stock is cheap. So lower expectations. You want to buy these things when things don't look so good. And obviously we saw with Walmart today, things look pretty good with Walmart, but it's got a demanding valuation.
Okay. The trend has been pretty amazing at Walmart, and to that point, accumulating a PE that is fairly elevated for a staple in the category too.
Apple-like PE, yeah.
Right, I guess that's an interesting question. Apple or Walmart? I guess there's supposed to be some more innovation at Apple, which would justify, I guess, a little bit more, right?
I hope so. Yeah.
Thinking about Target, then. When you look at the discretionary side, do we have the strength of the economy to power that right now, Jason? Does it look like everything is firing all cylinders?
Yeah, it's a great question, and it's an important question. It's one we'll be watching for in the Target conference call, management's assessment of the macro. Obviously, Walmart talks about this as well. And look, from our perch, we still have a slowing economy. We have a normalizing consumer, and that's certainly showing up and has shown up in companies like Target. Why Target more than Walmart there? Because Target has more discretionary as a bigger piece of their overall revenue mix, that category. Discretionary has been hit a little bit harder over the past 12 months or so. Walmart's been sailing right past that with a stable grocery business. It's like 65% of their revenues. But look, going back to the macro real quick, we have a consumer that is seeing excess wage growth come out as the labor market cools and normalizes. We've seen the excess savings from the pandemic basically drawn down, and now we have higher interest rates, which means higher costs on credit cards, and we have that normalization trend. Again, Target had 20% growth in 2021 in terms of top line, and then 15%. Big boom in spending on goods, people shifted to services, and we're still seeing that hangover effect. So macro definitely slowing, but I don't think it's rolling over.
Okay. Thinking about Target and what you want to hear from them, also on the shareholder-friendly side, buybacks, etc. What's that balance right now for them in your mind?
Yeah, I think the balance is there's three capital needs as we see it, and this has been true of Target for the past few years. One is investment in the stores. They've been not necessarily doing a rebrand, but they're refreshing and upgrading their brand. They've been upgrading their stores. There's a fair amount of fixed capital that they've needed in the business. And then going to the shareholder returns piece, they've been growing the dividend really quickly over the past 10 years. It's been something like 12-13% dividend growth, compounded average growth rate. That has slowed dramatically down to the low double digits, but low single digits. We think that picks up as some of these large capital projects roll off a bit. So buybacks, yes, the stock is cheap. Take some shares off the market, give those of us who currently own the company more earnings, a bigger piece of that pie, but also that dividend support is key. And when we look at the support of the dividend, compared to the payout relative to earnings and free cash flow, things look pretty dang good. And we think, again, that will start to drip higher in terms of the growth rate back to the mid-teens.
Yeah, okay. When you look at the potential growth, the people going to be drinking while they shop, maybe that certainly helps. You hear that story? They're going to start to open up some bars in Target, get a little tipsy, and push that cart around, baby.
That's not part of my bull thesis. We'll see how that goes.
There you go. I'm adding another piece into it.
Yeah, right.
Appreciate it, Jason. Thanks for the thoughts.
Yeah,
a quickie here this morning. Appreciate that. Good setup in a Target. How do you want to trade it, Tom?
Oliver, they already have it in Mariano's and Whole Foods here in Chicago. You can grab a glass of wine and walk around the shop.
That's a grocery store. Target's, I guess a grocery store too.
Yeah, exactly. Implied volatility levels elevated in the near-term options due to that earnings event. Option markets pricing about a plus or minus 8% move in the shares. As Jason mentioned, it's underperformed severely, only up about 10% so far this year. So underperforming Walmart and a lot of the other big box retailers. So I looked at a strategy that takes advantage of a move higher, giving myself a little bit of duration, but taking advantage of the different levels and implied volatilities to lower my risk on this one. So going out to the December monthly option series, so 31 days expiration, I'm going to buy the 155 strike call. It's basically at the money. And then in the near term, November 22nd, weekly options expire in just a few days here on Friday. Sell the 170 strike call. So a bullish $15 wide call diagonal to the upside. I'm paying roughly about a $6.50 debit for that. Probably closer to $6 now. Stock has pulled back a little bit. But that debit I pay is going to be my risk. For a $15 wide call diagonal, that's a pretty good price. And why is that price lower on a $15 wide diagonal? Is because I'm buying about 47% implied volatility out in the December monthly options that expire in 31 days on that 155 strike, selling about 120% implied volatility in the near-term November 22nd 170 strike calls. So that's, if I pay $6.50 for this, my break-even is going to be about $158 to the upside, less than 2% above the current share price in there. And then I'll get that ability as we get closer to expiration to roll or adjust that short 170 strike call on a week-to-week basis that collects credit, increases potential profitability. But the key one with this type of strategy when you're picking diagonals is try to get that dispersion between implied volatility levels, because that's going to lower the input price, which is your risk on this trade. Whatever you pay is going to be your risk. Whether you're bullish like this example, or if you're more bearish, you can buy a put diagonal. I think the key is the strategy taking advantage of the implied volatility levels within this call diagonal.
Okay. So buy the 155, sell the 170. You're in the money on the one that you own already. Yeah. So you've got immediate upside, and then you will get capped out, but it helps you limit your downside.
Limits your downside, and you have some roll or adjustments on that short call. As you get closer to expiration, you can roll it, collect credits, reduces your risk, increases potential profitability.
Well, okay. Fair enough. Target down a little bit, going into the earnings. A little upside there. Thanks, Tom. Coming up, we're in hour 2. We're going to talk a little crypto and policy, how the two meet, and what framework will be built by the incoming Trump administration. Some ideas starting to percolate with potential combo. Be right back.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on Next Gen Investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Of our show here, 30 minutes into the session. Stock's still under some pressure, but we are up off the lows a little bit. We got some more fun stories to get into over the next hour, including reports that DJT, the social media and Trump holding company, is interested in buying a crypto trader. So that's a little fun one. We'll talk about that in a sec. We're going to be joined by John Kosar for the Asbury 6, getting a read on the technicals from a bit of a local market wizard. Chart Masters taking a look at Palo Alto. A pretty good stock, but needs to have some earnings live up to the expectations. Trading just below $400. And with report right around the corner, Palo Alto's a fun one to look at right now. We're also going to be checking out TJ Maxx after a little retail pop this morning from Walmart, not translating into TJ Maxx, which is down about 1%. Maybe the Route 60, what is it, Route 77, Walmart closed, maybe biting into TJ's lunch. I don't know if they still call it that brand. I got George Tillis joining me for a look at the market here. Session underway is improving, George. We're pretty well up off the lows now. What are you looking at?
Well, I'm looking at every sector. Looks like to the downside. We're actually seeing materials, healthcare, financials, the worst performers out of the S&P 500. I think it's an interesting day so far. Maybe it's a reversal day, contingent upon what we're seeing in the markets the last few days. We're in a mini correction at the very least. Obviously, that's the case. We're seeing a little bit of a bid back to gold. This was yesterday. Bitcoin's moving to the upside, and if you take a look at the VIX, it's actually come down quite a bit, but we're sitting around 17 right now. Heating oil futures and crude oil futures are also trading higher. I noticed that some of the defense stocks, which really took it on the chin last week, are catching a bid. Booz Allen Hamilton, if you look at GD, which is General Dynamics, those two stocks are trading to the upside.
Okay. The few that are winning here, hey, look at Walmart. Just unstoppable, trading 87 bucks. That's still what stands out to me. Nvidia's up too. So a few key components that are working. Maybe it was sort of a geopolitical risk-off bid. Bitcoin bounced back positive. Bonds are letting up a little bit. Dollar's still firm, but bonds coming off a little, so yields inching higher. Maybe a little early morning scare that we can get over.
It's possible, OJ. We see this all the time. You know, considering what we saw after the election, I'm not surprised to see a pullback. I mean, there's a lot of expectations that were brought forward in just a few days. A lot of profits were taken, but now we're going to see the reality of, you know, earnings, valuations, macro. I think the narrative maybe around the Fed not cutting rates coming up in December was a little bit overblown. I think the probabilities now are plus 60 or so percent. They dropped all the way down to below 60% probabilities just a couple days ago, or actually yesterday. So I think they're still going to cut rates. So I think that's a little bit overblown. If you look at 2-year yields, they're actually trading back down about 4.25. So they're suggesting that, you know, that policy rates will be accommodated coming up in December. I think going forward after that, there's probably going to be, at the very least, a pause early next year and a reassessment. Because I think the Fed is also going to be paying close attention to what's happening from a fiscal and, of course, executive branch and congressional policy. There's also the budget. We have to keep that in mind. We've been operating over the last year under a continuing resolution, and it's up for renegotiation on the 20th of December. So I think that's an important date to certainly keep in mind.
Okay. George, thinking about the overall path for this week. Bonds interesting to you? Give me a quick macro thought, because last week there was a lot of attention on rates. So far, it's actually been reversing a little bit. Bond bulls have shown up, but I do wonder if maybe that was a little geopolitical bid and if bonds will fade. If stocks can.
Well, I think it's a good question. It's a good point to bring up, actually. You know, there's some defensive posturing taking place with bonds, the long bonds being bid up and yields just softening a bit. Obviously, we're still stuck within that, 25 basis point range on the 10-year between 4.25 and 4.5. I think 4.5 is a sort of a critical pivot point. If we break above that, we may be seeing some additional inflationary pressures. I think the housing price issue is still a concern. If you just look at housing starts, 1.3 or so million housing starts, that's significantly below historical averages. You just go back to the 70s and 60s, I'm talking the decades of those years, and we were at 2 million plus housing starts. So this is a very low number. I think this is an issue that's going to be of concern because it is imputed in core CPI and the CPI numbers, and so I think that's going to creep or continue to cause inflation to creep higher because I don't see any alleviation in the housing market at the very least. And if we get an additional bid in energy prices, crude oil, I know heating oil, natural gas, I think we talked about a couple weeks ago, it's been very volatile but trending to the upside based on seasonal factors. And, that could also play into some of the non-core inflation prints that come up in the next couple months.
All right. Good stuff. Good context on housing too, George, as the home builders have been under some pressure. Home improvement stocks at a 2-round lows, so some insight there. Appreciate that. Let's go to Jeff Pierce. What do you get when you combine social media with crypto? We might find out with Trump media's interest apparently in a report for Backed, a ICE-owned or invested in at least, I believe. Take us through it, Jeff.
Yeah, you're right. We might find out more. As we know, Trump has been, very interested in crypto as part of his campaign, and now it looks like he might be advancing those interests as he's reportedly in advanced talks to buy the crypto trading firm Backed. According to the Financial Times, they're looking at an all-share purchase of the company. The news caused the spike yesterday, but has since cooled off a little bit, lowering in trading this morning. Backed said in a statement that they're aware of the buyout rumors, but declined to comment on any sort of market rumors. And so far, we haven't heard anything directly from Trump Media or Intercontinental Exchange, which actually owns 55% of Backed. Donald Trump, as I said, has shown interest in crypto, including launching his own crypto venture in September, the Worldwide Liberty Financial. The Trump campaign has said that they would make the U.S. the crypto capital of the world, and we've seen the broader crypto sector move higher after his win. And Trump has previously said that he would appoint a Bitcoin and crypto presidential advisory council, which would design some more regulatory guidelines around that industry. So this isn't a big shock. We are seeing the stock move up yesterday and then, of course, pull back today. That might be in part because investors are wondering whether or not this is a good idea, considering the state of Trump Media after we saw their Q3 filings. It also might be that this has just been a very volatile stock where you see traders really trading in and out of it to try to take advantage of that volatility.
Yeah, it's still unclear kind of what the plan is, what the product is, but it seems like the seriousness is there. If those were for those who were doubting, maybe that it was just sort of like an appeal without backing. I mean, this is literally, I guess, pun unintended, kind of filling in some of that expectations with some reality and some actual, evidence, empirical evidence.
Yeah, I mean, if you look at what we've seen from insider selling, there's certainly been some concern, but Trump himself seems to, emphatically say that he doesn't plan to sell a stake and he's going to maintain his kind of majority ownership standpoint here. We know if we look back at that report in Q3, the company's reported about a $363 million net loss for the first 9 months. That includes a Q3 loss of about $19.2 million. Revenue fell about 6% year over year, coming in just above $1 million in Q3. But the company said they have about $673 million in cash available. All the company's revenue right now comes from advertising, so the True Social platform is really where they make their money. Of course, that could change if they continue to dive into crypto, but that remains to be seen. As for Backed, they have had quite a few issues over the last few years. We've heard them talk about possibly selling, possibly breaking up the company. They've also said that they might, just wind down their crypto custody business, which, according to reports, is a part of the business that Trump Media does not want to include in the deal. So that all remains to be seen. But yes, it certainly looks like this company is diving further outside of just their True Social advertising. Whether or not that's going to drive revenue in the long term is, I think, a question mark for investors. And again, that might be part of the reaction we're seeing here today.
Okay. All right, good stuff. Shares down a little bit here, but this is a volatile stock. What's 7.5% between speculators? Thing is, a little bit frustrating for sure. Given that I think a lot of folks are trading as sort of a proxy. But if DJT struggles post-election, then any Trump trade can struggle as the one with the actual literal initials on it, is going to have some major fundamental development to justify $30 shares. Okay, thanks, Jeff. Appreciate that. Let's trade it. Tim Bigham joins us this morning, option strategist to buy alerts. And Tim, it seems like even after the drop today, you might be interested in fading it further.
Yeah, absolutely. You were talking earlier on your Target conversation about having drinking available while you're shopping. If you're trading DJT, I think you need to be drinking while trading this stock with the movements on it. It's beyond almost belief how much it swings here, and it's reflected in the implied volatility. IV, especially in the shorter term options, still well over 200. So this is a stock that you absolutely, I think, unless you have a very committed directional viewpoint, take advantage of just really rich option pricing. So I'm just going out and selling December 6th, giving myself a little leeway and a little more hedging room if I need to, selling the December 40-42 call spread. Somewhere right around here is the best way to say it. The prices fluctuate greatly, but certainly getting somewhere, around, 40 to 50 cent range list. I looked here, so I like the risk return there. The stock did have a couple forays up towards the 40 level, but got met with concerted selling, to say the least. So once again, I think on these kind of news event plays, I think it's always good to kind of fade any sort of over optimism. That's certainly the case with DJT stock generally. And plus I have, this week's and next week's to hedge in case the stock does rip up towards that 40 level. Take advantage of really inflated implied volatility as well there.
Yeah. Bottom line is, this thing is so juicy that you still, with sell-offs, have a good bit of volatility to toy around with. It's not a cheap trade from a vol standpoint.
Yeah, absolutely not. I don't think that, it's going to go ripping to the upside. When the news kind of came out on Backed and the crypto kind of pop, the stock, ripped huge, and now it's starting to level off here. We'll see what ultimately becomes of that, right? And certainly it's going to take time for it to have any meaningful effect. So I think taking advantage of, really overinflated short-term vol, and I'm slightly bearish on DJT just as a name, but I'm giving myself, over a 30% upside cushion for a few weeks here, so don't mind that. Define risk, 2 points wide, risking, less than that because I'm getting a decent premium for some of that spread as well.
All right, so fade the upside. Don't.
Every chance you get, really, I think, on this name, it's been proven, to be a winner. You do have maybe some short-term angst, but it doesn't last too long. It's kind of like, the VIX, when it gets that pop towards, the 50 or 60 level, never really lasts too long. Same kind of idea here with DJT. You might get, a quick pop, but we're really not seeing it lately at all. And I think the options are overpriced, given that I think the stock will be relatively contained over the next several weeks.
Yeah. About almost 3 weeks, not quite, a little less than 3 weeks away with the December 6th expiry. Selling upside, okay, thanks, appreciate it. Selling the upside spread, Tim Bigham, option strategist, buy alerts, fading the bullish potential of a crypto tie-up with Trump Social. Let's look at levels, technicals, and charts with John Kosar when we come back. Asbury 6 discussion on a day with stocks under some pressure. Always helpful to get some technical thoughts on the intermediate trends. Be right back.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Stocks under a little pressure, but finding some buying since the opening bell. Let's look at the charts, the indicators, and the Asbury 6 with John Kosar, Chief Market Strategist at Asbury Research. Good morning, John. How are you?
I'm good. How are you? Good morning.
Pretty well, thank you, sir. Stock's been kind of drifting a little bit more sideways to down than up in the last week compared to the week after the election. So it looks like your overall assessment is kind of just reflecting some of that neutrality, maybe?
Yeah, from a really tactical basis. The last time I was on, what I did this morning is I went back to see when I was on last, and it was October the 16th. And you actually made a joke because I had a green Asbury Research shirt on, and you said, was that a good sign? And I said, yeah. I think we ran up 3.5% since then. And now we've kind of backed off a little bit. And our metrics, our Asbury 6 is 3 and 3. And 3 and 3 seems ambiguous, but it tells me a lot. If you look at the market, first of all, for those that are not familiar, these are 6 tactical metrics, some of my favorites throughout my career that we back tested, and we look at them. They're pretty disparate, but we back test them and they work really well together, meaning if 1 or 2 give a bad signal, the other 4 tend to pick it up. So we're 3 and 3 right now. The way I look at that is the market's in balance from a very tactical monthly basis. So at that point, what I usually do is go to the chart and see if I can kind of assign a support level that will go along with that 3 and 3, and we're going to look at that one in just a minute. But yeah, so we're in balance right now. So that means tactically, this is where the tactical uptrend needs to re-engage if it's still good. So we should see this Asbury 6 start to go 4 green, 5 green, 6 green between now and the end of the week, early next week, to indicate that. If we can't get off the dime here and we start going 4 red or 5 red, that indicates to me that the market is internally weak enough to now start breaking some support levels and maybe even start a correction.
All right, this is fun. This kind of gives us, this kind of puts us on our toes, waiting to pounce for when we get some directional clearance, some real indication. John, the thing that stands out to me, rate of change, which went negative, kind of follows some of the price action. But the things that are still positive in terms of high yield bonds, flows, VIX, a lot of stuff there that seems to reflect a good bit of sentiment and willingness to spend right now by folks.
Yeah, of those 3, the one that tends to be the most sensitive is the VIX. Okay. So that's the one that we're watching. I actually brought a chart of the VIX too, just because that will be the one that kind of gets us over the line, either up or down. We'll take a look at that in a little bit. I don't handicap these or weight them in terms of one being any more strong than the other or any more influential than the other. We picked them because they back tested well together as a set, and because they're all different. There's only one there, that's the rate of change in the S&P 500 that directly has to do with the price of the S&P. The purpose of this thing is not to get caught chasing the S&P 500's tail when it's up 50 in the morning and down 50 in the afternoon, but kind of rather watch the market under the hood so you don't get faked out by a lot of these choppy moves that are, at the end of the day, they end up just being noise.
Yeah. All right, let's look at the S&Ps. Let's start with SPX. We've been kind of monitoring that post-election gap. You're looking for support 58.78 to 65.
Yes. That 58.78 to 58.65, that is the October 17th high. That's the previous high. It's the second. If you're looking at the right edge and moving in, that's that second most high peak that we made. That's the October 17th high, 58.78. And 58.65 is the gap that we had post-election, that big 130-point or whatever it was gap opening in the S&P 500. And that's, so I talked about the 3 and 3 in the Asbury 6. That's the support level that I kind of marry to that. And so if this support level holds this week and you start seeing the Asbury 6 go 4 green, 5 green, 6 green, we've held the support. This is very good. If you're a bull, the risk reward here is great, right? Because you buy here and then you wait for the A6 to tell you if the internals are okay. And if we break down through this support, you're risking just a minuscule amount to have open-ended upside. Well, open-ended as far as maybe going into a Santa Claus rally or some strength in the beginning of the year. But that's how I marry those two. If we break 58.65 and the A6 goes to 4 or more green, 57.80, we don't see it on that chart, but that's the 50-day moving average. That's about another 2% below where we are right now. That's what I would call primary minor support. If we break 57.80, now we've broken what a lot of people look at as being kind of a minor trend proxy, let's call it. And then that would open up the door for another couple of percent lower. We've got some more support around 56.50.
That's the old high from the summer.
Yes.
That 56.70-ish area, 56.50, 57.80, basically your 50-day moving average. And so I see the point where things could get pretty gappy to the downside if we don't basically kind of hold that post-election October gap around that 58.65 at the low. So you kind of get some chunky moves on the way down. So I guess then if we do get a meaningful pullback, the one you really got to hold is that July high, that 56.70, because then it's like, boy, something ugly must be happening then.
Yeah, I mean, there's a lot going on in the news, right? You know, there's a lot of the market hates a decision. It hates when it doesn't know what's in front of it, and there's a lot of speculation as to how we're going to begin this new administration. And so, you know, there's the horsepower in there to make this thing a little sporty here over the next, 4 to 8 weeks. There's enough newsworthy stuff out there that could make the market a little jumpy. But in my mind, nobody knows what the future is. The next best thing to knowing what the future is knowing where the inflection points are. And this 58, let's call it 58.70, right? It's right in the middle of those two numbers. 58.70, watch the internals. That's going to tell us if we get one more leg up out of this thing, or if it's tired, we're going to go into some kind of a sell-off.
Okay. Viewed through the lens of VIX to come back there, 13.5 at the lows, 16.8 right now. We're going to pull up a 3-month chart on TOS here, which is close to the one that the time frame you're looking at as well. For volatility, John, where are the trigger points and levels on your model?
What I'm looking at, and the VIX is part of the Asbury 6, by the way.
Yeah.
So what I'm looking at is the 21-day moving average in the VIX. It's currently, well, through yesterday, it was 1802. So it's right in that neighborhood also today. We're under it now. If we get through it, you start seeing the VIX up above 18, not for half an hour, but for a couple of days. That's going to indicate tactically, very short term, that the market is starting to get a little nervous again, and that would likely be, if we do get the bear scenario and the Asbury 6 starts to turn progressively more red, the VIX is likely to be the one that starts that process. So keep an eye on 18 even in the VIX. Below it, the market's cool as a cucumber and we're fine. The more time it spends above it, the more the market's getting a little bit nervous, and that could be a precursor to some kind of a sell-off here into Thanksgiving.
All right. So monitoring VIX and its relationship with S&Ps. Love the levels there. Very helpful for us. Sector-wise, give me one thought there under the hood. John, you got a favorite group right now?
I've got a couple of sectors that one of our models, you have the graphic, it's called the SEAF model. It's a sector rotation model that measures the velocity of money moving around the 11 sector spiders in 3 different time frames. And the 2 that we've been overweight since the beginning of the month have been financials and consumer discretionary. Both of those have outperformed the S&P 500 by about 5% since our model gave the overweight signal on those, and there's more room. They're very strong. There's a lot of asset flows that have rushed into there over the past 2 to 3 weeks. So those are the 2 that have been making us money, and this is rebalanced once a week. Our latest rebalance shows these 2 sectors are still getting a lot of love.
Okay. Nice. All right, like it. So still some positive flows coming through into some key areas there, and ones that reflect a pretty positive economy too. Consumer, financials, those are pretty cyclical in nature.
So far, so good. You know, I try not to forecast, but read the data, and the data suggests if the uptrend's still good, we should re-engage this week. And financials and consumer discretionary are getting a lot of attention.
All right, we'll watch for the rate of change for S&Ps, volumes, market breadth to improve. Thanks, John. Always
good to see you.
Thank you, sir.
See you next time. Thanks.
John Kosar, Chief Market Strategist, Asbury Research. All right, coming up, charts for tomorrow's earnings. Palo Alto, TJ, Williams-Sonoma. Got a few retailers in there. WSM actually the best performer right now.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network. Let's look at some charts. Let's get ready for earnings. Kevin Green joins us for the technicals. Jenny Horn in the studio with me on the fundamentals. We got TJ, Williams-Sonoma pre-market, and we got Palo Alto post. So we'll go with the retailers first here. TJ Maxx, Jenny, you just dropped a great stat on me. What is it?
It is that TJX, in terms of its market cap, is more than double the size of Target, which reports later this week.
Wow.
I think that's astounding. And also, I mean, like the fact that I was really noticed this because I was looking at store locations, which now in the past quarter topped over 5,000. And I was like, wow, I just didn't realize how large TJX was.
Mm-hmm.
And like relative speaking, even like incomparable to Ross, Dillard's, some of these other discount brands. So I didn't realize its reach, which I think that makes it kind of more and more so a compelling story, especially considering we're only about 3% from highs.
It's the king of discount, TJ, the Maxinistas. Yeah, Ross is, you know, come on. All right.
Just for less, I guess, but
135 billion market cap right now for TJ.
yeah, and that's impressive. We're expecting also revenue of just shy of like 14 billion, which would be a healthy 5% growth year over year. Earnings per share also expected to rise about 6%. But what we saw last quarter is amazingly they've been able to deliver comparable store sales growth of around 4%. That's been able to beat. They also did see that their strongest segment was their main Marmax, which reported comp sales growth of 5% year over year, which was actually accelerating their growth. So international results were somewhat on the weaker side. We are still seeing this like expansion slowly into Canada as well as overseas. Australia is one of their developing markets, but they did note that they're expecting more of this softness to continue in their European business last earnings call. But also, they've been able to continue to grow their margins. Gross profit margin last quarter improved to 36.5%, up 68 basis points from a year ago, thanks to this 20 basis point improvement in quarterly gross profit. And they've also been able to do all of this without major discounts. So I think that also is really reflective of a healthy consumer. And last quarter, we did also see that they announced this deal with Dubai-based off-price retailer Brands for Less that's expected to continue to help their international exposure by giving them an entire reach into a new region. So all this to be said, I fairly was impressed with TJX this morning. I mean, growing internationally, I think because they've closed down in some of these major cities, like the TJX I was familiar with closed years ago, and they began shedding like Home Goods, for example. But hey, I mean, as far as like what's working, it still remains to be seen. It's like they've done a great job controlling costs, finding what works for consumers, and they said they're poised very well into this holiday season. So I'm excited about this report.
Heck yeah. All right, TJ usually doesn't let down, and it's been growing a good bit, and efficient growth too, the right stores and such. You know, we went from $53 now 2 years ago to 118, steady and up and to the right. Chart-wise, KG, any sign of slowdown in TJ's momentum?
Maybe a little bit of a pullback here if they do kind of miss or maybe even exceed, match the street's expectations. You have a little bit of a sell the news, but the overall trend is obviously bullish here, Oliver. We can kind of start on the one-year daily chart. We're in this expanding megaphone pattern, which means that it is in an uptrend, but we also could see a little bit of volatility. The upper end of that channel, that resistance zone, has been intact for the better part of this year, and I would say that it's probably going to continue to stay intact. But we also have to be mindful of that lower end of that channel too, which kind of briefly touched that 200-day moving average, but it has since diverged from it. So right now it's a little bit in a consolidation pattern. You can see maybe a little bit of a bull flag, but we did see a brief breakout. Maybe we come back and retest that 20-period moving average sitting at $116.15 there before trying to move up higher. If we do see more of a breakdown, 112 is going to be your next area of support, and if not, the 200-day moving average sitting at 107.45. What is potentially going to be bearish in the near term, and I'm not saying a massive correction, but a little bit of a pullback, Oliver, as the RSI did hit overbought territories, pulling back here a little bit, and MACD does look like it wants to hinge a little bit lower. The 12 is still above the 26 EMA, but that hinge is something to keep on the radar. If we do see the completion of that, we probably also are going to see that coincide with a pullback to the downside here. But once again, this chart is ultimately bullish. If you're looking for a breakout move to the upside or a continuation, 125 is going to be your next area of resistance.
All right, nice. Zooming in, definitely shows a little bit of a shift in some of that momentum, kind of a failed breakout above that 120. Weekly still looks pretty good, but yeah, the chart definitely leaves plenty of room to be desired for upside, given the kind of failure to extend past 120. Nice, all right, good eyes on that. Williams-Sonoma, kind of a fun one, Jenny. We've had some pretty volatile earnings in the last year for this one, but I don't know, the chart's weird. Tell me about the fundamentals. What's the situation here? Because we just saw that some of the warning from housing maybe was a little bit slow.
I mean, but somehow, though, this name to me is almost like an RH, different obviously, but in the sense that like the price points are so high, which I know all too well. I mean, I'm a huge fan of Pottery Barn, which is one of their several brands, but like West Elm, Pottery Barn.
I like to walk through and like imagine what I could get at these places.
And like imagine that your house actually
if I
looks
cared
like
enough
that.
to pay $300 for a lamp.
Yeah, see, unfortunately though, every now and then I do, and then I'm like, it's not to say that it's like higher quality than other products you're getting, it's just something about it. It's
Looks
like
good.
you walk in, you go into the storerooms and you want your home to look exactly like they had. It's brilliant. This company's though revenues comes 96% from the U.S. So if you are a believer in then like the weakening story overseas, I think that you'd be thankful that they're primarily here domestic. Well, what the story has been is that underlying demand does still remain relatively, I'd say, bumpy as far as like we saw a revenue contraction last quarter. We did also see that right now there's still fairly high expectations for this continued recovery that the pessimists of this name are saying may not materialize. Its current valuation at around 16 times its forward PE is also pretty optimistic. When we're not really expecting like huge growth this quarter, they did lift their outlook for operating margin. They expect that this quarter to fall between around 17.6 to 18%. That was above prior expectations, but they affirmed their full year revenue guide between a 3% decline and 3% gain. I mean, that's a really wide margin to give. So that makes me say there's a lot of uncertainty into this report because either we could see a 3% drop as far as revenue, or we could see a 3% gain. I mean, hugely different numbers. I tend to think that usually when you give the wider goalposts, it's because there is that degree of uncertainty.
Yeah, definitely.
I mean, I'll talk about a name that should benefit from the ramp up into holiday spend. I mean, this is like what I get some degree of my mom's gift every single year.
Right.
But I
Some
do
degree of the gift? So there's multiple gifts, or it's like a piecemeal gift?
It's like a piecemeal gift.
Okay.
But she's a Pottery Barn enthusiast as well. But I also think, yeah, when you widen your goalposts, it means that there's some things you're not certain of as a company, and that's the best read I could give for a company that is, to me, definitely more in that high-end consumer as far as retail.
Definitely. I like that. It sounds like also when you've got a wide range, you've got potentially a wide range of volatility and outcomes. Kind of a choppy chart. KG, is there an obvious trend here, or is it just chop?
Well, I would say it's a consolidation of time here, Oliver, when you're looking at the Williams-Sonoma chart, especially on a one-year daily basis. But you are seeing a little bit of a breakdown. We actually had that nice little pop to the upside at the latter half of last year, pretty much up until April, and we've been range-bound ever since. That initial channel was sitting between $162 on the upper end and sitting at around $135 on the lower end. But we have seen a little bit of a step down, making relatively lower lows and making lower highs. Now, it's not aggressive, so this is kind of a descending type of wedge pattern that is developing right now, but for the most part, it's still kind of bearish. But not too bearish, if we can have a degree of bearishness right now. But the 130 level has been able to hold. You want to continue to see that hold if you are a bull in this name. And you can see an area of resistance in the near term at the 200-day moving average, which, once again, this kind of shows you the consolidation of time. As price has not really corrected to the downside, the 200-day has now finally caught up with the stock price itself. You want to be able to break above that 200-day, try to retest that upper end of that wedge pattern, which is going to sit at around $150, and then break out. Any further breakdown, though, Oliver, I get a little bit concerned. You could actually see maybe a reset and going back to that yellow block area. That's where we see a fair amount of volume on this chart. That's sitting in between $96 and $106, if you will. We're not there yet. I wouldn't get too concerned, but there is something that's on the radar. Last but not least, bullishness on the RSI did make a relatively higher low, trying to reset itself. MACD did actually cross 12 above the 26, still below the zero line, which is not the full bullish sentiment yet, but something that is optimistic if you do believe that the name's going to move to the upside here. So consolidation, somewhat of a bearish tilt, but it's holding up.
All right. Like that. Holding where it needs to. Find a little support, little line in the sand there. Kind of a deep gray line in the sand. All right. Also, love that is right where the inflection point from that earnings in the first quarter really sent it and to kind of a new level, but then has come back down. All right, Jenny, last one here. Let's go tech. Let's talk Palo Alto. coming into it after just making fresh highs. We were above $400 about a week ago.
So this company is really interesting. If you do just like a brief search on Google, you will find that platformization is either the greatest thing that happened to this company or the worst. And you get two different sort of trains of thinking. Basically consolidating 30 to 40 of these cybersecurity tools into one platform, which their CEO announced at the beginning of this year that they would be ramping into it and speeding up that process, which a unified platform could produce a more efficient operation than competitors, but also did raise some concern skeptics really said this consolidating point products show that they could potentially create a slower path to achieving their goals. And we've seen, to speak to that, we've seen the pace of revenue growth slow since mid-2023, while also we have seen more and more of their gross margins really trailing off since the beginning of this year. But I think the stock's resilience shows that over the long term, there's still a ton of faith in this company, despite maybe some short-term pain of growing and becoming more of this player. Also, I think it's interesting the cybersecurity space is so highly fragmented that no single company right now has double-digit % market share. Palo Alto actually leads, it has 9%, but then you look at its peers like Fortinet 7%, and Microsoft 6%, because the industry basically operates in which they're piggybacking off of each other's innovations, which I just didn't realize. So platformization, I think, is huge if you're a believer in the long-term, more patient strategy, but some say it doesn't give that short-term growth that they're desiring from the Palo Alto network.
Okay, so maybe a little bit less of a punch, but at least now pretty consistent in its profitability, kind of getting a little bit more of a mature cybersecurity play. A KG chart-wise, technically, what about that little pullback since the high?
Yeah, the chart is really constructive here, Oliver. Obviously, we had that breakdown in February where the stock just dropped like a rock after their earnings announcement and their guidance kind of moving forward. But ever since then, it's actually been in this ascending channel. What's actually nice about that drop, though, is that we came back, tested the 200-day moving average, tried to bounce higher, came back, tested the 200-day again. Then we started getting into that trend, that channel line there. And every time that we go back and test that 200-day moving average, buyers step in. And that's really what's really optimistic. Now, we did actually hit the upper end of that channel, which is an area of resistance, did see a little bit of a pullback, trying to hold that 378 level, which was the initial breakout that we saw in February, that before the breakdown. And so you want to be able to hold these levels. Also trying to hold the 20-day moving average sitting at around $377. And then it would not be out of the ordinary for us to come back and retest 365. That would keep that channel intact, which is also bullish. If we do be at a breakdown, the 200-day moving average sitting at 325.70 is going to be your line in the sand, and any breakdown below that is something that the bears probably would definitely cheer on here. RSI still bullish, making higher highs, making higher lows. MACD trying to cross on an immediate basis, so we might see a little bit of a pullback. But this chart is bullish here. This is actually more constructive than what we saw this time last year, where we might have moved up a little bit too far, too fast. Valuations were really lofty, and I think the executive team did a really good job of trying to reset expectations, and it now seems like they have been able to right-size analyst expectations as well, and the market's really trying to reflect that when it comes to the price action.
All right. Pretty good long-term chart, pretty good short-term chart. It seems like there's a lot to like in Palo Alto, frankly, technically, especially compared to even to the other two, the strength of TJ Maxx, which had kind of slowed down the last quarter as well. So I think best-looking chart of the three. Appreciate it, KG. Thanks, Jenny Horn. When we come back, a little check-in on the market, talk a little that Walmart story, check in on the consumer. Speaking of investors, market participants engaging this morning, buying dips.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades a full hour of trading insights.
I'm Tom White.
I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Morning Trade Live. Let's check in on the session. We're going green right now. Caroline Woods joins us from New York. Senior markets correspondent Dan Grant, senior specialist retail trading here in Chicago with me. Things have improved this morning, Caroline. We're positive in tech and the NASDAQ. Everything but Microsoft is up.
Yeah, and Netflix is up too. So Mag 7 plus Netflix minus Microsoft helping the NASDAQ to turn positive, just barely above the unchanged line right now. Dow still lower despite Walmart being the best performer there. That's being offset by some weakness in Sherwin-Williams and Home Depot, likely after Lowe's earnings. The S&P 500 lower as well. It seems like staples and tech, the only positive sectors there. But do think a big takeaway today about the consumer after hearing from Lowe's and Walmart is that they're delaying those big ticket purchases at Lowe's, which I don't think was a huge surprise after earnings, or I'm sorry, after Home Depot's earnings, but they continue to shop at Walmart. And some of the commentary from Walmart on the consumer is still pretty positive, saying U.S. customers remain resilient with behaviors largely consistent over the past 4 to 6 quarters. They continue to seek to maximize their budgets while also choosing convenient options to save time. And they actually talked about how they're willing to pay up for that convenience, and then seeing higher engagement across multiple income cohorts. But again, particular strength in that higher income cohort. So really able to capitalize on that. And I think the big question for Walmart was, is the bar too high given the fact that it was so close to all-time highs, given the fact that it was up more than 60% year to date, and Walmart able to build on those gains today, up almost another 5% today. So that's a big winner today. I will note that we are going to hear from TJX, Ross Stores, Gap later this week. All are lower heading into those prints, so maybe not as much optimism around the non-staples kind of area. But Walmart did say that consumers are spending more money on discretionary items as well. So overall, pointing to a pretty resilient consumer, just not necessarily one that's buying a lot to improve their homes.
Consumers are buying basics, and traders are buying stocks, Dan, and they're buying bonds too this morning.
Flight to safety on the bond side, apparently. Global, some global risk out there, some geopolitical risk. I thought it was kind of a muted response by crude this morning, like almost no response, right?
Almost, yeah.
Might even be higher right now.
Crude's down right now.
Crude's still down. So.
And gold 0.5%, that doesn't seem like a nuclear disaster to me.
It doesn't. So maybe they're just discounting it. Maybe it's a lot of hyperbole, right? Maybe it's not my thing to talk about.
Sure.
But I'd like to talk about bonds.
We appreciate
right?
that. Me too. So that's why I like it.
Bonds are down, and people still are parked in money market funds, right? So we have rates all the way down to what, 440, 450 for the 2-year note, right in that area, compressed yield curve, and people are not leaving money market mutual funds. They have no risk appetite right now. Why would you pull money out of a money market mutual fund and put it in the stocks? Yes, you have a chance for a better return on stocks.
Right.
But
well, that's kind of where if rates go any higher, then you might start to detract from equities a little bit.
Rates lower, you mean, right?
Or interest rates higher. Bond prices lower.
Yeah, bond prices lower. But I don't see anything getting the market to really change its dynamic right now. We're continuing to have a normalization of the curve. 30-year bonds, king of all nations for yield, is well it should be, right? Demanding more yield for longer term duration.
Next couple days, do you think anything moves the needle on bonds for the economy?
I don't think so. No, I really don't.
It's kind of slim pickings.
I mean,
right?
Does the Treasury Secretary matter when they're picking the Treasury Secretary?
Possibly.
I've seen some names out there.
What about the 20-year auction?
20-year auction, I don't have an opinion.
Nobody trades a 20-year.
No, it's not a well-participated thing.
Yeah, fair enough. Okay. Fed speak this week, moving the needle at all?
What are they going to say? What's the needle? Like, are they going to talk about the? Are they going to take off that? Are they going to take off that rate cut?
Yeah.
I don't think so. I think the market needs it. I think the market wants it. There's Schwab put out something that the nominal rate, the real rate's right around 3.5% to 4% for rates right now.
Okay. So, all right. I think that the point there is that the rest of the week fairly muted on the economic side, which leaves us NVIDIA, Caroline. We still got one more big one this week.
Yeah, and Alex Coffey says he thinks it's the last really big event for the markets this week. So, and we're seeing strength in NVIDIA heading into that print. So, that's obviously the big event tomorrow. I do want to go back. Obviously, this could eventually impact rates and such in terms of inflationary pressures. But just to bring it back to tariffs really quickly, because something that was discussed on the Lowe's earnings call wasn't discussed on the Walmart earnings call, but there was a CFO interview on CNBC where the Walmart CFO basically said that he's concerned that they will have to raise prices for consumers, something that they don't like to do if those tariffs are imposed. Lowe's did say that it's still early on, but they're preparing internally for those tariffs. So something I think that's important to watch and something that we'll continue to see play out. And potentially, obviously, we'll see if the Fed has to field any questions about that as well.
Absolutely. Last time Jerome Powell's pretty good at dodging questions. Thanks, Caroline. Thanks, Dan Grant. Good thoughts there to close out Morning Trade Live. Thank you for joining. I'll see you from San Francisco at Schwab Impact the next 2 days. Have a great session. Good luck. I'll see you tomorrow morning.
Join me, Oliver Rennick, alongside Schwab Network's options experts as we explore the second derivative. Gamma On is a brand new limited series to take your trading skills to the next level. Subscribe to Schwab Network's YouTube channel now.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
90 minutes into the trading day. Welcome to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. We have a big show for you today. We will spotlight and take a look at investor sentiment after the election with Caleb Silver from Investopedia. He has a lot of details. Salesforce is our disruptor as the stock gets a bullish call. And our panel taking a look at the latest housing data, why mortgage rates not falling necessarily, and the outlook for those home prices. In the meantime, stocks are up off the lows. We did have, obviously, accelerated tensions. Russia, Ukraine has been weighing. Geopolitical tensions across the board have driven this market on certain days. Today, we do see that we are up off the lows, but right now the S&P is at 58.90, down 2 points. The NASDAQ is back in the green here, 9 points higher. The Dow is down 208 points, down 0.5% at 43,181. And the Russell Small Caps down 0.1%. We do see oil and gold both higher, and oil's at $69.19 the barrel. $26.28 a troy ounce for gold, up $13. So gold's been back in favor again of late. 1606 on the VIX. The Bitcoin back to that 93,000 mark, back to these record high levels, 1% higher. And you do see the dollar holding the 106 handle. That being said, we have a lot to cover throughout this hour. For a look at some of the top moving stocks in today's market, I'm joined by Jenny Horn, markets correspondent here on Schwab Network. We're taking a look at Supermicro rallying today after saying the fears the stock could get delisted, and now they maintain the NASDAQ listing. Let's hear a little bit about this.
Yeah, thank goodness. I think the sigh of relief now heard around the AI trade, because this name has now risen, 51% over just the last 2 trading sessions. And I was looking at this name yesterday into the close, and it was like, well, nothing has really changed. We saw a substantial move to the upside yesterday with really hopes that they would see some of this delisting fears dissipate. But finally, we did actually get more concrete of an update today. We did see that now they're leading the S&P 500 as well as the NASDAQ 100 with a pretty massive move to the upside today, announcing they've hired a new auditor, which is BDO, and they've also submitted a plan to the NASDAQ for how they plan to get current with their delayed filings. So BDO is seen as the 5th largest consulting firm by revenue behind the so-called Big Four. So that was seen as a win. I was also reading a Mizuho note that said they believe their NASDAQ approvals on deck potentially within 2 to 5 weeks. So they needed this new accountant because, of course, Ernst & Young did resign as their auditor last month, saying they could not be associated with financial statements that had been prepared by Supermicro's management. They also do face the prospect of a second delisting if its plan is not approved by the NASDAQ, but they get to stay listed now under the exchange while it reviews its proposal. So I do think that this is seen as a win. Also, the new auditor will get a filing extension into February, so they have a bit more time. But the stock does still remain down about 40% over the last month, and now has pulled into negative territory pretty substantially on the year. And there's still many unknowns, of course. I do think that including whether the proposal will indeed be approved by the NASDAQ remains up for question, whether the new auditor will be able to appropriately now file their 10K, which has been delayed, for the fiscal year that ended back in June. So it's been a long story of pain for this name, but as we know, with some of these substantial moves to the downside, we're now seeing the inverse, where we're seeing the momentum to the upside on perhaps a recovery. And I think at least right now we're seeing steps in the right direction. Again, I think a fundamental update from this company with a new auditor and some delisting, sort of calming of fears, has been huge, because we rallied yesterday on basically hopes of delisting delays, and now we're seeing that news actually today, Nicole.
Yeah, and big news about BDO. A nice move there, clearly, up 30% today. Jenny Horn, thank you, markets correspondent, taking a look at SMCI today. All right, let's get some insights in the news shaping the markets. For that, we welcome in Kevin Mons with us, President, Chief Investment Officer at Henny & Walsh Asset Management. Thank you for being with us.
My pleasure.
You noted the post-election rally. You said the torrid pace was evident.
Yes.
But that's not going to continue. Does that mean that you're negative, or it just means that it'll be fewer highs or something like that.
Yeah, Nicole, I think it's fair to say the initial Trump bump is over now and more short-term bouts of volatility may be ahead, at least over the next couple of weeks, given the uncertainty about how much further the Ukraine-Russian tensions will escalate, given the uncertainty over what the Fed may do or not do next month. And then, of course, we have NVIDIA reporting tomorrow. And NVIDIA has such a tremendous impact of the psyche of the markets, given how many investors hold the stock, either directly or indirectly.
Are you a fan of some of these Mag 7s, NVIDIA in particular, that even on pullbacks, people think that in the long term they are continually going to be winners?
And it's understandable why they would think that way. During the first half of the year, those Mag 7 stocks counted for nearly 60% of the total return of the stock market. However, Nicole, during the third quarter, only 9%. So the expansion of the rally is starting to take place. Investors would be wise to consider other stocks beyond the Mag 7 to build a more diversified portfolio, because that may be where the growth is for the next 2 years.
And I know you have some themes you're talking about: industrials, healthcare, energy. Why are you picking some of these particular sectors? Are they potentially having catalysts, or are they just sort of the dogs that are not participating?
Yeah, I think they were themes that were resonating in 2024, even prior to the election, and will only accelerate because of the election. Take one, aerospace and defense.
Yeah.
The Biden administration was allocating funding towards defense. I think that, again, only accelerates during a Trump administration. Our country needs, Nicole, to upgrade, replenish, and also modernize our military warfare capabilities, and defense stocks will benefit from that. Another area, healthcare, but not necessarily large cap pharmaceuticals, but rather small cap biotech from an M&A perspective. And then finally, power. And I don't mean drill baby drill, oil or gas. I'm talking about multi-utilities, these utilities that supply electricity, natural gas, and nuclear power to help meet this increasing power demands from data centers to power this AI revolution forward.
Yeah, and for that you have DTE Energy, right?
Yes.
Tell me a little bit about that specific name and how much higher you think this could be headed.
Sure. So DTE Energy has a yield of about 3.3%. They're a multi-utility based in Michigan. They have a PE of less than 18, so trading pretty reasonably. And they also provide electricity and natural gas utilities to their customers in Michigan and own the Fermi 2 nuclear power plant. So they have all three legs of the stool to this energy demand that we have across our country right now.
Yeah, and then for defense and security solutions, KTOS Kratos.
Yeah, so Kratos is really the modernization theme of defense spending, and they allow for drones, unmanned aircraft, and machinery, and also satellite communications. That's really where we need to take our security and defense moving forward, is into those areas of modernization.
It's amazing because I heard a whole conversation today pertaining to drones and how Ukraine is building them and at a moderately priced cost, and using them very effectively, and that we need to sort of reevaluate our warfare products and how expensive they are, maybe incorporating a drones.
And it doesn't put human lives at risk.
Yeah, another good point. Healthcare, you have Celsuity. I don't even know that name.
Yes.
Tell me a little bit about that name.
So that's a small cap biotech play, and what they do is provide precision therapies to target cancer. In fact, they will provide therapies consistent with an individual patient's tumor biologies. Talk about that. The specific treatments to focus on specific forms of cancer. Now, you can't tell me that a large cap pharmaceutical company isn't going to look to acquire that innovative healthcare solution, especially if they get continued pressure from Congress to lower their drug prices. They're going to have to look to replace that lost revenue, and they're going to turn to be acquisitive and perhaps acquire companies like Celsuity.
Do you think that people will feel left out if they sort of take cash and put it on the sidelines? I mean, don't do that or do that.
Absolutely. I've been doing this for over 31 years right now. I can't time the market effectively. No one can. Because you got to get it right twice. When to get out and when to get back in. So the theme here is to stay invested, consistent with your risk tolerance. There was a University of Michigan professor, Nicole, who did a study, and they looked at 30 years worth of consecutive stock market performance. And what they found was that 95% of the stock market's return returns come on just 1% of the trading days. Wow.
Right.
Now, I don't know when those 1% of the trading days are going to be, but rest assured, if you're not in the market on the 1% of those trading days, you're likely to miss out on the most significant returns that the market has to offer.
Are you worried about, there are people who are cheering, corporate taxes, that this is a business-friendly administration, corporations will have lower taxes. There are people who are worried about the economy. There will be deportations. And what camp are you in, and where are you standing on the economy?
I'm concerned with the overall amount of debt our government and the consumer has right now, with consumers racking up nearly $1.2 trillion in outstanding credit card debt. If that consumer, which accounts for 70% of the economy, shifts from spending to servicing that outstanding debt, the economy can and will only slow further. But the Federal Reserve realizes that. And that's why, given their outlook for lower interest rates over the next 2 years, moderating levels of inflation should provide tailwinds for both stocks and bonds. So short term, I see more short-term bouts of volatility. Long term, I'm much more optimistic.
And as you mentioned credit cards, I was thinking Capital One Financial, Discover Financial, and I was doing some research on credit card debt, and again, how people are facing just so much, and that the credit card debt the delinquencies were rising faster than any other debt in 2024. So it is real. But then there was talk about M&A activity, Capital One, Discover, and are they takeover targets? Will there be mergers and acquisitions? Are you in the camp that we'll see a lot more action on Wall Street?
We'll certainly see a lot more M&A activity, at least over the next 2 years. As regulations come down, the pace of the review of said acquisitions picks up. I would expect to see acquisitions in the financial space, as you correctly point out, including regional banks, and also in the biotech and healthcare spaces.
Are there some deals that you think should have gone through and got blocked?
Not necessarily. I don't think so, but I think there's a lot of deals that perhaps didn't take place as a result.
And now Spirit's looking to file for bankruptcy. That would be one.
That would be one. And now maybe someone actually jumps in and acquires them as a result of what's going to take place.
All right. Well, it's good to see you, Kevin. Thank you so much for being here.
My
Kevin
pleasure.
Monahan and Walsh. Thank you. Coming up, plenty more to come here on Trading 360. Up next, it's the big three. 3 stocks, 3 charts, 3 trades. Kevin Green will take us through the technicals. Jessica Inskip standing by. Stockbrokers.com, and she has the trades for BWX Technologies, Costco, Disney. Trading 360 on Schwab Network. We'll be right back.
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
I'm Nicole Petalides, live on the floor of the New York Stock Exchange. We're coming up off the morning's lows. Now we are down about 172 points on the Dow Jones Industrial Average. In the meantime, it's time for the big three stocks, three charts, three trades. Kevin Green will take us through the charts here to take us through the trades. Jessica Inskip, Director of Investor Research at StockBrokers.com. Great to see you both. Jessica, welcome back to the show. Just wanted to see how you're feeling. You know, we've had some volatility today. We sold off first thing. How are you feeling between now and the end of the year about the market?
Yeah, volatility and uncertainty go hand in hand. Nicole, I think near term, what's going to set the tone for the rest of the year is NVIDIA earnings that we have tomorrow after market close. That's going to tell us the AI narrative. And then beyond that into 2025, which is already right around the corner, I think that uncertainty might come back as well as we get into new administration, understanding fiscal policy, taking into account what actually is being implemented. The previous term with the administration, he tended to use even tariffs as bartering tools, and it's interesting to see how the market reacted. But near term, let's just focus on NVIDIA earnings and then go from there.
There are some folks who say even if the earnings disappoint, they're still, you know, big fans of the market. You're more in a wait and see mode. In the meantime, BWX is the first group you're watching here. Tell me a little bit about this.
So this is related to that AI theme. Something we've talked about a lot, Nicole, is the grid pressure. I like to say it's not the price to earnings ratio that we're looking at for overvaluation, it's the price to energy ratio. The computing power is just a byproduct that we need with this grid pressure. So BWXT is actually a exposure to small modular reactors, and we've had major investments in those small modular reactors by Google and Amazon. So I love when we go into earnings season, we look at the hyperscalers first, and then we get NVIDIA last, which is just a great way to understand the AI narrative and to round off the earnings season. So I want to see where are Google and Amazon spending money, where are the hyperscalers spending, what are the headwinds, and of course, energy is one of them. This is something that is a merchant supplier, it's agnostic, it's definitely going to within its early stages. So I definitely have some caution there as a growth energy play, if you will, but it's got exposure to those SMRs and is one of the few public traded companies that actually have that exposure. So I think that can attract a lot of attention, especially as we focus on what's happening with the grid pressure and the whole AI narrative.
Yeah. And it's had an incredible run. I mean, it's up 66% year to date, recently hit a new high of 136, I believe. Let me take a look here. In the meantime, Kevin, take a look at the chart, please. I may be wrong on that.
Huge run up, though. Yes, it has had a huge run up, though. You're right, Nicole.
Yeah, I would say that the chart does look bullish, Nicole, obviously. I mean, we've had a really nice run here, and we kind of talk about the secular theme. And when you're looking at the one-year daily, we did actually have a nice little consolidation pattern before we actually broke out to the upside. It had a nice little run, ending the year last year, kind of topped off at around that $108 level. And then we were pretty much range-bound between $108 and at the lows sitting at around $87. Pretty wide range, but this is a high beta stock here, and you can actually see there's kind of like two different cup and handle patterns within that channel, which we then actually did see that breakout, had a little bit of a flag pattern at point B here, and then we continued to resume to the upside. Now, this does look like a little bit of a blow-off candle or blow-off top, so I would just be a little bit cautious with that, but you cannot fade a secular theme right now. An area of support, if we were to come back and kind of retest some areas, 115 is going to be the first one that I'm looking at, and then that 200-day, which is sitting at 101.60. Now, the reason why I'm getting a little bit cautious with this one, Nicole, is because we are having a bearish divergence with the RSI, meaning that we are making lower highs and lower lows on a relative basis, and the MACD also is kind of in a bearish formation. Now, it's still above the zero line, which is bullish, but that cross is something that I'm kind of keeping my eye out on. If we do see the 12 and 26 cross below the zero line, we probably will see a pullback on the horizon. Overall, this is a bullish chart, just showing a little bit of signs of maybe an immediate pullback before resuming the uptrend.
Right, understood. I mean, it really is incredible. And the idea, I just like saying small modular reactors. I mean, I just think I'm in the right place with all the energy demand of the grid. I think you're right on point with that, because that's what we're hearing. I mean, that is a common conversation that's being had. And, you know, we talk about electricity, we talk about nuclear energy, we talk about nat gas, et cetera, and all kinds of utilities. Final thought here, you know, when you think about this stock here, that I mentioned it hit a high of 136, it's at 127 now. You know, how high do you think these can go? I mean, are you looking for 10%, 20% in the next 6 to 12 months? I mean, what kind of parameters do you set?
So I'm not putting a price target on this one necessarily. This is something I want to add to my longer term growth oriented portfolio and then just go from there. So I want to start with my investment thesis, which is that grid pressure. And then as long as that investment thesis still is in play, I'm still hearing from the hyperscalers that they're spending money or that's still an issue. And then this is the proposed solution, then I'm absolutely going to keep that within my portfolio.
Yeah. Well, we have a lot of big retailers this week, right? We heard from Walmart, but you know, Target and TJX and Ross Stores and Gap and Ross Stores, BJ, Gap. These are some of the names that we're watching closely. You have Costco in focus. Tell me a little bit about that. You like that it's had more traffic in the stores, a loyalty program looking good.
Yeah, absolutely. Costco is positioned for growth. It has a little bit of a different business model compared to those other retailers because of the subscription model, if you will, that it has with its membership model. And they're expected to gain market share, even with rising grocery prices. So I think that's going to help really attract different types of customers. Their proposition is attracting even budget conscious customers, which is something that's extremely important. They've got their signature brand, which is Kirkland, that also drives that customer loyalty. And what I found very interesting is the expanding of digital opportunities. I remember Target many years ago when they just started introducing that e-commerce and digital initiatives, that bolstered their growth. And I'm seeing a similar theme here with Costco, and that's going to really help their competitive edge, especially within the grocery space. We're in this era where we want things now, and e-commerce certainly helps get things now and quicker. And so I'm very interested to see how that transforms in addition to their global sourcing model advantages, which help them position pricing power very well.
Yeah, so many pieces to this puzzle. You mentioned the Kirkland brand really has gained in popularity as well. Let's hear what Kevin has to say about the charts, please, Kevin.
Well, Nicole, when you're looking at Costco's chart, they just had a outperformance to the upside. I think it actually has shocked the street's expectations here when you're looking at how it's been able to hold up for so long. And this stock actually does a really good job with having a stair-step approach to price appreciation, just meaning that we utilize past areas of resistance as new areas of support. At point A, we see the same type of scenario taking place. In March, we hit basically the $800 level, came back, kind of consolidated, broke through, and then now we utilize $800 as an area of support where we came back and tested. Then we broke out even more to the upside here, breaking that $875 level, and then we were in a consolidation range between $920 and $873 before trying to break out recently. Now, the breakout seems a little bit weak. You want to see some follow through, obviously, when it comes to this name. And even if you kind of go back into that consolidation range, the overall trend is still to the upside. If we break down that stair-step approach of those previous resistance areas are now going to be support areas that you want to be focused on, or even if we hit that 200-day moving average, if we do see that type of reversal to the upside, where could we see the stock go? I think $1,000 is on everybody's radar right now, and sometimes when you get those psychological levels, the market tries to just melt up there. The question is going to be, can it hold 1,000, or do we see a massive sell-off right after that? Do we see a lot of stops being triggered? The one thing I am kind of keeping my eye out on the bear side, though, is that the momentum has started to wane here a little bit. You can see that with the RSI kind of forming this, descending wedge pattern taking place, and then the MACD also kind of on a relative basis making lower highs. So it just means that we're losing a little bit of steam. I think we need a little bit more of a new narrative. I think we do have a reverse split that's going to be happening with the stock too, if I'm not mistaken. That could be a driver. So overall bullish trend, 1,000 area of resistance. I probably wouldn't fade the move right now just based on what the structure is looking like.
Look, you're right on. Bernstein has an outperform rating. They have 1,062 as the target. Evercore has an outperform rating, also over $1,000. And Evercore now has the Costco price target at 1,075, up from 980. And there's a couple of others as well. So it shows that the $1,000 mark is definitely in the sights of folks, and we're already at records. Any final thought here about the consumer, the holidays, Jessica? Spinning it forward a little.
Yeah, well, I mean, retail sales came in strong. Holiday season seems to come earlier every single year, and I'm not sure why people were putting Christmas trees up in my neighborhood right after Halloween, which is very, very interesting. So I think it's going to be a little bit more of a pull forward, like you said, and that 1,000 level is psychological. We see that happen. So it's going to be interesting to see with Costco and retail altogether.
Yeah, without a doubt. We've gotten the latest from Disney, too, in the earnings, and we think about you know, they really gave some clarity going forward in a way that they hadn't prior, and there was some optimism that where you see the chart here. I see the gap up. Tell me a little bit about the Disney story, where you think it's headed.
Yeah, nail on the head, Nicole. It is literally, the story is all about forward-looking guidance. I know they had an uptick in streaming. I personally would like to attribute that to Taylor Swift because I'm a big Taylor Swift fan, but that's where she parked her Eras tour, and therefore, if you want to watch that over and over again, that is a reason to go into that streaming service. So, but the point of bringing that up, it is targeted content that is extremely important when we're thinking about streaming and these streaming wars that we have, and this completely differentiation that is happening across the way that we consume TV. But that's also not the component of Disney that's very important. It's sports. There's entertainment operating income. They expect double-digit growth, 875 million year over year for improvement on their direct-to-consumer. They have that their growth is weighted towards the first half of the year. That is the timing of specific content releases. So that's certainly going to translate over. We're probably pulling forward earnings, hence seeing that rally right now, but we want to see that follow through. So I would watch out for any pullbacks to add into it. And then additionally, the sports segment, 13% of operated income, that growth is expected to be. And so there's so many deals happening with NBA, ESPN, their flagship launch timing, lots of growth segments. So I really think the entertainment industry, the sports, and then of course that content creation lineup that they're having is going to be a pivotal moment for Disney.
Yeah, I mean, right on with the sports too. Well, look what we just saw with Jake Paul and Mike Tyson, right? You had 60 million viewers, and it's my understanding Netflix has more people subscribed to it than people who have cable. You have the Warner Brothers deal for the NBA, 11-year NBA deal extension, and so on and so forth. And you mentioned ESPN here for Disney and live sports there. Huge. Let's have Kevin take a look at technicals, please.
Well, Nicole, I mean, you already hit it. I mean, at the end of the day, it's breaking out to the upside. I mean, we had a scenario earlier this year where we had this island pattern, this head and shoulders, where we just had price pretty much by itself before we actually saw that breakdown. And the breakdown was massive when you're looking at that selling pressure. But we ended up seeing a little bit more of a consolidation between July and, for the most part, early October, before we kind of broke out of that channel, utilized the area of resistance now as an area of support, starting to grind higher, and then we had that gap above that 200-day moving average. And now we're at a scenario here where we actually did fill that gap, where we saw the initial breakdown of the stock. Now, you want to see the stock actually hold up this gap and even kind of advance a little bit more to the upside here on very large volume to kind of backfill some of this gappy action that we've seen over the last couple of trading sessions. But this is, for the most part, pretty bullish. We're also going to see that 20-day moving average cross above that 200-day moving average probably by the end of November, if not early December, and that's also going to be a bullish cross here. We have RSI pretty extended to the overbought levels here, so maybe we have a little bit of consolidation or a pullback here, maybe retest some of that gap, but overall this trend is obviously to the upside here, Nicole. I think there's a lot of traders that not only were eyeballing this name because of that consolidation, but also looking for value plays, and sometimes when that happens, you have FOMO going into these stocks, and the technicals kind of aligned with the fundamentals that you guys talked about, and that's why we're seeing the nice little price action over the last month and a half, 2 months.
All right, Kevin Green, thank you for looking at all those charts for us. And Jessica Inskip will give you the final word here.
It's NVIDIA earnings. We've got to focus on that. Let's get the tone for the rest of the year and then go from there.
You know, there was a time where we would get up and see what the semis were doing, right? There were days that you just looked at the semis and you knew what the market did, right? I mean, there are certain times of the market cycles that we see it's very evident. All right, we'll watch for NVIDIA too. Thank you so much, Jessica Inskip, Kevin Green. Great to see you both. And we had BWXT, Costco, and Disney today on the Big Three. Coming up next, we'll spotlight Investopedia's Individual Investor Sentiment Survey. Caleb Silver is standing by, editor-in-chief, and he has all the details of all the folks that subscribe to Investopedia. How do they feel the election, the new year, their money? We'll be right back.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Welcome back to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. It's time to spotlight Investopedia. Now, Investopedia has individual investor sentiment survey. We want to know how people are feeling about the election, about the new year, about their money. Caleb Silver's with us, editor-in-chief at Investopedia. And so tell us, how many people do you survey? How long is the survey? Some of the details before you get to if they're worried or not.
These are our daily newsletter readers. We got about 5 newsletters that go out to about 1.5 million people. We survey them every 2 months to ask them, bullish, bearish, what are you worried about? What do you think is going to have the most impact on your portfolio? What are you actually doing inside your portfolio? And what would you do if you had a little extra money with that portfolio?
I like that question,
Me too, because it's the ultimate discretionary question.
So it seems like, and I think last time we talked, there were a lot of cautiously optimistic folks, right?
Yeah.
So that trend continues. Tell me a little bit about that.
Yeah, I wouldn't call in Maverick from Top Gun to say they've lost that love and feeling yet, but the optimism has waned a little bit, down about 9 percentage points. Still, 69% say they're optimistic or cautiously optimistic. 39% somewhat worried. Only 5%, though, Nicole, are really optimistic and ready to take a flyer on this market. And 64% say they're making no changes to their portfolios, which is kind of how individual investors like us roll. We don't really make big changes. We make changes around the margin.
Right.
Nobody's making big changes. Only 21% are making much riskier investments.
So there's no like doomsday scenario
No
here.
doomsday.
You said 39% are somewhat worried.
Yeah, no doomsday, and nobody is selling, and nobody's capitulating.
Right.
They just think we've had higher highs for a long time. There's a lot of uncertainty. There's new uncertainty, even though there's certainty about who will be in the White House and what the makeup of Congress will be. There's uncertainty about the policies that will come from the Trump administration and what they may mean to their portfolio. Some uncertainty, some optimism, but also some worry.
Yeah, I wonder what the 21% that are making riskier investments.
Oh, Bitcoin.
Bitcoin's in there? Okay, good. We'll get to that. Investors face new worries post-election. What kind of worries?
Well, they're worried about tariffs. And we asked them, of the policies that the Trump administration has promised on the campaign trail, which do you think will impact your portfolio the most and for the better, and which ones for the worse? Obviously, tariffs taking number one, as this one could really impact their returns, not only their returns, their household spending, 69% choosing that. On the flip side, though, and this is interesting, lower corporate taxes and potentially lower income taxes for individuals, that could be very beneficial to folks as they think about their portfolio and their returns going forward.
Yeah, I'm still dying to talk about the Bitcoin, but I'd like to hear sort of the allocation where people are putting money to work.
Big stocks and ETFs. And we've seen this trend over the last 6 months. It used to be individual stocks when we had this nice upward rise in the markets in the first part of the year. But as things got a little uncertain, we had that little currency crash in the late fall. I think folks have sort of dialed back a little bit, wanted to diversify through ETFs. So it's been ETFs first, then individual stocks, then index funds. You'll see some corporate bonds in there, and then you see crypto sort of cracking the top 10 for the first time in a long time.
Oh, that's interesting. And CDs are still hot, huh?
CDs are still hot. Get them while they're hot. 5% is not going to be here forever. It's been bouncing around a little bit. Also, high yield savings. People have been putting their money in that as well, trying to lock in the 5% or the 4 to 5% now, given the uncertainty they have going forward in the market.
I think there was a whole generation of folks who just never heard of CDs,
Yeah.
right? Because they were something that we all wanted when we were younger. We had good interest rate, and then they were out of favor for so long, and then you had a higher rates for some of these types of things. Let's talk about the cryptocurrency a little bit. You see it here. They're buying crypto. Tell us some more.
Yeah, not everybody's buying crypto, but when we've done this survey over the past 3 years, Nicole, the numbers have been somewhere between 8 and 12% of our readers who own cryptocurrency and invest in it. Now, given the rise, the all-time highs, the promises from the Trump administration about deregulating it, making America the crypto capital of the world, we've seen a lot more enthusiasm, up to 25% of people saying they're investing or considering it, and folks saying they would actually invest more if they had a little bit of extra money. It's one of the top 5 choices.
Really?
First time in a long time.
Yeah, that's interesting. I saw that you have folks also saying they want to pay down debt.
Yeah, and we have this balance, right, within our readership, which is folks who are just like us, thinking about how do I maximize my gains, protect the nest egg, but also if I have debt, how do I pay it down? They can feel interest rates, potentially credit card APRs going down. They want to get rid of some of that debt. Maybe it's a New Year resolution, hopefully. We want people to do both, pay down the debt and invest. Good to see people thinking about both of those things.
You know, China is also always front and center in U.S. relations with China. You know, we've obviously had some decoupling happening. Some of your thoughts there?
Yeah, it used to be when over the past several months and really over the past couple of years, what are people concerned the most about? It was geopolitical uncertainty. It was uncertainty around the election. The fact that we've had so peaceful election and transfer of power, at least that's what it looks like. That took that worry away. What are they worried about now? Tariffs, and they're worried about U.S.-China relations. You see Russia-Ukraine creeping up back into the top 5. That, obviously, the news of today is huge. When we surveyed last week, this was not happening at that level, but it's still one of their top 5 concerns.
Yeah, I mean, they're throwing the word nuclear around. It makes people nervous.
Don't throw that word around.
Yeah, it makes people nervous, ultimately, right? When we think about the anxiety index, what happened with that?
Yeah, well, with record highs for the stock market right after the election, people weren't feeling terribly anxious necessarily about their returns, about their money, but they do feel a little uncertainty about geopolitical stance right now, about tariffs, and also inflation. Although the narrative is quieted down a little bit, people are still paying higher prices, so they're feeling the personal finance anxiety much less than they feel the market's anxiety, because the market has delivered for them this year and last year and really over the past 20 years, except for a few years here and there.
Look, we've talked about a lot of things here. One thing is cyber attacks. We didn't really mention that, and that is a concern for folks. I mean, it's a growing concern as AI is getting better, technology is getting better. I mean, it's, you know, you shred your papers thinking, oh, I'll be okay.
No, I don't think
your
so.
whole identity is taken, right?
I don't think so. We've seen what that can do to just one company when we have an incident, or we can see what it can do to an entire industry. But it is one of those black swan events where you can't predict it, so you can't model it into your portfolio.
Right, understood. So what am I leaving out? I mean, in the big picture here, I mean, overall, you think people are feeling pretty good. That seems like good news overall, right?
Yeah, and what you see, especially with individual investors, we don't make a lot of changes. When we ask our readers for their top 10 stocks in their portfolio, what do you think it looks like? It looks just like the S&P 500. It looks a lot like the NASDAQ 100. NVIDIA is the #1 stock that people now hold and also say will deliver the best returns over the next 10 years. No pressure when they report earnings on Wednesday afternoon. Let's hope that the demand is as strong as it is, because there's a lot riding on it.
Yeah, indeed. Good to see you, as always.
Thank
Caleb Silver of Investopedia, editor-in-chief there. Thank you. Coming up next, Disruptors. George Sellis is standing by. He'll take a look at Salesforce, which Scotia Bank named as a top pick. We'll get more.
record on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Palantir is one you have to look at in the next 4 or 5 years. I mean, Albert, this is a new story being built when it comes to AIP and it comes to the Palantir enterprise piece that's not being factored into the stock. The trajectory here, I mean, we could start to be looking at $4 billion, $400 billion, $500 billion. Could this be a $1 trillion valuation? If they continue to execute, that's not out of the realm.
Tune in to the newest episode of Market Overtime as Oliver Rennick sits down with Dan Ives to discuss why the AI revolution may just be beginning. Market Overtime airs this week, 4:30 p.m., and airs all week long on Schwab Network and our YouTube page as well. Don't miss it. Welcome back to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. We have a few developing stories, things to watch here. We bring in Caroline Woods, senior markets correspondent here on Schwab Network, and we're taking a look at Walmart, new all-time highs. Everybody's who comes on loves Walmart, and it certainly seems like they were right.
Yeah, the bar was high for this one, and there was a lot of speculation that even if Walmart beat, how would investors react? Because it was up more than 60% year to date heading into the report, so close to those all-time highs. And it seems like they cleared that bar and impressed investors. We're seeing shares up 4% right now. I was going to say that Walmart was bucking the downtrend, but we've seen a pretty big reversal in a lot of names. So joining in on some of the strength, I guess, the Dow's still lower though. So best performer there. In terms of the quarter, it was a beat and raise quarter. Adjusted EPS of 58 cents was a nickel better than analysts were looking for. Revenue rose 5.5% to $169.6 billion. Wall Street was looking for more like 167.5. Breaking it down, U.S. comp store sales, excluding fuel, were up more than 5%. Transactions were up 3%. Average ticket was up 2%, 2.1%. At Sam's Club, comp store sales ex fuel was up 7%. Global e-commerce sales were up 27%. And then the global ad business, kind of a diversified revenue stream for Walmart, up 28%. Mentioned it was beat and raise quarter. The updated guidance, Walmart now forecasting that sales will grow between 4.8 and 5.1% for the full year. Previously, it was 3.75 to 4.75%. So that's welcome as well. And then in terms of the overall consumer, Walmart a great bellwether, just to kind of give us an indication on the overall consumer. Pretty positive on the earnings call. Said U.S. customers remain resilient with behaviors largely consistent with how they acted over the past 4 to 6 quarters. They continue to maximize their budgets, but they're choosing convenient options to save time, and they're paying up for those convenient options. Also seeing engagement across all income cohorts, and again seeing strength in that higher income consumer as well. So really pretty positive on the consumer, and we're seeing that reflected in share prices today, up 4% right now up about almost 6.5% this month. And take a look, year to date, up 66% for the big box retailer.
Yeah, really great for the shareholders. And we'll hear from a lot of the retailers this week, and retail sales has been good. I mean, now we have the holidays, but certainly some great news out of Walmart today. Thank you, Caroline Woods. Let's take a look now at another big story here, our disruptor, and that is George Sillis, senior markets correspondent, taking a look at Salesforce. A bullish call from Scotiabank, a nice price target too.
Yeah, I mean, if you look at the price action on Salesforce, Nicole, I mean, year to date, one of the things about this name and some of the other software application names out there is Salesforce has actually been underperforming the rest of the S&P 500. It's only up about 21%. It's still a good return, but nonetheless, it really hasn't generated the returns I'm sure investors have been hoping for. And if you look at what it does, I mean, obviously this is an enterprise cloud behemoth. They're also a big player in marketing cloud, but also in e-commerce and data visualization and back-end data integration with companies like Tableau and of course Slack is one of their acquisitions they made over the past few years. But generative AI is essentially what Scotiabank is looking for as a primary catalyst for CRM going forward. They actually initiated coverage on the name today with a $425 price target and outperform rating. They actually have it as one of their top picks in the software application space. And one of the things they also noticed is the underperformance of some of these bigger players in the software application space, as investors have been really focused on hardware in technology, particularly semiconductors, which if you look across the board, absent companies like NVIDIA or even Broadcom in the AI infrastructure space, many of the semiconductor stocks have actually been trading lower. So it looks like there's some catalysts right now from the standpoint of underperformance, catch-up, or alpha, potentially going to be generated in the software app space, and CRM being one of the leaders out there may end up catching a further bid after hitting some new highs over the past week or so, but having pulled back over the past few days. Now, if you look at Salesforce, they are coming out with earnings on December 3rd, so you have to be mindful of that. But at the same time, if you look at the financials, the performance of the stock may not necessarily reflect accurately some of the value opportunities in this name, considering if you go and look at their 5-year average EBITDA growth on a year-over-year basis, it's around 19%. And if you look at the forward EBITDA growth, it's around 18%. It's a little bit less than their 5-year average, but the stock is trading at a forward multiple right now at around 35% of its 5-year average and around 28 times next year's earnings versus 43 times on a historical 5-year average basis. So one would say that relative to their expected earnings growth, the stock is cheap, and I think this is maybe why two things have happened. One, the stock has recently broke out to new highs, and then also Scotiabank sees some opportunities with their target of 425.
Yeah, understood. So how would you go about doing an example trade today, George?
Yeah, so we have to be mindful, like I said, of the earnings on December 3rd when we structure our trades. The other thing is, if you look at the price action on a multi-year weekly chart, it did break above the late 2021 levels. Also, corresponding levels it broke out of early this year in March. But the stock is pulling back to the 20-day moving average. So there may be a trend continuation in play here. So what I'm going to do is I'm going to structure a long call diagonal with the context of earnings in mind. I'm actually going to sell the December weekly 340 out of the money calls. These are going to expire on the 6th of December. And then I'm going to use the proceeds of that option to buy a January in the money $310 call option. So altogether, this whole structure would cost about $18 a share or $1,800 a contract. Now, the whole premise behind this trade is the best outcome is obviously $340 and by expiration on December 6th. If it does hit that, then you essentially basically earn $12 a share because your break even is $328. But if it doesn't breach that level of 340, it's unencumbered and has unlimited profit potential up until, of course, expiration in 59 days for the January contract. It's $18 a share or $1,800 a contract. And then, of course, the potential, if the December weekly option expires worthless, is unlimited.
George Sillis, thank you. Good luck there. We really appreciate it. And some big news there on Salesforce as well. Thank you. Coming up next, our 360 round, we're taking a look at the housing market. We've gotten in starts and permits, and somewhat disappointing. Also, mortgage rates still are relatively high. Homes are still high as well. Affordability is a question. What's next for housing? Our panel is ready.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
It's time to look forward
Find the next trend.
from every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. It's time now for our 360 round. We're taking a look at housing. We watch mortgage rates and building permits. And what is the themes now going into 2025? Jenna Stafford's with us, expert broker, global real estate advisor at Sotheby's International Realty. And right here on set, Erin Sykes is with us, founding partner, Sykes Properties. Thank you both for being here. So Jenna, I'll start with you. A big picture thought on some of the trends that you are seeing.
Well, I would say that what my outlook for 2025 is that we could see some gradual improvements in the housing market, but we're still going to be up against some persistent challenges. Of course, interest rates being one of those challenges. Instead of seeing rates dip lower, we've seen these rates just go higher. And in order to really get some movement in the housing market, I think we need to see rates go down. And of course, the big problem that we have with the housing market is that we have a massive shortage of homes. And what this has done is it has created a massive affordability problem. So fewer and fewer Americans are able to buy homes, which is a big problem for America. This trickles down into so many sectors of the economy. I will say that a positive trend that I am seeing is that you are starting to see some inventory levels pick up around the country slowly. And again, I think that, we'll see some moderate improvements next year, but we really have to see more supply come to the market. This is one of the biggest things that we need. We need to start seeing supply come to the market so that we can start seeing some downward pressure on home prices. We can't continue to go at this level of price appreciation that we've had these past few years. In the long term, it just really is not sustainable.
Yeah, Erin, I'd like for you to add on to that, because obviously affordability is an issue. And we've had, to your point, Jenna, have had more inventory come on, but it's not enough. Home builders have been able to sort of negotiate mortgages with folks that if rates come down, they won't be able to do that as much. What do you think is the outlook here?
Yeah, so I think the outlook for home builders is actually quite positive because they benefit from the higher mortgage rates versus the independent sellers in the MLS listing market. There's been so many talks about the Trump bump, and I think we've seen this Trump bump in multiple variations. We've seen actually mortgage rates bump up 1 point since the election, or since September in particular. However, I think that we're going to see this shift where the market is settling, the market is digesting in terms of where pricing is going to go, where inventory is going to go. Personally speaking, I got 2 new listings the day after the election. People were just sitting on the sidelines waiting to see a little bit of risk mitigation so that they could then list their properties and we could price it appropriately. So we know a bit more about where the market is going, and I think that, this is just a bump in the road in terms of this point elevation in the mortgage rates. We're going to see them settle back 5.5%, 6% long-term focus.
And we've heard some of the home builders actually switching to condos and townhomes to actually bring some more affordability to folks. Do you think rates come down? I mean, what kind of rates do you see in a few months, let's say?
I think by the end of the year, we're back at 6%. I think long term, we should settle between 5.5% and 6%. I think any lower than that is unrealistic. And it also sets up for another negative situation like we saw in 2021, where it was just an unbalanced market.
And will that be enough? I mean, Jenna, what do you think? You think lower rates, but not much lower rates, will be enough to get things evened out here?
Yeah, I think they have to go in the low 5s to really get some movement. I mean, ideally, I think it would even be nice to see them get in the 4s, but just at least having them trend down to the 5s will definitely start spurring some movement in the housing market.
Do you recommend people make the move and try to refinance later, Jenna?
I recommend not timing the market. I recommend doing what is best for you in this moment. There are some great opportunities out there. If you have found a house that meets what you need and you're in a position where you can purchase this home, don't try to time the market because you think rates are going to go lower down the line. Do what is best for you right now.
Yeah, understood. When we think about home ownership, general wealth, what's the status there? I mean, I know regionally there's different parts that have more wealth than others, but you did have sort of a broad-based thought.
Yeah, so we've got average price of a home in the United States is in the high 400,000s. And in terms of where that distribution is, you see Florida, it's over 500,000 at this point. We've seen such a uptick in Palm Beach, Miami areas where I work, and you can't even enter the market anywhere close to there, unfortunately. So we are seeing this general momentum out of the state of Florida, kind of back into we call them halfbacks, into the South Carolina and North Carolina states.
But will those prices come down in Florida because you won't have, nobody will be able to sell anything if they keep it too high, right?
So we did have a pretty slow market over the summer. There is absolutely no denying that. However, we also are negotiating prices. So even though they're not listed lower, they're going into contract 10-20% off list price. So I think it's a really great opportunity to be a buyer right now.
And there's still a lot of talk about the 30-year fixed rate mortgage, whether or not that would still exist. It seems that would still exist under the Trump administration. Thank you both, Jenna Stauffer and also Erin Sykes. Good to see you both. I'm Nicole Petalides. Thanks for being with us. Fast Market is next.
Join me, Oliver Rennick, alongside Schwab Network's options experts as we explore the second derivative. Gamma On is a brand new limited series to take your trading skills to the next level. Subscribe to Schwab Network's YouTube channel now.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
Day traders, welcome to Fast Market here on the Schwab Network. I'm Tom White. We've got a great lineup for you today, including market discussions, and then we'll have some option strategies. We're going to cover Netflix, which is at all-time highs and is up over 70% so far this year. And TJX, which has rallied about 27% so far this year, trading near all-time highs into their earnings. And like Folio, break down consumer sentiment data in Target. The retailer stock is up about 5% so far this month. They report earnings ahead of tomorrow's opening bell. Now let's take a look at the major indices, which are near session highs. We've had a spectacular rebound from losses earlier. S&P 500 up 0.1%. The Dow off about 135 points or 0.3%. NASDAQ 100 up nearly 0.2%. And the Russell 2000 small caps up just over 0.25%. This was after we saw the major indices down over 1% earlier in the session. To help me break this all down, let's bring in my co-host Kevin Hinks. Kevin, that was quite a reversal. Once again, markets push back against anything geopolitical. It doesn't matter what happens, it seems like globally, that the optimism's still there. They're going to buy up every dip, and that's what happened again today.
Make no mistake, geopolitics was all over this market this morning.
Yep.
It was the reason we were down, but news releases started coming out, softening some of the stances, and you're right. You know, this market, the United States stock market, is a little more immune from geopolitical risks because, frankly, they're not here. They're somewhere else. And so, yeah, you're right. It bought the dip, and that dissipated. I mean, right after the open, it picked up pace pretty hard. Down 1%, like you mentioned,
right.
And down over 1% on the NASDAQ. And then it firmed up, and the selling kind of dried up. And now we've got the S&P up 0.1%, and the NASDAQ up about 0.2%. So, solid comeback here. And by the way, NVIDIA, I don't think was ever down this morning. It was up pre-market.
It was positive
and stayed up the whole time.
Yep, it is up 2.3%
Yeah.
now. Kind of reflective going into that earnings event tomorrow. We'll talk about that more. But and this comes after the word nuclear gets thrown out there by Putin.
Whenever Vladimir Putin is pushed to the corner, he brings out that word.
Approved an updated nuclear doctrine that expands the conditions for Russia to use atomic weapons. Basically, they lowered the response on the conventional attacks. There were reports out of Bloomberg that 6 ballistic missiles were fired long range into Russia. Maybe one of those hit. So, but that's to your point. You can't discount maybe this rhetoric, but the market seems to discount it like that.
Well, remember, the market doesn't like to be uncertain.
Right.
And when that happens, when those headlines break overnight, the market becomes uncertain. VIX spiked up to, it was, I think, close to an 18.
Yeah, close
at
to
one
18,
point.
yeah.
Yeah. So, and then it dissipated over time because, politicians make comments, and I think this is just a very, unfortunate time, in between the end of one, political party and the beginning of another.
Right.
And it's dicey.
Yeah.
Let's face it.
Yeah.
It's dicey.
And I
wonder who's making decisions, and you wonder why they're making these decisions now to escalate when they didn't for 2 years.
Yeah, Biden allows longer range ballistic missiles to be fired.
And of course, Ukraine gets them and fires them right away.
Yep, exactly. Right when Biden administration on their way out, I think a lot of people expect the Trump administration to be a little bit more friendly and kind of cool heads about this, and maybe that's why we've rebounded. But let's expand this conversation. Bring in Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. Nate, quite a spectacular rebound here in stocks, and as I mentioned to Kevin, it just seems like the market doesn't care about political risks at this point.
Yeah, I'm not a military strategist, but based on the price action, maybe they're just signing this off as some type of a bargaining, saber rattling type of positioning until we do see evidence that it is actually a serious escalation. At least that's what the price action is kind of conveying. We don't like to see these types of headlines, But you're right in terms of the desensitization we've had over the years. Look at the geopolitical headlines we've had, just over the last decade or so in terms of various wars that are broken out. And as these become more commonplace, which it seems like they have been over the past decade or so, then that, the market begins to, just not be as shocked by these types of headlines. So it remains an escalation. It remains higher uncertainty. If you look at the price action here, we're still, bulls are in charge. We got our post-election rally on stocks, and then essentially we got some of that consolidation or digestion of gains, which brought the S&P 500, the Dow, and the Russell all down to their 20-day simple moving average. That's just kind of a healthy consolidation. So at this point in time, it just still seems like the bulls are in control, and their thesis is essentially that, the economy will remain strong. We've got a pro-business administration that will be coming into office. We've got a friendly Fed, and therefore we've got, the technicals, we got bullish seasonality. And so when those dips come in, just like you were citing, it looks like that is seen as an opportunity to go ahead and move in.
Yeah, it seems like, Kevin, we talk about this every late fall into the holiday shopping season, that there's not a lot of catalysts out there. If you look at the earnings season, over 93% of the S&P 500 companies have reported. That's a 75% B rate on EPS, about 60% on revenue. But it kind of tells that tale that, hey, the consumers out there spending, economy's healthy at this point. We're going into the historically strong fourth quarter, that there's really nothing to get in our way right now because most of earnings are done. Economic data is tailing off. We've got Thanksgiving holiday next week. So what's to create that headwind if something like the talk about escalation on the nuclear geopolitical risks can't push stocks down? Where
Hold on a minute. Now hold on.
I'm not begging for stocks to go down, but I thought this was a big deal.
There is one catalyst out there.
Yeah.
Thursday morning, there won't be a catalyst going forward, but NVIDIA is a pretty big catalyst.
Yeah.
There's a big event still looming on the horizon. And you're right, though. It might be the last one, right? There's not a lot to get in the way. Remember, we're going to look at the U.S. consumer, and if Walmart's numbers are any indication, pretty healthy U.S. consumer, right? So if NVIDIA comes in strong, Walmart's hanging in there, we get Target again tomorrow. I mean, this could, like I said, we're setting up, obviously, geopolitics, NVIDIA's earnings, there's still things on the horizon that can disrupt this market, but they're getting less and less, Tom.
Yeah.
And then we have to look for the end of the year and a new administration and everything that might be. And yeah, I mean, there can be some extreme moves coming in the next 6 weeks.
Yep, and that's even with the S&P 500 up basically 23-24% so far this year. So we've had good gains. But Nate, what was your takeaway on that Walmart earnings? Because I talked about it on the Future Show this morning. I couldn't find any cracks in this report, and the bar was high going into this. The stock was at all-time highs going into the report, but they just hit it on every metric, it seems like.
Yeah, they certainly did, and that's at all-time highs with expectations high, and then they're still able to deliver as they are. And I think the Walmart consumer of the past, where it's really a price-saving type of a retailer to go to, the lower-income retail consumer is going there. They mentioned that 75% of their growth there was coming from the 100K up and above households, which tells you they're getting just a broader mix in terms of the consumer that they're serving there. And I think it does also convey the health of the consumer. We saw that with retail sales largely pretty healthy last week, a little bit below estimates, ex-autos. But Walmart is just one of those companies that just appears to be executing like a Costco, and they know how to basically attract the right demographics and get that price mix, in this type of environment where you have potentially inflation that's important to consumers.
Yeah, e-commerce sales rose 22%, pickup in advertising sales. Their third-party marketplace business picked up. If you looked at some of their, they did come out in their commentary on the conference call, Kevin, and they just said the consumer's resilient. Nate mentioned that, the fact that the more affluent consumer is trading down and going to Walmart.
I had this conversation with my 28-year-old child last night. He came home from the grocery store and goes, man, groceries are expensive. I go, dude, why do you think more affluent customers are going to Walmart now?
Right. Yeah.
Because for lower prices. Here's the thing that jumped out at me from the Walmart earnings report. Sales outside grocery.
Right.
Discretionary.
Right.
If there's a return by the U.S. consumer to discretionary purchases,
Right.
what does that do for Target?
Right.
Right?
Yeah.
There's the connecting the dots to the next earnings release. I think that was the one where like, whoa, discretionary is back.
Yeah.
That's I think we knew they'd hit it in terms of groceries.
Right.
It was 27% e-commerce global raise in that. That's an awesome number, but boy, sales outside grocery, really surprising.
Yep, and they continue to do everything right, it seems like, Nate. But then on the flip side, still got some pressures with declining sales from Lowe's. And you know what, Nate, I equate this to higher interest rates and that firming up of inflation that we saw, the CPI data. GDP came out, Atlanta Fed GDP came out, revised up a couple ticks going into the Q4. But higher interest rates just won't allow maybe Home Depot and Lowe's to right the ship. But everybody still expects them to because the stocks have had pretty decent runs over the last several months.
Oh yeah, they certainly have, and the home builders as well. A lot of that due to the expectations around lower rates. Looking at Lowe's earnings report, they beat on the top and bottom line. They bumped their revenue and EPS guidance, but then really the only thing was their operating margin, that they just slightly lowered their forecast there by 1/10 of a percentage point there, 10 basis points. And, the stock was down $11-12 there. But, within this space, I think there is going to be more sensitivity to higher rates. And if you look at the Fed fund probabilities that we have currently, it's basically 75 basis points between now and the end of next year. If you would have gone back to the late September forecast, this is just 2 months ago or less, it was 175 basis points. And so a lot of the home builders really took off. A lot of the expectations around refinancing, those types of things really coming into play. So within the retail space, you might be a little bit more cautious around the likes of a Lowe's or Home Depot versus a Walmart.
Yep, we'll continue to watch that story. And, the housing starts number and permits didn't help, but I think maybe that was clouded by some...
There was some weather, because if you look, it was the Northeast and the Southeast that were the low numbers there. That tells you probably some storm activity.
Yeah, impact from some of those storms there, so we'll continue to watch that. All right, guys, let's take a quick break. When we come back, we're going to take a look at Netflix. Streaming stock is up over 70% so far this year, at all-time highs. Not surprising. Oh, boy, there's some clips of that fight. Boy, oh boy, what maybe a joke that was. All right, we're coming right back.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Welcome back to Fast Market here on the Schwab Network. We're talking Netflix. The stock's popping, overbought on a technical basis, but that doesn't seem to matter. Seems like it's always overbought. Stock hitting all-time highs. Let's bring in Caroline Wood, Senior Markets Correspondent here on the network. Caroline, I was just mentioning before we went to break that exhibition or that mockery of a fight that they had on Friday night. I guess 60 million people watched it. I wasn't one of them, but this stock continues to move to the upside.
Well, Tom, it's interesting. Shockingly, I almost was one of them, despite the fact that it actually makes me literally sick to watch fighting. I think I got sucked into the hype. I saw the weigh-in. I really wanted to know what was going to happen. It was playing at my brother's house. And then I realized it was going to be a couple hours before they actually got into the ring, and I said, okay, and the first thing I did the next morning was Google it to see who won. So I definitely, played into the hype. I was questioning the whole time if it was staged. It seemed a little too theatrical to me, but I heard the fight was pretty boring. But over 60 million, or about 60 million households worldwide tuned into the event, and that's causing quite a bit of optimism today. I mean, Netflix shares up another 2% right now up about 5% this week. And that's despite the fact that Down Detector received more than 500,000 reports of users having problems with the live stream, with outages beginning at 8 p.m. Eastern and going all the way to 2 a.m. Eastern time. So there were a lot of complaints of buffering and freezing, and you could see it play out on social media. I will say this is not the first time that we've seen issues with Netflix live events. Love is Blind Season 4, the reunion, had a whole bunch of issues. It was a total disaster, and that's despite the fact that 6.5 million people tuned into that one. So nothing really new for Netflix. Obviously leaves viewers and I would assume investors at this point questioning what's going to happen on Christmas Day when Netflix has those two big NFL games, the NFL debut on Netflix. It's been a huge investment for Netflix. Doesn't seem like there's a lot of concern based on the fact that, as you said, Netflix hit new all-time highs today. Shares are up some 78% year to date. And to add fuel to the fire here, and people who wouldn't tune in to the game but might tune in to the halftime show, Beyonce is actually performing during the Texans-Ravens match on Christmas Day. So that could draw more eyeballs as well. So analysts bullish. I saw that Jefferies raised their price target on Netflix to $1,000 a share. That's a street high, saying we view the disclosure of 60 million households watching the Paul Tyson fight as a major breakthrough for Netflix's live event strategy and a catalyst for attracting ad dollars away from the $50 billion plus U.S. linear TV market. These stats increase our confidence that the Christmas Day NFL games should outperform linear viewership, providing another catalyst to accelerate ad growth. So I think that there could be a lot of football fans unhappy if there's buffering and freezing going on during Christmas Day. But Netflix has, over a month to get that in order and some of these issues solved. And it doesn't seem like there's any pessimism on the street right now.
This is why you don't bet. Right here. Because if anyone would have asked me, is Caroline Woods watching the Tyson fight, I'd have slid all the chips into the middle to say no. No chance.
But they said it started at 8 a.m.
You would have been
8 p.m.
No, yeah, but you were intending to. But no way. So this is why. But here's the thing. The bigger picture here is just like Amazon, who does it really well, they're moving into sports. They're finding out that live broadcasting is the next big wave. It's their next big mountain for them to get to, and it's a more efficient. Remember, this fight, and this is just my opinion, I don't think it was real, and it still got 60 million people. Think about Christmas Day football. That's going to get big numbers.
Yeah.
And if they do it right, and you're right, Caroline, they've got some bugs to work through and some infrastructure to get through. This is just the next, the next chapter for these companies. And linear TV should be very worried about these companies, Amazon and Netflix, with money in their banks going after live sports, because it's the next horizon. It's huge, and advertising just keeps getting bigger.
Yeah.
Mm-hmm. Yeah, no, I think that, as someone who grew up actually watching WWF with my older brother, it was very reminiscent of that, and I kept saying, is this even real? Like, is this actually a real thing? And I found myself actually being worried for Mike Tyson before the fight. It was all a very odd place for me to be in, but I think bringing it back to Netflix here, I think that it's clear that investors and Wall Street looking at this as a key catalyst for the fourth quarter. Obviously, it's happening on Christmas Day in terms of the live sports, and if they can, pull that off, I think we could expect to see, as the analysts said, more ad dollars being spent and more traffic to Netflix, and we've already seen, better than expected subscriber numbers from Netflix just in the last quarter that they reported alone. I do think one thing I do want to point out, analysts still very bullish on this name. 48 cover the company, 32 have a buy rating, so that's almost 70%. But the median price target for Netflix at this point is $800 a share. Netflix is currently trading at $862.67. And if you look at the 32 buy ratings, only 6 of the price targets from those buy ratings are higher than where it's currently trading. So something has to change here. If analysts are going to be bullish, you would assume you have to see some of those price targets go higher, or maybe there'll be some re-rating. It doesn't seem like today is going to be any day with some doubts here, but Netflix has some 283 million subscribers at this point in more than 190 countries, and they're really pulling in subscribers and drawing those eyeballs. And if they can do it right, I think that's going to be very key, because you might say that the fight didn't necessarily go right, and there's still a lot of optimism. I don't know that people would be as forgiving if these NFL games don't go right.
Yeah. The average viewership for Monday Night Football, which is, big, 17.5 million viewers. So even if they get 25, 30 million, that's less than half the Tyson fight.
And double the linear networks.
Right, yeah, so we'll have to see. Hopefully.
Don't underestimate Beyonce, too. Beyonce is going to pull in viewers as well.
Yeah.
Caroline Woods is an onion.
Yes.
We're peeling back layers. She's like boxing and Beyonce. Come on.
Yeah. That's why.
Well, all I have to say is go Bills. They're not playing on Christmas Day on Netflix, but go Bills.
Best quarterback in the league.
Yeah.
Bills.
Not our Chicago Bears quarterback, that's for sure. All right, great stuff. Thanks to Caroline Wood, senior markets correspondent here, breaking down Netflix. Let's bring Nate back in here for a discussion on this. Nate, I mentioned on a technical basis, I think the RSI is about 78, so overbought. Anything above 70 is overbought on this one. But, if you look at their results from last quarter, revenue growth 15%, 30% operating margins, new all-time high. The subscription additions continue to beat expectations, so maybe this stock should be at this lofty valuation.
Certainly in terms of execution in management and going after, the right channels of growth here. On that live event, they signed they have the next 3 years. They have the Christmas games with the NFL, and I'm a consumer that when, I think it was Paramount Plus, they might have grabbed like the Thursday night game, or it might have been the Sunday night game. I actually signed up for Paramount just to get the game. It was like $7 a month or whatever, but it just tells you, for those that are more inclined to watch sports, it's not that big of a deal to drop $15 if that's a subscription, even just to watch one game. And then you have a captivated audience that's on Christmas along with the Beyonce show. It's like a mini Super Bowl almost, it seems like. So, they're just making the right moves in terms of maintaining their dominance within streaming. Forward PE is 42. Yes, that's a little bit high there. Stock is at all-time highs. You've got it's a bit of a momentum kind of push that's going higher, and the RSI is 78. You're right, that's overbought. It's not a timing tool in terms of, once you get above 75, you got to hit the sell button. You have to wait to let the price action dictate when buyer exhaustion is kicked in. But if you look at the historical RSI in the high 70s to around 80, this is where generally the stock tends to top out in terms of momentum. And that's how I like to use RSI as well, the historical RSI, because stocks do have a personality. They have a character about them. And so we are in that overbought type of territory. And then the last thing on Netflix I'll bring up here is I get a little bit uncomfortable when everybody's on board with Netflix and they seem to be hitting it out of the park, because if you look at their history, more than 15 years, and going back to 06 or so, have been some massive drawdowns, some resets of valuation, and I think that's because they've changed their business model multiple times, going from mail to streaming. They've had competition come in. They've done various switches to the ad tiers. So I don't want to get too comfortable and just think it's off to the moon with Netflix, knowing its history.
All right, Nate, they've actually gotten an anticipated market maker move, because as the stock's moved higher, it's expanded implied volatility levels. But you got an example trade for us here. Break it down.
Sure. So, yeah, this is a little bit unusual, but I'll explain my reasoning. So, on the one hand, you've got a stock that is at all-time highs. It has bullish momentum. But on the up, and you got the analysts that are on board, etc. It looks a place that money wants to go in terms of, committing new capital to the market. But they are overbought here, so it shouldn't be surprising if we do get some congestion, some digestions of gains in between. And also, what's going to be the catalyst between now and Christmas Day when you get there? So you have a little bit of the push-pull in terms of the price action potentially over the next 2 weeks. But what stands out to me, it's an example trade, is that next day we have 3.5 days instead of 5. And if you want to go after the stock in terms of a time decay play, go after theta here, that's the way that I positioned that example trade. So at the time, the stock was trading at 850, and what I was setting up was selling next Friday's 850 strike call, and then I was going out to the following week and buying that call against it. And at the time, the theta there was a net roughly 12 cents, meaning your long 850 call was losing about 56 cents, net, all things else being equal, while your short call was losing 68. So you had a 12-cent gain there on theta, all else being equal. The other thing that I'll say here, though, is I'm going after the at-the-money strike, because that tends to be the place where you're going to get the most meat on the turkey leg. So this is really a theta play that you'd be going at by going with the at-the-money strike, going after the expiration that has 3.5 days next week. And then you do have somewhat of a wide range of profitability here. So when it was at 850, the range was roughly 830 to 870. So in terms of price action, it's tough to kind of predict what the stock's going to do. But in an example like this, at least you can have time working in your favor in the meantime.
All right, let's break this one down. December 6th, weekly options by the 850 call. Sell that same call in the November 29th options that expire in 10 days. Paying roughly about a 480 debit we've got here. It's about where it's trading right now, maybe a little bit higher. Slightly in the money. The debit you pay is your risk on this position. As Nate mentioned, maybe break even's about 835, 830 on the downside, and about 865, 870 on the upside on this one, Kevin. But you got a nice wide range for this sector trade, so all you need is some consolidation, right?
Yeah, what you want in this case, remember, this is a call calendar, but it's below the market. So it's a little bit of a different makeup than we normally talk about. So this is a bearish trade using calls. And any move, any drift towards 850, that front expiration call is going to lose value pretty quickly, as well as theta is going to over a long weekend. So this could be one of those ones, Tom, where not much happens the week of Thanksgiving, and you come in and it's just expanded just because of time and lack of movement. And that can happen on a calendar spread. If you target something range bound, which, it's $14 below this market, but it's still, but for this stock, kind of a range bound strategy, you can make the case, then that's all you need, right? Remember, you're targeting the short strike, which is 850. So it's slightly short deltas, but also slightly range bound.
Yep, and implied volatility levels elevated at this point. So if you get that crush, maybe the near-term options contract at a quicker pace. You got some assignment risk on that short 850 call going into expiration over the next 10 days. So good look at a calendar, relatively neutral. Slide a little bit lower here for the apex of profitability. All right, thanks to Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. But coming up after the break, we're going to be joined by Landon Swan from Likefolio for a look at sentiment data in Target. The retailer stock has lagged the market this year and the sector, up only about 10% so far into earnings tomorrow morning. Stick around.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl?
Schwab, a modern approach to wealth management.
Welcome back to Fast Market here on the Schwab Network. It's time for cash tags. For that, let's bring in our next guest. It's going to be Landon Swan, co-founder at Likefolio. Welcome back to the show, Landon.
Thank you. It's great to be here.
All right. So Target underperforming in this space. Walmart had some good earnings. What kind of data do you guys have on Target going into this report? Because it seems like the bar is relatively low compared to maybe some of its competitors.
I know you see what Walmart did, the reaction that they had, very strong earnings report, and you would thought that Target would run up more than it has today. It's kind of just moving with the market a little bit, right? But Walmart reported that there's more discretionary purchases happening. Holiday shopping's already started. I think that maybe there's some concern that consumers are trading down from Target to Walmart, and that's why Walmart did well. I'm not taking that stance. I think that this is a rising tide kind of situation, and both boats are going to be lifted. The data that we've got shows that Target is maybe not doing as well with Walmart when it comes to the hardcore consumer demand data, but happiness is picking back up. And we're seeing some snap reversals of some downtrends when it comes to their digital data. So, when we look back at what Target talked about last quarter, I mean, they raised their forecast. They said that their brick and mortar was doing well, digital's doing well. We know that the consumers are very happy with the same-day delivery. Their loyalty on their rewards program is very strong, and that kind of matches with what we've got, and we've actually seen a lot of that continuing. So when I talk about a little bit of a snap on the reversal, so their digital numbers, websites and app visits were kind of downtrending for a while. In fact, if you look back to about 3 months ago, it was negative 11% year over year. But now we're actually moving to positive 3%. We're looking at apps here. This is positive 7%. And you can see there was a little bit of a downtrend over time, but we've got a pretty sharp snap on that side to that. Now we're positive 7% on a year over year basis. And again, this is year over year. So we're comparing apples to apples, even though we're moving into that holiday shopping season. We're doing better than we were. And for a long time, we couldn't say that. A very similar story when it comes to web visits. It was negative 11, now it's positive 3. So that's a 14-point move in just a few months. Now they aren't doing as well as Walmart. Walmart is doing better, as you can see here. I mean, they're Amazon is, I'm sorry, Target is plus 3, Walmart's plus 8. So we knew that Walmart was going to come in with better numbers than Target, but a lot of the stuff that we're looking at, this is just consumer demand. When we look at happiness, Target has had a big increase in happiness, and a lot of it has to do with that the loyalty program, that $99 a year. You get same-day delivery, you get free shipping, and you get other perks, including delivery from Shipt. For all that stuff goes with Shipt because they own it, and then you can combine that with other retailers that work with Shipt, like Sephora, CVS, Publix. So it's kind of it's a nice benefit for users, and they're actually talking about, some of the things that we see online. People are talking about how when you order with Target on Shipt, you get it in 1 to 2 hours no matter what, whereas with Walmart, you'll get it the same day, but it's hours away, right? Maybe 4, 5, 6 hours. So, I mean, it just shows how greedy we're getting at this point. I can remember when we had 2-day delivery on Amazon years ago, and that was unbelievable. Now you want it in an hour, and if you don't get it, you're switching services. But, it's really incredible what these companies are able to do. And everything that we're seeing is basically telling us that, yes, Walmart had a great quarter. We kind of knew that they would, but we don't think it's an anomaly. We think that Target is moving along that same trajectory, and they're actually reversing some of the negative trends that they had. So now it's just a question of how do you play it, right? I mean, last quarter they jumped from 144 up to 159 on the stock on our very good earnings report, and they ended at 159 at the end of that day, and we're basically 158 now. So they've been kind of sideways, up and down. We're at the sort of the higher end of the channel, I guess. But I still think there's room for upside. I liked it a lot better yesterday at the open at 153 than I do at 158 now. But given all that we know, I'm bullish going into this report.
Landon, when I saw the Walmart news release, I thought the same thing you did. Because of the focus on discretion, remember, it was a couple of years ago, the genesis of all Target's problems was the big miss in discretionary inventory and how they had to lower margins to get rid of that inventory. I think if there's any real recovery, and remember, Target is a fraction of the size of Walmart. 8 billion outstanding shares versus 460 million. This is a small company compared to Walmart, and it's got a much lower PE and a much higher dividend yield than Walmart. So, I mean, there's a lot of positives here if they can find their niche. Now, the risk, in my opinion, is that Walmart's eating their lunch and they're taking their customer share. But your data does not show that, and that's, I think, promising for a company like Target if they can just find their place in the middle of this big box retail.
Right, I agree with you completely. Now, the thing about these two companies is for a long time, Target was always seen as the kind of the higher class version of Walmart, much smaller, but much nicer stores. Consumer happiness scores were always coming in higher. And over the last 18 months or so, we saw that gap close, and I think there was even a few quarters where Walmart happiness was higher. Target got into some political stuff, and you get polarizing voices there. But I think that kind of reversal really worried investors, excuse me, because if Target doesn't have that, then what do they have, right? They don't have the size to compete or the pricing power. So if they don't have that the conception that they are the higher class version, then I think that's very concerning. And Walmart, to its credit, has done a lot to up its game as far as perception of quality, the niceness of their stores. So that, I think, was a big concern for investors, and I think it was a legitimate concern. Now we're starting to see Target move in the right direction, competing on happiness again, competing on consumer perception, and they're getting back to where they were. I think they had a little bump in the road there, but now they're on the right track. So if they are valued lower, and if they do have all this upside, if they're perceived as the better company as far as consumer experience, then they have a lot of upside competing against the giant. And I think you just got to look into this. If it's discretionary that really moved the needle, just like you said, and that's where Target's going to pick it up. It would be really surprising to me if discretionary money went into Walmart and it didn't also go into Target. So I'm a little surprised it's not more up today, the stock, but I think that's an opportunity for investors.
It was actually down.
Yeah,
in the morning. It's 154.
Right. And Len, I know you guys are bullish on this one going into the report. Stock up now 11% so far this year. But, if you look at retail sales, back to school was during this quarter. Circle Days was mixed in there also. So that should probably also give them a boost, right?
Yeah, absolutely. And I mean, Walmart talked about how people are already starting holiday shopping, back to school shopping is going to be in here. So, you've got the reported quarter with back to school, you got the forecasted quarter with holiday shopping. So, overall, the data that we're seeing is that people are moving back to Target, whereas the last, again, 12 to 18 months, they had a perception problem and they were really starting to trail off. It wasn't significant, but it was a downtrend for sure. And this quarter, it looks like a snap on that to the right side, to the upside, which is where you want to go as an investor. So, I don't think it's going to be a giant surprise, but I do think that there's opportunity for the upside because people are kind of pushing them to the side saying, I think that was just Walmart that had a great quarter. I don't know about Target. And I'm saying, no, I think they're both having a great quarter. So I do think there's upside here. And, for those interested in the score from negative 100 to positive 100, our score on this one's plus 56. So we're more confident than a lot of our trades. This one we like.
Yeah, bullish on Target going into earnings. That's a high score, 56.
Data doesn't lie, people do, Tom.
That's true. All right, great stuff. Great data as always, Landon. Have a good day.
Thanks, guys.
All right, that's Landon Swan, co-founder at Likefolio, breaking it down for us. Option market pricing in about a plus or minus $13 move, Cap.
Small move, and like I said, not a big. I mean, the float is not small. We certainly report on smaller floats along the way, but $8 billion for Walmart versus 460 million. Tom, the practice trade I looked at was just this. Doing a diagonal. Now, I did it earlier in the day, so it may have moved a little bit, but buying next week's 155 call, selling this week's 167.5, just getting in line with the expected move. Now, it was 450, 460 earlier in the day. It's now over $5.
We've got it 490 here. It's probably just about 510 right now. So it's moved up with the overall market.
Exactly right. So, but remember, the stock was trading 154 today.
Yeah.
So it spent a lot of the morning lower on the day. But all I know is the first thought when Walmart came out with their earnings today, I thought, Target. What does that mean for Target? Mm-hmm. If discretionary is stronger, how does that do Target? And like I said, Target, unlike Walmart, valuation is cheap. Yep. So there's that too. Doesn't mean the stock's going up. If they miss, I mean, remember, this stock has a high of 268 from a couple years ago.
Yep.
So it's not like it is beat up. And like I said, it's almost like it's failed to find its niche with all the retail. Maybe it is.
Discretionary inventory issues they've had in the past. Do they ride it? Well, Likefolio seems to think so. And so did this example trade sets up with that upside bias here. November 29th, weekly options, 10 days to expiration. Buy that slightly in the money, 155 strike call. Sell the 167.5 strike call in the November 22nd weekly options that expire in 3 days. Paying roughly about a $5 debit for it. The debit you pay is going to be a risk, so about $500 or so on this one. Break even above 158 most likely on this one. But you're playing the dispersion between implied volatility levels. That's why you're buying basically a $12.50 wide call diagonal and paying about $5 for it. So less than half the price of it, because you're buying about a 68% implied volatility on aggregate in the November 29th. Weekly options on the 155 strike selling about 115% in that November 22nd weekly 167.5 strike call. As I mentioned, the break even around 158, a little bit higher than that. Apex of profitability at or near that 167 strike. You'll have one opportunity to roll that, create some credits, increase potential profitability. Got some assignment risk on that short option over the next 3 days going into expiration also, so keep that in mind. But a good look here at a bullish call diagonal setting up with like Folio's data at this point on target going into earnings. All right, let's take a quick break. When we come back, we're going to take a look at another retailer, it's TJX. The off-price retailer stock's up about 27% so far this year, near all-time highs, into their earnings report tomorrow morning. Stick around.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network.
Welcome back to Fast Market here on the Schwab Network. It's time to talk some more earnings. Got TJX reporting ahead of the opening bell tomorrow along with Target. Let's bring in George Tillis, Senior Markets Correspondent here on the network. George, it seems like the last few earnings reports out of TJX has kind of showed the resilience of this off-price retailer with the stock near all-time highs. Give me your take here on TJX.
Well, I'm going to start off by saying, I mean, I was quite surprised. I really haven't looked at this company very often or in the past, but I was quite surprised how large they are and how much in sales they actually generate. I mean, $56 billion in sales last year. The market cap's basically $135 billion. So this is actually quite a large company now. Over 5,000 total stores, including their flagship TJ Maxx and Marshalls and Sierra stores. But a couple of other things to point out about their underlying business as well is they've expanded obviously very large domestically in North America, even South America, but internationally they really only have sold about 2% of their total sales. So there's a lot of potential for TJ Maxx to grow their international business. That might be something the analysts will ask the executives once they report earnings. The other thing is, if you look at their earnings and sales, they're expected to be modest, but earnings are expected to be growing faster than sales, and that's what you want to see with these nice trends of the stock higher by about 27%, like you mentioned, year to date. And in the last 5 years, the stock has nearly doubled, up 96%. But they're expected to earn $1.09 in terms of total earnings. That's higher by 6% compared to the $1.03 for the same quarter last year. $13.95 billion in sales for the quarter, higher by 5% compared to last year for the same quarter at $13.27 billion. And one of the things about this name also, it's not just the overstocked items, the home furnishings, their seasonal and off-season brands, as well as, again, off-label brands. The company is also, if you look at the valuation for the business, they're expected to grow their sales still modestly at 6%, but in the next year, their earnings are expected to grow by 12%. So their earnings are expected to grow about 2 times their sales. That speaks to strong trends that may continue, as well as the fact that the company's paying about $1.50 per share in terms of dividends compared to next year's $4.17 in earnings. That's about 35%. So you're getting basically income as well as growth in this particular name.
George, this company had a nice beat a quarter ago in terms of earnings per share and revenue and comp sales up 4%, but they guided very conservatively coming out of that earnings, which could set them up for another nice beat this quarter because the stock is pretty much flat. It jumped higher on earnings and then has stayed pretty much, a little bit lower now. All things considered, it's flat. They're now going to Dubai in a company called Brands for Less. They're opening more stores here. This treasure hunt style of shopping that they do is exploding, and it's becoming extremely popular, and it's brick and mortar. You have to go in there. So, it's amazing the evolution of this kind of a store.
It is, and that's why I started off the segment by talking about I was quite surprised how large this company has become over the years. And the primary focus is still brick and mortar because of the fact that it's tough to keep up with consistent sales of unique goods that again come and go based on off season and off label types of products. So I think that's something to keep in mind. But they have such a large array of different furnishings and home goods that change all the time, and that's why I think it's so hard for this business to grow its e-commerce style of footprint. But nonetheless, they're making a lot of room in that area. But irrespective of e-commerce, which we always focus on that being more profitable, you just look at the profit profile of the company. Their gross margins are about 250 basis points higher than their average. This is the last year compared to their 5-year average. Their net income is higher by 250 basis points. So that suggests to me that we consider TJ Maxx more of a discounter. They have had pricing power in the last year. But if you look at those ratios, they're pretty equivalent, gross margins to net income margins. So that suggests they're not generating more operating expenses per dollar of sales, or not much at all. And that's quite powerful. And so maybe this is why a lot of the analysts still have some EBITDA growth targets that are about 12%, considering this quarter they're expected to grow their earnings only 6%. Compared to the same quarter last year. So I think there may be something here, considering their, as you mentioned, conservative guidance. But anything can happen. But I do like the fact that you pointed out that the stock could gap higher and has been trading sort of sideways since then. But overall, the trend is a nice mild trend and it's intact. But the last thing I'll keep in mind here is also that dividend, and that dividend that they're paying does suppress the price action, and that's fine because they're just basically moving the money off their balance sheet to the shareholder.
All right, great backdrop for us here, George. Going into earnings, as George Tilla, senior markets correspondent. Kevin, option market pricing about $5.40 move either way. Looked at a strategy that takes advantage, like you did on your diagonal. I looked at a double diagonal where I'm buying something a little bit cheaper on implied volatility, selling something elevated going into this report. So I looked at a double diagonal position here We're going to buy it out of the money call diagonal and out of the money put diagonal. Combine those. I'm going to collect a credit. So going out to the November 29th weekly series here, buy the strangle, the 127 call, and buy the 110 put. And then in the near term, November 22nd weekly options, I'm going to sell the 124 call, sell the 113 put. Collecting a credit of around 60 cents. It takes my break evens about 111 on the downside, maybe 112, all the way up to 126 on the upside for this, Kevin. But you're collecting a credit, so if the stock doesn't even move, you're going to actually profit on this one because of the credit that you're collecting on this type of double diagonal position.
A different look at the double diagonal, right? Because you do it from the short side, and what does that do? You can tell the much smaller debit you pay for something in the calendar spread family, but the risk stays the same. It is the short strikes where you peak out, and the risk is the width on that on the diagonal from the vertical spread that you're now short the vertical spread within the diagonal.
Yep, collecting a credit of 60 cents makes your risk, and that's far below. If it goes down to 105 or goes up to about 130, you're probably going to have a risk of about $240 per spread on this one, because the 60-cent credit that you collected
minus the $3,
minus $3 on each one of those diagonals. So good look at that one. Now you just want it to go towards either one of the short strikes. All right, that's going to do it for us today here on Fast Market. Make sure you stick around right here on the Schwab Network. Next Gen Investing is coming up.
Join me, Oliver Rennick, alongside Schwab Network's options experts as we explore the second derivative. Gamma On is a brand new limited series to take your trading skills to the next level. Subscribe to Schwab Network's YouTube channel now.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
Of Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Jenny Horn alongside Alex Coffey. And Alex, we're seeing a bit of a mixed session today. We are seeing still green, relative green sessions in the S&P, NASDAQ, and the Russell. The Dow is our weak spot today, which is down about 0.3%. All things considered, though, a pretty muted session as far as price activity goes. I know that we saw initially this morning VIX remaining elevated, up about 3%, but it's actually been moderated from when I looked at it this morning. So Bitcoin higher was one of my focuses, but all across the board, though, big tech is higher today.
Yeah, geopolitical sell-offs continue to be opportunities to buy the dip, and we saw that this morning. Some escalated tensions in the Russia-Ukraine conflict. Some of this, I think, has to do with, post Donald Trump's election victory, there was almost like a geopolitical risk recalibration where it was almost like we were starting to, price out some of these, these risks, and you saw that reflected in gold, you saw that reflected in treasuries. And like anything, I think the pendulum can swing too far. There's still, a few months until the new administration takes over. There's still a conflict going on between those two countries and other conflicts throughout the world. So maybe a little bit naive of the market to price things out the way that it did. A little bit of a recalibration today, but quick dip buying as buyers stepped in basically right at the open and haven't really looked back. We're near session highs, and it's been a pretty impressive turnaround.
It has, and I think to your point that there was an exuberance that was maybe a bit irrational following maybe the election result, and now we're starting to see things settle because there is still, major, all of the risks to the market that we were discussing prior to the election are still, a lot of them are still there. I just think that the fact that we have at least a new administration that we know of was like the relief rally, but yeah, we got very overextended as far as like price to the upside. Now we're just seeing things, I think, more moderate, but we will obviously have to see where we close today. We will kick things off, as always, with upvote and downvote. We'll be charting and trading our upvoted names. And for FOMO today, we're actually revisiting one we haven't looked at in quite some time. That's C3AI, which saw a nice lift on the back of an expanded partnership with Microsoft. So always good news when you can tie yourselves to one of the largest names in big tech. We'll also be looking at a lot of the analysts' bullish momentum as far as like price activity going into NVIDIA's earnings due out tomorrow after the closing bell. So I would say we were joking yesterday, not joking, but it's one of the biggest events for the rest of this year as far as like major market moving catalysts. And we'll close things out with XPeng, which did rise earlier today, then gave up some of that strength after reporting better than expected quarterly results.
Yeah, tons to get through. Looking forward to the NVIDIA discussion. As I said, I do think it's probably the biggest event that we know of on the calendar for the rest of 2024. As we just know, it's been such a symbol of this AI trade, as well as the big tech trade and the momentum trade, everything you want to say trade, it seems, within equities. NVIDIA has been, symbolic of. So looking forward to that discussion. Let's do upvote, downvote, though, not endorsements, not recommendations. A couple big names kick things off, couple not as big names towards the end of this particular segment. Let's start with one of the big ones in Costco. No earnings yet, but we do get numbers from them monthly in terms of sales. Business model is, relatively straightforward. Pay for a membership, get access to wholesale goods in the warehouse. It's a really popular place for those who are members.
I know, and they have a membership retention rate of over like 98%. So they not only do members that join Costco like it, but they continue to really love it. And that's why I think this name has seen such resiliency in a very difficult big box retail environment. Also encouraging that we saw a pretty nice report out of Walmart where it was very difficult to find anything not to love about those numbers. So they do release some more quarterly updates on December 12th, but until then, we did actually see earlier this month, they reported sales that rose about 7% year over year to $20 billion during the month of October. Same-store sales were also up about 5% over that same time frame, with a 19% jump in e-commerce sales. So still growing at a pretty healthy clip as well. Management did note that sales during the month of October were negatively affected by a pull forward in sales from the abnormal consumer activity that was associated with these port strikes as well as hurricanes. So they did know that might have been a one-time benefit, but still pretty strong October sales. And of course, we get a good glimpse of their sales on a month-to-month basis, like Alex said. But Evercore, to kick off this week, did raise its price target to just over $1,000, $1,010 a share from $810. Outperform rating. BMO also did maintain its outperform rating with a price target of $10.75, up from $9.80. And that is as high as I could see. The highest previous price target was just over $10.60 a share. The low I saw was $6.75. So makes sense to see that this name definitely skews more bullish. We have 25 buys and 14 holds and no bears in Costco.
Yeah, a lot of analysts love here, 60% in the buy camp thereabouts. And as you said, that street high from BMO Capital is that 1075 mark. So one that has a lot of love on the street. When we're looking at this name, though, it's hard not to notice that it has pulled back a little bit. It's modestly off its highs. Probably by about, if I'm doing some quick math, maybe 4% off those highs. So something to consider as we do have earnings coming up at the early part of the December month. And maybe not going to be quite the market mover that NVIDIA's earnings will be, but certainly one that gets the attention of investors when they do report. Let's talk CRM. This is another name that reports earnings in the next few weeks. That's a pretty big name. Also has had a pretty notable pullback. It's probably about 10 or so percent, a little bit less than 10% off its highs, down over 5% in the last week. Salesforce, a name that had been such a strong performer for so many years. Kind of a rough go the last couple years, but starting to reestablish itself.
Yeah, I mean, I think definitely trying to carve out a niche in AI, because there was this thinking, this was one of the early adopters of AI, given, I mean, its sales and its platform's adaptability. But then there was the concern of like, wait a second, is AI actually going to completely disrupt this business model? I put them in the same bucket as like an Adobe, where they were initial winners of the AI trade, and then it was like, wait a minute, what does this actually mean for the long-term growth? Because AI, of course, is not going to benefit all of these industries equally. But Scotiabank today did start coverage with an outperform rating, 425 price target. So that was actually, again, one of the highest I could see. I believe the highest, previous high had been 415. But the firm, which does name Salesforce a top pick in the group, so that after a choppy year after the software sector, followed by then a pretty solid 3 months, they think there's an opportunity to generate alpha at this point by continuing to own these clear market winners. So as well as companies with re-rate potential or these benefits of AI, they also do like those type of names. But in the firm's opinion, stock picking has become more crucial than ever, with the bulk of investor interest being in semiconductors, to question on whether software businesses should still exist beyond 5 years. As we know, the software space has been the losing area of the semiconductor AI world. But we've seen a recent uptick. So they do have earnings December 3rd, so we'll get some update relatively soon. I know December sounds like it's a lifetime away, and then I remember it's in like 2 weeks. So we have that to look forward to as far as like still quarterly earnings to parse through. If you look at a 3-year or so time frame, you can really see this giant, what I would think technical analysts would describe as bullish pattern in the stock. It's a really, really big cup with handle, a breakout, and then what technicians like to see, a pull back to that former resistance level, which where we sit now. So, I mean, from just a chart standpoint, there's a lot to like in terms of CRM. It is at a pretty critical level. If it were to break back into that pattern, it would be a kind of a failed breakout, which is not a bullish look. But this is so far basically following exactly like the technician handbook would tell you it would. A breakout of that really long-term resistance point, and then retesting it. If it were to bounce here, it could be very, very interesting in terms of what that may bring for the end of this year and into next year. All right, next one on our list, though, is Symbotic, I believe is how you say it. I'll be honest, I have never heard of this company until today. It's making a nice move today, but it's an AI robotics company, and it's really in that kind of automation technology space, of which we're hearing more and more about. You see Tesla working on those type of products and working on that kind of research. This is another one of those companies. Okay, this one jumped out to me because I do always like to look at like these big movers, and thankfully to the upside today. But I noticed, I mean, like heavy volume, really nice upside today, and it hasn't actually really lost any of that momentum on the session. So I had not honestly never heard of this name either, but now at least attempting to recover on the year. We were down about 40+% on the year into today, now having a pretty nice session, up now 30% this week thus far. And this is really due to its strong quarter, as well as offering some upbeat financial guidance. For its fourth quarter, the company reported earnings of 5 cents a share, swinging substantially from a loss per share of around 8 cents they reported a year ago. Revenue also did come in around $576.8 million, well above consensus at around $470 million. So it's not often you see a company beat its own expectations by about $100 million. And they did say that they're looking forward to the beginning of 2025 and that they expect continued strong top-line growth as well as stable gross margins, which, along with their targeted investments to capture on their expanding set of opportunities, they do see now even stronger guide going forward. They did say that they forecast revenue between $495 to $515 million. Again, well above expectations at $493 million. And I was reading a William Blair note that noticed that they are really proving their ability to quickly put out fires, having yet again right-sized their supply chain and delivered another strong quarter of margin performance following a project delay that impacted their previous quarter. So at least showing their ability to navigate rough waters, and I think that's huge, especially as building out your credibility as a company that's trying to be a formidable player in AI.
Yeah, and $22.5 billion market cap. Like, it just blows my mind that there's just companies that carry that type of valuation that I've just never seen.
I know.
Almost 30% short interest. So there's a fair share of doubters on this company. It's not been the strongest of performers in 2024. But if you were to zoom out a little bit further, maybe a 3-year time frame, whatever you want to choose, it does look a little bit better on that longer term, going back to when it first became public, kind of around 10. And so longer term, nice winner, but recently it's basically been cut in half from its highs at the middle part of last year. So early AI winner, maybe. We'll see if it can build on some of those successes going forward. Monster move here today. Next one is Reddit. Really successful debut for Reddit as you look at its performance that's becoming public. Surprised by it, to be honest, but maybe we shouldn't have been, as the social media, digital ads, and that kind of ecosystem of a user base that is loyal and reliable has been a really strong part of this market. You see it in things like Netflix, you see it in things like Meta, of course. So maybe we shouldn't be so surprised that Reddit's doing really well.
I know, because frankly, it's like Reddit to me is the most like simple, unchanged platform, and I mean that honestly as a compliment, because I do know that from like the various features that are rolled out on Instagram or Facebook, or I don't have TikTok, but I could imagine as well. It's like then their loyal followers get so mad at any updates in the platform. I can't recall a time that Reddit has ever made an update to their platform, and I like that. I'm a tried and true Reddit user, and so I like that they haven't changed anything in what feels like the last decade or so. But they also had a really blowout quarter at the end of October, and then we saw a significant gap up. Amazingly so, they've been able to hold on to this nice new level. They've tested up another 11% this month. Piper Sandler did update its price target, though, to the upside of 150 from 115 with an overweight rating, saying that its October ad metrics actually indicate that Google is starting to monetize searches with Reddit in its title by posting these paid links and products ads above its organic results. So the firm's data has not seen an impact to Reddit users or pricing based on these changes, but the debate remains on whether sustainability of its user growth as well as its ad data will continue to provide this substantial top-line growth for Reddit. So they did say they increased their 2025 revenue and EBITDA estimates by about 5% and 15% respectively, and they do continue to see the company achieving more and more of this robust monetization, given the average revenue per user growth of around 9% they think is achievable now into the new year. There's 11 buys in this name. There are now, I believe, 5 holds and 1 lone sell. But, I mean, a name that definitely does still skew more optimistically as far as street coverage.
Yeah, it feels like one of those names where we could look, back, 6 months from now and say, oh my gosh, how is that stock $136?
Right.
And it's because it's 200 or it's because it's 40. Like, you could tell me both things and I would believe them. It's just a volatile name. And right now, one that seems like the elevated risk maybe surrounding it. You look at consensus price target for the street, it's around 115. So it's way above that now. And we kind of joke about me liking to talk about Pinterest, and I always say I've never really used it. This isn't entirely true because sometimes you'll Google search something or whatever search engine you use, and a Pinterest thing will come up. You'll click on it, etc. So maybe a handful of times you've interacted with the platform. Reddit's the same way for me. Maybe a couple times something from Reddit has come up on a search, and that's about it. I've never really had interest in this platform, but I might be in the minority in terms of those who do like it, do seem to flock to it.
I love like the threads that get you down like a whole nother rabbit hole of information where you're like, I don't even care about this topic, but here I am like 20 minutes later. That's like my ultimate social media scrolling, is I just go down these Reddit threads. So yeah, I'm a fan, but I can understand it's a very niche target demographic, I think, as far as like reading these various threads. But we'll actually be looking more into our upvoted names today that have earnings somewhat on the near-term horizon. We'll be looking at Costco as well as Salesforce. Some example trades also in both of those names. Stick around, Next Gen Investing. We'll be right back.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. It's now time for our Chartmaster segment. Today we're looking at Costco as well as Salesforce, both with earnings due out in the next several weeks. So not near term, but at least to look forward to on the horizon. So joining us now today is our honorary Chartmaster, Kevin Green, to break down the technicals for us. So Kevin, we'll start off with, objectively the better of the two, although very different companies. Costco, have to imagine today seeing some degree of move on the back of Walmart's pretty strong report, but they have their own news and own analyst calls, so walk us through what you see from a price perspective.
The chart has been remarkable when you're looking at the upside move over the last year, and you could make the case that it's a little bit stretched, but if you even look at the price action, you could have said that 2 months ago, 3 months ago, 6 months ago. So the uptrend is definitely intact here, and if we can continue to see a move to the upside here, I would say the big target that's on everybody's radar is that 1,000 level. But if you look at point A, what's really nice about this stock is it has been able to do these SR flips, or the support to resistance or resistance to support type of flips here. We see that with point A, where we were testing pretty much that $790 level level back in March. That was an area of resistance. Then we broke that and now utilize it as an area of support where we came back and tested it in August, moved to the upside, and then once again kind of range bound between 873 and 922 before trying to break out higher. Now we are coming back and kind of retesting that upper end of that channel line that's in purple there, but this is kind of that retest that we've seen so often for this stock. So you'd like to see a nice little push to the upside on very large volume. Once we get to that 1,000 level, we might see some sells triggering in the market. It's really big psychological level. And if we do see a breakdown, once again, kind of going back to those previous areas of resistance that have now turned into support are going to be very key. Even looking at the 200-day moving average was sitting at around $821, still keeps the stock into an uptrend. You are seeing maybe a little bit of momentum or lack of momentum. If you're looking at the RSI, kind of consolidating a little bit. MACD, for the most part, looks like it wants to hinge and kind of cross lower, but the trend is upward here. It's hard to really fade this name here, Jenny. It's just been a really good chart, especially for the industry that it's at.
I know, and one that is a rare perspective. When you only get stronger, it feels like when you zoom out, you look at a 3-year weekly chart, which is usually when you start to see some of like the momentum shift. I mean, like the price can dip and it just looks even better. A name that has consistently taken out higher highs, higher lows, and like you said, we're at this now somewhat, no pun intended, uncharted territory, high of 962, which we pulled back slightly from, but I mean, still, all things considered, as healthy of a chart as you could really see. I think the only thing comparable has been Walmart on the year. So now, when we look at trading this name, I do think that, again, given the fact that we are basically at a level never seen before, the importance of standard deviations is one sentiment that Rick always mentions, but we've risen about 40.6% on the year, 65% over the last 12 months, pulling back about 3.5% from that all-time high. But walk us through how you would think about trading this name for example purposes.
Yeah, I think it just comes down to if you're wanting to go with the trend. Obviously, you have that earnings event to contend with the second week in December. So I elected to, avoid that earnings event, only go out to the December 6th cycle, and then kind of going with that bullish trend that Kevin talked about, looking at a neutral to bullish strategy in selling a put vertical below the market. If you were to look at some of the moving averages, for example, maybe a 1 month moving average in Costco on the EMA side, it's right around 909.72, so let's call that 910. That's acted as a level of support many times in the past, and so if that were to happen again, perhaps it could be a level that you use when selecting strikes. And so I looked at selling the 910, 905 put vertical in the December 6th cycle. Looking for about $1.50 credits. That'd be 30 cents for every dollar of risk, in creating a risk reward there of a little bit worse than 2-to-1, where you risk 350 with a chance to make 150. Break even at 908.50 would be just below that potential support point on this strategy. Now, again, this is going with a trend. It's also utilizing kind of the volatility structure to the advantage of the trader. You have a little bit of an elevated implied volatility at the moment in this name relative to itself. With the implied volatility around 28%, that's a 12-month percentile of around 60, so on the higher side of things. So a strategy that sells that higher volatility sometimes is preferred by traders, and so that's what this one looks to do. Stay above 910, that's the best case scenario. Only has to be there for a couple weeks. If earnings send it lower, so be it. This trade will have already expired by that point, and so it would not be impacted.
Yeah, and now to completely shift gears and look at CRM or Salesforce, which is up 22.5% on the year. And if you can recall, this name had a pretty ugly move to the downside. I believe it was 2 quarters ago. We've been trying to regain some of what was lost. And I will say we did peak out around $348.86 a share, and we've been substantially declining since. So Kevin, even though we're definitely closer to the high, we have pulled back about 7.7% from those levels.
We have, but you know what, it actually is still a bullish trend if you look at it. You also kind of talked about it late last year, going into earlier this year. We saw a nice little move to the upside. We kind of hit that 317 level, then kind of ranged out between pretty much 310 and let's say 290, 295 before breaking down. We broke down at point B. We did see this ascending channel line that's ultimately bullish. We were also kind of riding that 200-day moving average as an area of resistance. We broke out, now utilizing that as an area of support, and we've been moving higher ever since. challenged that 317 level, broke through, hit 348. Now we're coming back, retesting that breakout level, which is actually normal and healthy. But you want to be able to hold this level right now. If we have any further breakdown, look for that channel that we talked about at point A, just move that over to point B. Could be another your new value area for the stock, which once again is going to be sitting at around $295, $310. And if not, if we break through and break down even more, you're looking at the 200-day moving average, and then obviously looking for some other areas around that point of control on the volume profile. But this chart does look pretty strong here. It's just a breakout retest that's taking place. Now, when you're looking at the RSI, still relatively strong, making higher highs, making higher lows, but the MACD does look like it wants to kind of curl and cross with the 12 EMA below the 26 EMA. Even though we are above that zero line, that's kind of your first indication of a minor pullback in this stock. Let's see if that's actually going to develop here. But Jenny, this is actually a really decent and clean breakout retest. Let's see if it's going to be able to hold.
Okay, Kevin, I like that. That's more optimistic than I would have said at first glance. So I always like to be proven wrong to the upside here. And just curious before we let you go, I did notice there's a market maker move being priced into options at least around $5.84 a share. Is this because of NVIDIA? Is this because of, like, I know Snowflake has earnings tomorrow. Why are we expecting, I mean, like, this increased interest in, like, price movement with there's not really any major news imminent?
Well, it's because of the reaction of the stock over the last 3 or 4 quarters in its earnings. So usually when we have an outsized move, especially when you're looking at point A where we had that breakdown in the stock, market makers are going to try to increase the premiums in order to try to hedge themselves. If they do have a really good report or a bad report, they try to utilize that premium in order to kind of give themselves a little bit of a padding. So it could be NVIDIA. If you're looking at it across the board for options, especially in tech and communication services, NVIDIA has increased and ramped up the IV pretty much across the board, even on the index level. But this is also a stock that can move, and we've heard some really positive commentary coming from this company over the last 3 months. And if we get some further follow through, maybe that's going to also lead credence to more bullishness for this stock. And the technical setup kind of tells you that maybe that could be the case, especially if we close in the manner that we are doing today, which is pretty much a hammer candle at that low, at that area of support sitting around 317. So rightfully so, IV is going to be pretty elevated here. It might be a trade that Alex tries to set up here that might try to take advantage of that. Who knows?
Okay, great insight. Appreciate it. Kevin Green, Senior Markets Correspondent for the network. And to complete segue from what Kevin just said into now the trade, of course, we're looking at CRM here. We do earnings Tuesday, December 3rd after the close. But per all of Kevin's technical analysis, I mean, there's upside to be had in this name, which is encouraging because I've been a bit down on some of these software stocks. So I enjoy that perspective. So walk us through how to think about this name, of course, for example purposes.
Yeah, we talked about this in the first part of the show too. It's a longer term bullish pattern. It's not just this year. It really goes all the way back to October of 2021, the giant cup with handle, the breakout, the retest that Kevin talked about. It's not just that little kind of saucer base that you see for this year. That's actually the handle piece of the pattern. So it's a very big pattern. We've actually looked at in recent months, I believe, an example trade that was a little bit more aggressive, looking for a pretty significant up move by January. But I looked at something that was a little bit closer to the vest in terms of risk, and something that's a little bit more high probability of success. Really, looking for that support level to hold more so than seeing more upside. And so with this, it's similar to what we looked at in Costco. It's selling a put vertical below the market, and it also stays ahead of that earnings event by going out to just the November 29th expiration. It's not this Friday, it's the following Friday. Of course, that's going to be a holiday disrupted week as well, so bear that in mind. But it's a 312.5, 310 put vertical. If you could get somewhere around 50 cents, that would be 20% of the risk. Creates a 4-to-1 risk reward. You can make 50 on $200 in risk. 312 is the break even. And really, you just need this stock to stay above 312.5 by the end of next week. Right now, it's got about, let's call it $11 in cushion for that to happen. And some pretty key multi-year former resistance, perhaps now support to contend with right around that mark. So really, really interesting. And also to note that 1 month EMA that we used for the strike selection in Costco also corresponds quite nicely here in this one as well, with that around 313, so just below that mark. But with this one, Jenny, not looking necessarily for upside for this exact example. Since we're staying ahead of earnings, it's short dated, just looking forward to hold on to its current price, not go much lower.
Yeah, and I think this is more somewhat in line like the near-term trends. I mean, we don't really have any like major catalysts. I know I was joking NVIDIA earnings, but hey, I guess we could see a movement. We also could not, though. That's the risk of course, betting so much on one company's earnings that aren't even Salesforce, for example. But we'll leave it there for our Chartmaster segment. Now, coming up next, time to talk a name that is definitely one of the original players of AI. I can't say one of the strongest or largest, but that's C3 AI, which is making a 24% move to the upside today following news of their expanded partnership with Microsoft. So we'll dive into the details coming up next.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl?
Schwab, a modern approach to wealth management.
Accelerate your market knowledge.
And shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go, at 12 p.m. Eastern on the Schwab Network.
Palantir is one you have to look at in the next 4 or 5 years. I mean, Albert, this is a new story being built when it comes to AIP and it comes to the Palantir enterprise piece that's not being factored into the stock. The trajectory here, I mean, we could start to be looking at $4 billion, $400 billion, $500 billion. Could this be a $1 trillion valuation? If they continue to execute, that's not out of the realm.
Tune into the newest episode of Market Overtime as Oliver Rennick sits down with Dan Ives to discuss why the AI revolution may just be the beginning. Market Overtime debuts Monday at 4:30 p.m. and airs all week on Schwab Network and on our YouTube page. So welcome back to Next Gen Investing, and now it's time for FOMO and actually continuing a lot of the AI conversation that was of course just teased by Dan Ives. We're talking C3 AI, which has amazingly held on to a near 24% move for the entirety of this session thus far, Alex. I mean, a huge pop. I have to say that we talked AI, or C3 AI at the beginning of this year. We joked that this was the most lucky ticker that they snagged somehow. It hasn't really garnered the same headlines and attention as such to follow. I mean, I think there was, again, like these initial adopters of AI that just haven't been able to be the NVIDIA type player. I mean, a lot of these names at this point, but at least with some news today that they are now expanding this partnership with Microsoft, so that's something.
Yeah, I would argue that the most valuable thing this company has is the ticker in terms of what it's doing. It has no path to profitability as it stands right now. Analysts aren't projecting, even a penny of EPS profit until perhaps 2027. This isn't a market that's been super kind to this non-profitable growth technology companies long term. That said, it is investing heavily into AI software, which we know is a point of potential growth. And the company that really makes a breakthrough in this potentially has a lot of benefit to reap. And so it does help that they have that strategic alliance now with Microsoft, which is one of the companies that's spending a ton of money in general on this research and building things out from a model standpoint. But one of these super hyperscaler companies. So the fact that they have a perhaps alliance with Microsoft as opposed to seeing them as a threat, at least for now, is certainly good news. It explains the jump today. But this company's got a lot to prove. This is a headline that's getting it to jump today. Is it sustainable?
So that was, I think, like my first question as well. So in this press release, they've been highlighting each other's respective strengths. We do know C3 AI and as well as Microsoft, so they will work together to enhance the existing capabilities and introduce these new innovations that help their mutual customers maximize the delivery of their high-value enterprise AI solutions with Azure. More specifically, Microsoft does intend to integrate C3 AI's enterprise AI application software into its own commercial cloud portal, aligning C3's apps with its new capabilities from Azure, while both working together to deliver these various products to customers. Going forward, though, Microsoft will be the preferred cloud provider for C3 AI offerings and vice versa too. C3 will be, a preferred AI application software provider for Microsoft Azure. But I think the details are huge here, and you asked the question if this is sustainable. As you'd expect between a relationship with a smaller company, I mean, you have a $3.8 billion market cap with C3 AI. You have a market cap of over $3 trillion in Microsoft. Microsoft is going to be the preferred, of course, choice for C3 apps, but C3 is only going to be a preferred provider for Microsoft. I mean, not unusual, but I do think the distinction kind of makes a difference. It also suggests that maybe we could be seeing a bit of some over-enthusiasm today just in reaction to the news. The financial terms were not disclosed. That's always a figure I tend to like to see, just to have like the concrete numbers behind these partnerships. Also want to note that they're already in a strategic alliance with Microsoft. That's been the case for the last 6 years. So again, no predictions of new revenue, no predictions of how profits will rise from the alliance. I'm a skeptic, but I just know that costs right now in the AI build are everything. And so if you can't tell me financial details, I'm a skeptic.
Yeah, there's a lot of question marks, but I think some probably see this as one of those, almost long-term, I don't want to be disparaging to the companies, but almost like, long-term, almost lottery ticket-like, where one of these companies is going to figure this out. And the company that does is going to have tremendous upside. Is that going to be a Tesla? Is it going to be one of the mega cap companies? Is it going to be C3 AI? Is it Palantir? Is it a company we've never even heard of before? Is it OpenAI? Is it a private company? No one knows. Is it a combination of these? Probably, to some extent. But, many might see, kind of like they did maybe something like Bitcoin for a long time, where it's like, am I comfortable allocating a small portion of my portfolio to something that is, ultimately a high-risk asset, but might have tremendous upside if certain things go a certain way. And in the case of AI, C3 AI that is, perhaps it's a big breakthrough. It's more of these partnerships, whatever it may be. As far as today, if you're looking at this, it's up $6 today, this would be chasing momentum. And that's a totally different question. I'm saying more from an investment standpoint. You look at price to sales, the stock trades at a ratio that's 4 times greater than the market itself. So you're not buying something that's cheap. It doesn't make any money in terms of EPS. So you kind of have to look at this as, am I willing to invest in something that may not work out in terms of they may never make that breakthrough? Or am I just trading kind of technical momentum and short squeeze and whatever that may be, excitement and things that could lead to $6 rallies that turn into $12 rallies, for example. Who knows? So it's going to be depending on who the investor is and what their time and goals are for that particular trader investment are. But in the case of today, hard not to at least notice this type of a rally. But I don't know that this changes the long-term story of C3 AI.
I totally agree, and I think that a great, different but good example of chasing that momentum when it works is Supermicro Computer, and then when it unravels, it unravels. Not saying that that's going to be the case for this company, but that's the risk of chasing this momentum in this highly right now scrutinized AI world.
To be really fair though, C3 AI and Supermicro, totally different worlds. Supermicro is actually, the problem is now we don't know if the accounting is right.
Right.
But the accounting that we're seeing was presenting a company that was relatively cheap in terms of valuation and making a fair amount of money and growing tremendously fast. C3 AI, it's more of oh, you're in this world of AI software, maybe you're going to be the one that strikes gold. but you might not be.
Well, right, and I think the partnership with Microsoft, well, it's definitely maybe at least a moderate win. It doesn't change. I mean, like the financial perspective of this company. We do have earnings Monday, December 9th after the close, and we are expecting, as Alex pointed out, another non-profitable quarter, more losses ahead. Now, I will say the losses are expected to somewhat moderate, but yeah, still losing money without much clarity on when they'll actually be making money. So that's another thing that I tend to look at more in terms of like investing in some of these more long-term ideas. Now, when we trade this name, of course, we talked about the idea of like chasing momentum, chasing a lot of this upside today. I mean, we're up 24%. We are actually a lot closer to the yearly highs as well. We have only pulled back at this point now about 14 roughly percent from those highs, which is something. I mean, we're making up considerable ground today. So to walk us through how you think about trading this name again for example purposes.
Yeah, this price may not still be there, but the idea could still exist. What I looked at was, hey, it's FOMO. There's momentum, there's excitement, perhaps a technical breakout underway. I can understand the bullish desires for those who are doing something short term in this name. And so catering to that for this example, I looked at a bullish example spread. It's risk defined most importantly, so if this rally does fizzle out and turn around, you're only exposed for the debit spent on the strategy. But I looked at the 32.5, 35 call vertical debit spread here for 50-cent debit. So the idea being the less you spend on this on a $2.5 wide spread, if you spend 50 cents, for example, you actually have a situation where you're risking $50, but you have a chance to make 200. So it has some positive asymmetry if this rally continues and kind of surges over the next week. It's super short dated, it avoids that earnings, and it needs a pretty big rally by the end of next week. And it also needs the rally to hang out, at least for the end of next week, to get to that max profit. But with this, break even would be 33. We're pretty close to that now. But again, risk 50, chance to make 200. The idea being risking less than the max profit because you're really chasing the momentum here. Who knows? At some point, oftentimes these momentum-driven rallies do fade. It's just a matter of where does it fade from and where does it fade to. And so those are questions that, of course, we don't have the answer to.
No, but at least that momentum not totally waning today, as we now are up about 33% for the month of November thus far. So, I mean, obviously a huge portion of that move is today, but up 26% for the week. So things faring quite nicely, at least over the last two sessions for C3AI. Now, we'll leave it there as far as FOMO is concerned, but coming up next, actually, we'll talk the behemoth that is all things NVIDIA, of course, ahead of their earnings due out tomorrow afternoon. All the analyst expectations, all of the mixed picture going into those earnings. We'll discuss them more coming up next.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is powered by Ameritrade, bringing you futures and forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. It's now time to talk NVIDIA, as this is, I think, one of the most important, if not the most important stories of the week ahead of their earnings. And analysts seemingly more and more enthusiastic as we get closer to their third quarter print. So there's a lot of expectations riding on this stock. We are up 193% this year. We've risen another 9.3% for the month, another 2.25% for the week. We're also still being below the all-time high around 149.77 a share by about 3%. I mean, you'd have to live under a rock to not have heard that NVIDIA has been the mover of the year. The only thing that I will say has been so interesting to me, Alex, is the divergence we've seen that's only seemed to pick up here as we've seen semiconductors actually trade not so much in tandem with NVIDIA. I mean, we saw a lot of these semiconductor exposed ETFs peak out in midsummer. They've been yet to recapture those highs. Well, NVIDIA's sitting pretty nicely right around its all-time highs. It's totally like broken out on its own. We used to joke this was like a two-horse race between AMD and NVIDIA. It's a one-horse race, and it's in all things NVIDIA, and that's why I think that we're seeing so much importance on this earnings, because everything has a market maker move right now tied to the volatility that will be NVIDIA.
Yeah, there's a lot to factor in here. The price action for 2024 almost perfectly, emulates 2023's for NVIDIA. Really explosive first half of the year, a second half of the year that largely was spent in consolidation before a rally into the end of the year, setting up what now had been the same exact structure for 2024. A big rally into the first half of the year, a sideways most of the second half, and now perhaps setting up a next leg up. Now, getting through the event tomorrow is going to ultimately probably play tiebreaker on that. Is, do we spend some more time consolidating, or is it time to make that next leg up if there's going to be one? $145 a share. It's not on its highs, but it's certainly making a run at them after a little bit of a scare regarding perhaps some delays due to some overheating. We'll probably get some clarity from the company on that. A couple things of concern. We are in a period of time now, as would be expected, I think, that you're starting to see decelerating revenue growth. Now, there's not that many companies that are this size, or in fact, there are none that are growing at the rate that NVIDIA is growing. So it's still growing at a just astronomical clip relative to where it just was a couple years ago. That said, when you were having earnings growth of almost 500%, 600% on one quarter, and it's down to 85% if it hits the numbers, or revenue growth that was over 200%, almost 270% at one point, is now 80%. You can see the trend is slowing, but we're talking about quarter over quarter growth. If it just hits the numbers, which it hasn't just hit numbers recently, Jenny, it's been beating them by a wide margin. If it just hits the expectation, quarter over quarter, $3 billion more in revenue than it was the quarter before. Going back to April of 2023, first quarter of 2024 for them in terms of fiscally, this company was only making $7 billion a year. So it's growing almost, or a quarter, I should say. It's almost growing that much now, quarter over quarter, and we're talking about it slowing.
Yeah, I saw a similar stat about its market cap. Now it will move its entire market cap of like 5 years ago just in one session. So it's amazing. And the most valuable company in the world now. I saw a headline that, this is like, who writes this? Not to criticize, but that says, if we don't see some outperformance, we could see downside risk. Hello, I think that's what everyone right now is thinking. That's been the narrative for NVIDIA. Last quarter, we saw a more muted price post-earnings because even though it did outperform, it's just like, what even is the mark for outperforming? They could hit every bar possible, and still it could be seen as like not good enough.
Yeah, there's a lot of question marks still, but what does even a down move look like in NVIDIA? It moved lower last time, the dip was quickly bought, it only moved 6% in that first day after. It's got this characteristic to it now. Now, of course, this can change, where it's so big, it's in so many passive and actively managed funds from a quality standpoint to just broad-based indexes that are there's just passive demand just constantly for this stock, where it almost dampens the volatility, much like you see for Apple. Apple moved lower and it was quickly bought back up. The stock's higher now than it was pre-earnings, despite disappointing. Now, when you look at the trends going back to, again, that mid part of last year, it beat by 31% in earnings, then 19, then 11, then 8. Now last quarter it was 5. So again, its rate of beating is going down as well, but the numbers just keep getting bigger and bigger. So My question will be, what does an underperforming NVIDIA look like in terms of stock price? Is it 6%? Because right now the implied one-day move is 8%. Well, 8% in this stock is, you're talking, $10, $12 in the stock. I think you're still having a pretty good year if you're an NVIDIA shareholder if that happens. Now, the scary thing would be if it's some 2-3 times that. If it's $25 to the downside, well, then we're talking about a pretty red day for the market, probably.
I was going to say that, and I think I'm scared to see what that looks like for the sake of everyone's portfolios. But at least, some of its valuation has actually come down. It trades at around 40 times its forward PE. I know that sounds high, but it's actually historically slightly beneath where we've seen levels traded. So I will be watching this event. Of course, we have another full trading session until then, so we'll be discussing this name, I'm sure, more throughout today and tomorrow. We'll leave it there for NVIDIA. But coming up next, time to completely shift gears and talk XPeng, which was initially higher in reaction to its quarterly update. Now it's lower on the session. We'll dive into the numbers coming up next.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Welcome back to Next Gen Investing. It's time for Under 30. Today we're looking at XPeng, XPEV. Joining us now is George Tillis, Senior Markets Correspondent for the Schwab Network. George, a space we have talked about countless times over the years. It's had its ups and downs, and this is one, of course, that has macro concerns as well with its exposure within kind of domestic China and the lack of economic bounce alongside the stimulus. What's the latest here? What are you focused on with XPeng?
Well, obviously, if you look at the stock today, it's down about 3.5% after they reported, quite good earnings compared to what was estimated for this primary EV automaker in China. I'll talk about the financials and the macro in a sec, but if you just look at the print in terms of EPS, the estimates were 27 cents of a loss. They came in with only 23 cents, and that was bested or better than the 28 cents they lost last year for the same quarter. And sales were higher at 1.44 billion by 12.1% compared to 1.38 billion estimates. And so if you look at the delivery numbers, they were actually quite robust, up 16% year over year to 46,533 units. They even gave some preliminary guidance for next quarter's deliveries, which are expected to be up 51%. At the same time, they're expecting in the next few years to increase their total sales by 85%. So overall, the numbers were good. If you look at the total sales for the business over the past 4 quarters, over $5 billion. And if you do look at the losses, just looking at the last 4 quarters, excluding the quarter they just reported, so preliminary 4 quarters before that, was around $1 billion in losses. But what's happening here is that we're essentially seeing the losses get lower. In other words, they're not as large as they had been in the past. The short interest in the name has actually declined to less than 4% of their free float. And they do have about $3.8 billion in cash on the balance sheet compared to about $12.5 billion in equity. So what I see here is a company that's still losing money, but nonetheless, they did demonstrate that gross margins were the highest in their history at 15%, still relatively low. But again, it seems like the pricing erosion that they faced because of competition seems to be subsiding. and their operating vehicle margin was around 8%. So it looks like their costs also were relatively in line. So again, the challenge with the company is that they're still losing money, but they are firming up their balance sheet. Total deliveries are expanding, total sales are expanding, and the stock is only trading down about 3.5% right now.
Yeah, and George, I guess I'm just fairly shocked that we didn't see more of a move to the upside, because I'm like this Volkswagen partnership. I mean, like you mentioned, growth of around 51% for vehicles. I mean, what was really I think what was perceived so negatively that wasn't able to hang on to the positive narrative here?
Yeah, so I mean, context matters, and if you do look at the last year, the stock is down, but in the last 6 months, it's up about 50%, and there's been a lot of movement. I mean, in hindsight, things are clear, 2020 clear. You can actually see a lot of these growth names that haven't generated profits on an adjusted basis at the very least have done well. A group of them have done well since August, and that's, again, precursor to interest rates falling in September. So in the 6 months, this stock has actually moved higher, but you have to consider still that they're not near break even yet. And even next year, they're not expected to achieve an adjusted profit. So therefore, they're going to need financing. And that comes from share issuances, which again, in the long run, is a good strategy. But in the short run, it can suppress the price. And I think that's why it's down right now.
Okay, and great point there, and especially because I mean, this name doesn't exactly operate from an abundance of cash either. So I think the great takeaways. Appreciate it, George Tillis, senior markets correspondent for the network. That'll do it for Alex and myself for Next Gen Investing for this Tuesday. Coming up next, we have the watch list with Nicole Pedalides.
Join me, Oliver Rennick, alongside Schwab Network's options experts as we explore the second derivative. Gamma On is a brand new limited series to take your trading skills to the next level. Subscribe to Schwab Network's YouTube channel now.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
afternoon. Welcome to the Watch List. I'm Nicole Petalides. It's 2 p.m. Eastern Time, and we're coming to you live from the New York Stock Exchange, where stocks have really come back from the early morning lows. For example, the Dow's now down just 11 points. We have a big show for you today. The CEO of Trinity Capital will join me here at the New York Stock Exchange, discuss what's behind the strength of its most recent earnings report. We'll talk about that. It's also Technical Tuesday. That means Kevin Horner will be here, and he'll show us the key trends to watch in the S&P 500, which hit new highs recently, Flutter and Packard. And our panel standing by to give us the very latest on the EV market. Of course, the incoming Trump administration has been pushing forward for full self-driving. What about the rest? We'll have a discussion. In the meantime, here's a look at the market overall. I mentioned the Dow right now. Let's take a look. Is down just 16 points, but the rest of the market has turned back into the green after being in the red early in the morning. For example, the S&P had been red. Now look at it. It's up 28 points, up 0.5%, 59.21. The Nasdaq up 0.75%, 20,690 there. And the small caps up 0.5% as well. So good news there overall, really shaking off those early morning jitters. You have technology leading the way, as well as communication services and real estate and consumer discretionary. Those are some of the best performing sectors today. Bitcoin, 94,000 new highs, folks, up 2.5%, 94,425. The dollar, 106.15, so that's been showing strength. And oil and gold, both higher today. So that's the big picture there. Let's bring in Kevin Hinks, host of Fast Market here on Schwab Network. And of course, retail's in focus for many reasons. We have so many names that are coming up, but a big one that already is out is Walmart and some new all-time highs. We'd like to hear more about that. What stands out?
Walmart putting up video game numbers, Nicole, as we see earnings 58 cents a share versus 53 expected. Revenues $169.6 billion versus 167 expected. The key drivers for them during this earnings period were e-commerce and sales outside of grocery. Obviously, the grocery part of their segment of their company dominates. However, there was a recovery in discretionary buying that really fueled Walmart stock higher and really talks about the retail space in a different way. Here's some of the other numbers. Revenue growth up 5.5%. Operating margins 4%. Inventories 63.3 billion. Walmart US comp sales up 5.3%. Sam's Club comp sales up 7%. Really good performance out of Sam's Club. So average ticket sizes from Sam's Club up 6.4%. Average ticket up 0.5%. These are all good numbers. You see Walmart stock up about 4%. It was already sitting at or near all-time highs. So a really strong performance from Walmart, Nicole.
Yeah, really impressive, unbelievable. And then Lowe's, I mean, we saw an earnings beat, but still under some pressure, right?
Different story from Lowe's because of some of the guidance. You're right. Earnings per share $2.89 versus $2.82. Revenues $20.17 billion versus $19.94 expected. Full year guidance, they gave about $11.80 to $11.90. Comp sales, here's where it gets problematic. Down 3 to 3.5% versus down 3.5 to 4 prior. Adjusted operating margins 12.3 to 12.4%. That stock Lowe's is down about 3.6%. It actually had good numbers so far this year. The stock was pretty strong. Last 12 months it's up 28%, but down about 3.5% today, Nicole.
All right, Kevin Hanks, thank you so much. It's great to see you. Appreciate it. Now let's take a look at the bigger picture. Brian Glenn's with us, Chief Investment Officer, Premier Path Wealth Partners. Thanks for being here, Brian. Some of your thoughts on the market. I mean, first of all, we have a nice comeback this morning. A lot of worries, of course, about Russia, Ukraine, and the tensions on the rise, even the talk of nuclear weapons, and that spooked the market this morning, but amazing to watch it come back. I mean, what do you make of some of the volatility?
Thanks for having me, Nicole. And I'm down here at the Dynasty Conference down in Florida, and one of the things that a lot of people are talking about is how the market has performed so well despite what's been higher than expected interest rates and lasting higher than we've anticipated. And one of the things that's been discussed frequently is the net stimulus that's going into the economy from the fiscal side. So despite restrictive monetary policy, it's been a net stimulus on the fiscal side. Will that continue? And then the other thing that's been discussed is how strong the consumer is. This is a consumer-driven economy. And if you think about it, wages are growing north of 4%, which is almost twice the rate of inflation. And so if that continues, I think we have a strong backdrop for stocks and for the economy as a whole.
So, I mean, we do have this higher for longer rate environment. I think a lot of folks were hoping rates would come down. You're talking about how we've been higher, mortgage rates are higher, long end of the bond, the long end of the curve has been higher, but we do have the Fed coming in to cut rates at least once, right? What do you think happens there?
If you look at historical rate cut cycles, typically when there's a recession, you get a deeper series of cuts, and we don't know the future, but I think what investors should start to expect is, sure, maybe there is a rate cut or two on the horizon. We know that the Fed funds rate is much higher than the real rate and higher than the economy is growing. But if we should expect possibly a scenario where rates aren't cut as sharply as we've seen in recessions, especially if we have an economy that continues to grow.
Yeah, and this rate environment, does it matter for a name like Meta that you do like, right? You like Meta, where rates are exactly?
Yeah, so at Premier Path Wealth Partners, one of the things we say inside our office is that Meta is really our kids' generation's cigarettes. And it sounds like a pejorative term, but for people who have invested in Philip Morris over the last 40 years, they know it's one of the best performing stocks. And if that trend continues, our job is to deliver returns to our investors. This is a company that cut headcount by 15%, and then what happened? Revenues went up by 30%. They're the largest buyer of NVIDIA chips, the H100 chip, and so there's an optionality play on artificial intelligence. Oh, and by the way, they pay a dividend now that they started in the beginning of 2024, so it's going to start showing up in some of the factor ETFs that buy into dividend stocks as well as buybacks. And they have a return on equity of north of 30%, so it falls into a quality bucket for ETFs that buy stocks in that method.
Yeah, understood. And then you also have TransDigm too, TDG, folks, if you want to take a look at that one. Why is this a name you followed for a long time?
I've followed TransDigm for quite a while. It's an interesting business. It has margins. Most people wouldn't realize this. It's a manufacturing business. They make aftermarket aerospace parts. We have a situation globally where our two largest producers of single-aisle aircraft, Boeing and Airbus, have backlogs north of 10 years. So if you look at Airbus, it's 9,000 jets. If you look at Boeing, it's 6,000. If you look at what these guys are delivering each month, it's fewer than 50 jets. So they're barely chewing into that. And so what do we have to do? We have to maintain the aircraft fleet that we have now. And one of the big beneficiaries is going to be a company that sells into the aftermarket space. And most people, I don't think, realize, but TransDigm has higher margins than Apple and higher margins than Google.
That's pretty amazing, especially for the world of aerospace parts that you said in the aftermarket. I mean, do you like aerospace and defense stocks generally? Do you think that the Trump administration, I mean, he did say something in his speech talking about building up the military so that we don't have to use it. Did that bring some optimism for a name like, I mean, TransDigm and aerospace and defense overall, or not necessarily?
There's a longer-term trend that we've depleted our stockpiles, and this is actually before Ukraine-Russia conflict. I think there's a lot of change going on in aerospace and defense. I think last time I was on this segment, we talked about lower cost ways of munitions of aircrafts, and there's a ton of innovation in that space. If you look into the venture cap side of things, which I know we're not talking about now, there's a tremendous amount of innovation. And I think it's an exciting space. I think some of the public companies, large and small, will benefit from that, and we'll see how the administration responds.
Yeah, understood. Also just when we look at the new administration and how they're putting it together and they're looking at government efficiency, the Department of Government Efficiency, your thoughts on that group? Do you think that will serve a great purpose or not necessarily?
I think it remains to be seen. We had someone earlier today speak at this conference. The number they put on it was 100 billion to 200 billion. It was actually one of the smaller line items of costs that would be ripped out of the government in terms of the fiscal spending. And we'll see. It's Elon running it. It's Vivek running it. I think it's a clever play on words. We know this goes back to a tweet sometime in August where someone said, hey, we should do a Department of Government Efficiency, aka Doge, which is a play on that crypto coin. And so we'll see what happens. I think anyone that sells into the DoD, they might have crosshairs on them, and TransDime's no different. That's part of their business. The other part is commercial. It's more than half commercial.
Right. So overall, Brian, if you were to describe your mood and your attitude towards the market between now and the end of the year, and then for 2025, what do you tell investors? The big picture takeaway. Go for it, hold off. I mean, what would you say?
I think you have to be somewhat selective. Everyone points to a higher market multiple. Everyone knows now, this is no secret, that's heavily weighted towards the NVIDIAs, the Microsofts, all the large tech companies. And on the smaller cap side, we know those companies suffer from higher interest rates. They have weaker balance sheets. They have single lines of business. They're highly domestic, which, by the way, that would actually be a positive if we put up tariffs and trade walls and bring back production domestically. So there is an offset there. I think allocators and investors have to be very specific about how they're allocating both across the economy and within which sectors. You asked me how I felt. I think I'm pretty bullish, and I feel pretty strongly that the consumer is going to continue, and that we have a strong backbone, and we have a number of good years ahead of us.
Oh, I like the good years ahead of us. A number of good years ahead of us. I like that last ending there. Makes you feel a little better, right? Brian, Glenn, great to see you. Thank you, Premier Path Wealth Partners.
Yep,
Thank you.
Thank you. Thank you.
Thanks. Coming up, Options Corner. Tom White is standing by. He will highlight unusual options activity from the day and how investors are looking to trade on recent news of Uber, C3AI, and Joby Aviation. Stand by. We will be right back. The Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the Watch. Joshua, it's time for Options Corner, where we analyze unusual options trades that we're seeing throughout the day. You'll want to hear more about this. Tom White is here, host of Fast Market here on Schwab Network. He's been combing through and, in fact, found bullish trades on some 3 key names in the news. First up, you have Uber here, where you found a bullish trade. Nice to see you, Tom White. I'd like to hear more about it.
Yeah, stock's been under pressure since hitting all-time highs a few weeks ago, and that's probably based on the fact that competition maybe from, autonomous vehicles getting kind of thrown into the mix there. Bank of America took Uber off its US 1 list, so those were top stocks that they picked. So they removed that today. And then also on the back of that, Trump's team's, looking to ease self-driving car rules, according to Bloomberg. So there's some headlines out there that are kind of negatively affecting the stock. It's off a little bit today, even though the entire market's kind of reversed here today ahead of NVIDIA earnings. But I think a note that came out earlier today out of Jefferies stating the fact that the stock's pulled back nearly 20% from those all-time highs, and this is based on those concerns about, hey, where is Uber's fit going to be if autonomous vehicles really start to ramp up? The pressure from maybe Google, Alphabet's Waymo, Tesla being in cahoots here with the administration, maybe Elon Musk having some say as far as full self-driving and autonomous vehicles. That's been a concern for them, but Jefferies does still like the stock. Good buying opportunity, they said. They've got a $100 price target on the shares. But we did see some bullish activity in here, even though Bank of America removed them from their US 1 list. A trader bought out in the January monthly cycle about 5,000 of the 75 strike calls. Paid an average debit of about $1.50 on those. So the break even for this trader where they turn profitable is $76.50 over the next 59 days. That's about 10% above the current share price in Uber. So you're going to need a move in the shares. But I think one of the key things with this type of strategy that this trader's buying calls in is that it's 2 months until expiration. So you have plenty of time for the stock to reverse, make up some of the losses that we've seen over the last several weeks.
Yeah, understood. I mean, I was just looking at Lyft, how it had a gap up on earnings. We think of these names sometimes together, but the autonomous stuff still sticks around with Uber in the big picture. But as you noted, off the highs of $87. So thank you for that bullish trade where someone sees some opportunity. Next up, the ticker symbol's AI, C3AI. We often have the CEO here on the network, a friend of the network, of course. So we've seen some nice moves. In fact, it's been surging. Some of your thoughts on the action we've been seeing and the bullish trade you found?
Yeah, stock's actually positive now on the year after this pop of over 20% in today's session. They don't have earnings until the 9th of December, but I think the big news on why we're seeing this massive pop today is on the back of at Microsoft's Ignite conference. C3AI and Microsoft announced an expansion of their strategic partnership moving forward. What does this mean for C3AI? Well, they're going to be able to embed their platform within Azure and the cloud side, and then 365 as far as their other Microsoft products at this point. So this is going to be an expansion of that partnership. Stock had been lagging a lot of its competitors. One of its biggest competitors, of course, is Palantir. We talk about that name quite a bit here on the network. But one of the key takeaways from their last earnings report is that they're actually starting to take some market share away from Palantir, dive more into this marketplace as far as Department of Defense. And that's the Navy, Marine, Intelligence Community, and Air Force here, where they're getting more than 30% of its bookings moving forward from federal agencies. So digging into Palantir's sweet spot as far as revenue generation there. Now, some of their underperformance can be tied to the fact that they're moving away from a subscription-based model into a more consumption-oriented one. That's yet to take hold as far as maybe the share price goes, but they are making changes on that front. But I think if you take a look at the total addressable market within these AI platforms, and this is basically just an extension of taking those AI tools and making them work for their consumers. IDC said that it's supposed to, over the next 5 years, grow at a 41% growth rate. So a lot of total addressable market out there, and we've seen what Palantir shares have done recently. But we did see some unusual option activity in here today, really short-term positioning, I think maybe based on this pop. But trader bought early on this morning when the stock was up just a little bit. They bought 5,000 of the 31 strike calls in the November 22nd weekly cycle. So just 3 days to expiration. Paid an average debit of about $1.10 on those. So that break even at 32.10. Where they become profitable over the next 3 days, well, we're already above that price because the stock has continued to move higher throughout this session. Call volume, though, is 9 times normal daily average volume that we've seen over the last 5 days of trading. So, yeah, call buyers going into this one. It looks like this trader already is making some profits here on this trade.
And we think about AI and we think about Palantir. I mean, we heard Dan Ives here on Market Overtime recently just talking about the group and the exponential growth and potential going forward. So you found this bullish trade. Thank you for that. A good look there at C3 AI. Last but not least, Joby Aviation.
Yeah, Joby's popping in about 7-8% so far in today's session. Still down about 9% so far in the year, but it's had a nice rally over the last 3 weeks here in November, up about 25% so far this month. This is all based on the air taxis, right? We've already seen the investments from Delta that they had earlier. Toyota Automotive put in $500 million worth of investments in Joby Aviation. They're starting to build an airport base in Dubai, so they're expanding overseas also. They've already done some test runs between Manhattan and JFK. They say it's going to take 10 minutes, Nicole. So next time you're heading out to JFK to get out of town, maybe you'll be able to take one of these Joby Aviation air taxis in the next few years when they roll these out. But I think if you take a look at the movement today, it's probably based on the fact that Needham came out with a note on Joby. They put a buy rating on it, an $8 price target after they initiated coverage of this one. And they said that they're going to be the leader in the future of air taxi and their networks. They're thinking it's a $3 billion taxi opportunity. And that's out to 2029. So maybe this is a longer dated kind of outlook here from Needham. But I think that's why you're seeing the stock pop. And we saw some call buyers in there also really short term. In the November 22nd weekly options, traders bought over 8,000 of the 6 strike calls. Paid only an average debit of about 25 cents. These are short-term options. This isn't a high-priced stock. So that break even is $6.25 over the next 3 days. It's only about 3% above the current share price in there, with call volume about double normal daily average volume that we've seen over the last week of trading in there. Yeah, but seen a nice pop here in Joby.
Yeah, without a doubt. I mean, the $8 target from the 612 here certainly would be a nice move for folks too if they were to get that. Thank you so much, Tom White. Great to see you every day here on the watch list with Options Corner. Thank you. Coming up, the CEO of Trinity Capital will join us, sharing what was behind the record numbers that the company saw in the latest earnings report. And
what happened here?
Stay with us.
Shit.
Trading at Schwab.
I didn't have it on?
By Ameritrade, bringing you futures and forex for round-the-clock market access, even when equities markets are closed. All on our award-winning thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Accelerate your market knowledge.
And shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the watch list. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. Glad you're with us. I have a few movers for you, market movers that you need to take a look at into it. Let's moving lower after the Washington Post reported that the Department of Government Efficiency, which includes Elon Musk and Vivek Ramaswamy, have discussed creating a mobile app for Americans to file their taxes free with the Internal Revenue Service. According to this report, these talks have been described as highly preliminary. And shares of Supermicro, well, those are surging after a company appointed an independent auditor and submitted a plan with NASDAQ to comply with the listing requirements. Supermicro's CEO said the appointment of the new auditor is an important next step to bring its financial statements current. The company added securities will remain listed pending NASDAQ's review of the plan. So that's obviously a big deal for a name that has been beaten down. Let's turn our attention now over to Trinity Capital, provider of diversified financial solutions to growth-oriented companies. Its latest earnings report, well, Trinity Capital hit a record of $645 million of investments and funded a record $459 million of total investments. So let's hear more about Trinity Capital, the impressive quarter, and the outlook. We welcome in Kyle Brown, CEO at Trinity Capital. Thank you for being here. Glad you're here. Nice to have records in the quarter, isn't it?
Great.
You know, how do you keep those going?
I think right now we see a really robust private credit market. You're seeing tailwinds, particularly in kind of late stage VC to lower middle market. You're starting to see that dam, which has been leaking a little bit on M&A activity. It's picking up. And that's leading to more activity, more transactions, which require debt in lieu of some of the bank financing that used to be available for those transactions.
We found that to be so true, right? People were going to VC, venture capitalists and private equity to make their deals. They were having a hard time getting loans or deals through the banks. Do you think this trend will continue in 2025? I mean, you're going to have a more business-friendly administration. Rates will likely come down, but people have become very accustomed to doing things this way.
Yeah, you have a record amount of venture capital on the sidelines, a record amount of private equity on the sidelines, and deal flow has been slow. And so I think, A, we're counting on human nature. Those managers do not make management fees and incentive fees unless that money's deployed, and that money's going to get deployed. Right. You have companies who have been sitting on a valuation that was too high in 21 and 22, and they're starting to accept the fact that they cannot work into those valuations. That's going to lead to more M&A activity, and it's going to lead to a lot of liquidity and more deal flow.
I mean, you could almost equate this to selling your home. You know, if you sell your home and you say, oh, my home's worth $5 million, and the broker's like, no, it's really only worth $3 million. Yeah. I mean, once you come to terms that maybe you bring that down to the $3 million, then it gets moving and you make the deal, right? I mean, maybe some of the companies are overvaluing themselves. Why do you think they do that?
You had ZIRP. You had zero interest rate policy money, and you could invest it, and it was free money. So companies received higher valuations because managers had more money available to them at low to no rates.
And now, as we see the new year, we're likely to see the Fed cut once, twice. I don't know. What do you think?
I don't have the crystal ball. I don't know that we need a lot of rate cuts, but I think you have an administration that's coming in and this dam that needs to break, it needed something, and maybe this is it. You know, I think right now you have a lot of really good feelings about the future, and some of these companies were willing to take that lower valuation, hoping that they can build that business into a rate-friendly and an economy that's growing and building in the future.
Tell me about some of the companies that you've recently lent to. I saw, for example, an orthodontic chain expanding in Europe. I mean, these are like the fun stories that we get to hear behind the Trinity Capital headline.
Yeah.
You know, that's a fun one, right?
That's a fun one. We are expanding in Europe right now, so being able to put some great people on the ground there and go after a market that's underserved for equipment financing, for kind of lower middle market and late stage VC. We love Europe right now. Rocket Labs is a name that's on everybody's mind right now because the stock is flying. We did the equipment financing for that company in December. That's a high flyer for us right now, something we're very excited about. We continue to see investments into AI infrastructure, so we are doing a lot of the picks and shovel financing for that industry. A lot of the GPUs, CPUs, and some of the power generation. There's a lot of capex required to make those companies fly and for them to work, and we're right there financing it. So we're kind of on the peripheral, taking less risk, but we're still participating in that boom right now.
So different. I mean, all of these are in such different categories, right? Because you're talking about AI and all the infrastructure that goes with that versus, you know, orthodontics and, you know, equipment for Rocket Labs. I mean, all so different. Are you seeing more strength in certain areas? I mean, you mentioned AI, so I have to think tech is particularly strong.
Yeah, you follow the money, right? Software still gets more money than any other industry from VC. We're seeing a lot of investments in that space. We saw increased M&A activity there. So our sponsor finance group that's focused on M&A for private equity-backed deals, that was up 20% quarter-over-quarter, 15% year-over-year in software enterprise SaaS. That's exciting. We continue to see kind of frontier tech, space tech. There's a lot of money going into sending satellites up into space. And then you have a lot of infrastructure stuff. So a lot of manufacturing that is coming back to the U.S. That trend was already happening. And now with this administration, there's even more of a push towards getting manufacturing back into the United States. We're excited about investing into that.
And the repurchase, stock buybacks, obviously showing confidence in the company here. The board authorized that. Tell me a little bit about that.
I think the dividend yield is too high, and the stock was trading down. And there is a point where when your business is valued near its NAV and you've got 100 people and a management company, and we believe it's worth a lot more than that. And so to the extent it trades too low, we're absolutely going to be opportunistic and buy back shares.
Right. I mean, what's the dividend now?
15%.
That's a lot.
It's a lot. I bought some more last week. I like it.
Oh, so that's definitely one of the reasons why people love to hold it. I mean, even on a bad day, you know, you're getting paid to wait, right? You know, as we think about the new administration, are you worried about any hurdles? Or is it more just good news? I mean, you may have lower corporate tax rates. I don't know.
We've built this business through 4 different administrations, and successfully and scaled them. So there will be some new challenges. There could be some really nice tailwinds as well. I think perception sometimes matters more than reality. Right now,
Give me just a second.
Hope, and that the economy is going to be better than it is.
Okay, give me a second here. I'm gonna go ahead and close this down. I don't want to give out any information nobody needs to know. Where's it at? Where's it at?